We are excited to have you today at our conference. This will be an opportunity to learn from each other and grow together. I assure you that this conference will be fruitful and informative for all members participating in the conference. We have with us today Director NISM Shri Ashwini Bhatia, Chief Economic Advisor, Government of India, Shri B. Ananta Nageshwaran. He is joining us virtually. And Shri Uday Kotak, Founder and Director, Kotak Mahindra Bank, Chairperson SEBI, is going to join us shortly. May I request all the dignitaries to please join us on the stage. Let us begin today's auspicious event with the lighting of lamp, praising the most merciful and the most benevolent. Candle, please. Sir, please. Kamlesh, sir, please. Pramod Rao, sir. Sir, please. We have a rich tradition of Atithi Devo Bhava. Here too, we are going to follow such rich culture of ours. May I request Registrar NISM to please welcome Director NISM with the bouquet. Please bring the bouquet. Welcome, ma'am. A bouquet for Mr. Uday Kotak as well. We welcome Director NISM. It is said that success is where preparation and opportunity meet. SEBI-NISM Research Conference provides exactly that platform. This annual conference has been a part of our institution from the last 5 years. It has been a great medium to involve people from academia and markets and MIIs. And this inclusion not only increases mutual respect amongst people, but also makes the research work more comprehensive. Topic of present conference is sustainable finance, the way forward. In an era defined by economic dynamism, understanding the significance of continuous investment and its impact on long-term growth is paramount. Let's delve into the key aspects that shape our financial landscape and the role sustained capital formation plays in fostering a robust and resilient economy. In the coming 2 days, we will be dealing with various aspects of such an important topic. As we engage in discussions and share ideas, let us remember that the discussions we have during this conference will have the potential to bring a big change. We have the privilege to have esteemed speakers in our midst whose insights will further illuminate us regarding the topic. Before beginning, I would like to thank all the dignitaries for taking out their precious time out and making to this event. Without taking much time now, I now invite Mr. Ashwini Bhatia, Director NISM, for the opening remarks. Mr. Bhatia took charge as a whole-time member SEBI in Mumbai on June 1st, 2022. Prior to this assignment, he held the position of Managing Director, State Bank of India. He handles the Department of Debt and Hybrid Securities, Corporate Finance Investigation Department, Corporation Finance Department, General Services Department, Regional Offices, PQRTI, and Board Cell in SEBI. He comes with an experience of over 3.5 decades in the State Bank Group. He has wide experience in treasury operations, retail banking, credit, investment banking, and asset management. So we are eager to hear your thoughts.
A very good morning to all of you. Mr. Anant Nageshwaran, Mr. Kotak, Madam Madhvi Butch, dear participants, good morning. A pleasure to have you with us this morning, and I welcome you to the 5th SEBI-NISM Research Conference, a two-day conference which focuses on exploring the many facets of our conference theme, Sustained Capital Formation, the way forward. The conference aims at providing a platform for academia, industry interface, helping exchange of knowledge, ideas, best practices, and to catalyze innovation. To begin with, I'd like to mention that capital formation stands as a cornerstone for the nation's economic growth and development. The good part is we have capital in good measure, whether it is through the traditional channels, but all this needs to be raised transparently and then channelized for sustainable development and growth. The dynamics of capital formation have profound implications, especially for India. To meet India's aim of becoming a developed economy, investment in infrastructure will be key. Substantive development will require investment in all forms of infrastructure: physical, digital, social, climate. The budget estimates for 24-25, the capital outlay for infrastructure is expected to increase by 11% to 11 lakh crores, which this amounts to 3.4% of GDP. Going forward, India will also need to spend more on infrastructure, which according to estimates stands at 8 to 9% of GDP. It's clear that the demand for funds far exceeds supply. With government funding nearly 70% of infra projects, it's expected that going forward, private capital and investment needs to contribute a higher proportion of the total funding that is needed. This is easier said than done. In order for private investments to flow, we need more depth in bond markets, including municipal bonds and infrastructure investment trusts and REITs to supplement the equity markets, which we think is very well developed. We also think going forward, more and more population of the nation will move to urban areas. It's imperative that the municipal bond market grows. We have seen great traction in the InvIT and the REITs market. Another source of funding will have to come from the financialization of household savings. As per the statistics published by RBI on financial assets and liabilities of households, the stock of financial assets of households forms 103% of GDP at the end of March 23, which is roughly about 280 lakh crores. But the challenge is, how do you channelize all this? Because a lot of it is in the form of gold, real estate, and other assets. Of the total financial assets, bank deposits were the preferred choice of households with 45.2% share. Mutual funds form only 8.4% of the total financial assets, though that has also been doubling very, very fast. On an average, financial assets have been growing by 12% year on year for the past 3 financial years. Of this, investments in equity and mutual funds forms only 4%, while bank deposits take away 40%. It's clear that the potential investment capacity is already present in the financial system. What we need are the right methods and means to take this forward. The rise of retail investors post March 20 is a story that has been iterated multiple times. I will take a few moments to run through the latest figures. The number of unique mutual fund investors as of March 24 stood at 4.3 crores, almost double what we had in March 20. The total assets under management also have been growing very fast. In 2013, we were at 8 lakhs. In March, we have crossed 54 lakh crores. The same is naturally reflected in the growth in total demat accounts. Presently, the total number of demat accounts stands at close to 15 crores, which is 3.7 times from March 2020. Nearly half of these were added in tier 2 cities and beyond. During the course of this conference, we will touch upon topics that will shed light on challenges before us in more detail. We are delighted and very happy that the conference begins with an address by Mr. V. Anant Nageshwaran, Chief Economic Advisor to the Government of India, on his thoughts, and that will be followed by an address by Chairperson SEBI, Ms. Madhavi Butch, followed by Mr. Uday Kotak with his keynote address. The panel discussions will take you through the next big ideas of capital formation, deliberation on infrastructure financing, and how do we move from being savers to investors. NISM, as you all know, was formed in 2006 with the objective of building capacity of various stakeholders of the Indian securities market so that we have an efficient and robust securities market in place. The purpose of NISM has been changed recently. I'd like you to just listen to this, that to develop NISM as a premier institution recognized globally for capacity building. Capacity building is very important in the securities market ecosystem with the objective of enhancing quality, compliance, efficiency, and effectiveness of the participants in the market. This would be achieved through skill development, professional training, and certification. To achieve this purpose, NISM has been carrying out a wide range of capacity building activities for professionals in the securities market with an objective to disseminate knowledge through technology-driven initiatives like e-learning programs, webinars, hybrid programs, etc. NISM also considers the importance of industry collaboration. Since inception, the focus of NISM has been to engage with industry partners to understand their training and skilling requirements, enabling it to jointly develop programs and certifications that directly address their needs. NISM has been reaching out to market infrastructure institutions like NSC, BSC, and other intermediaries so that professionals are well trained. These initiatives underscore our commitment in strengthening our ties with industry and facilitating innovation for a more collaborative future. By bridging the gap between theory and practice, this conference will enable collaborations so that we have more meaningful insights with outcomes that are relevant, useful, and that can be applied to the real world in the securities market. Finally, I conclude my address with few words from the book, Psychology of Money. Growth is driven by compounding, which always takes time. This holds true for developments, changes, and improvements that always compound over a period of time. I once again welcome you all, researchers, market participants, industry experts, and my colleagues from SEBI, NISM to this year's conference. I hope we get wonderful insights from this conference that will guide us in policy formation and designing programs and certifications that address the needs of market participants. I welcome you all once again. Thank you very much.
Thank you, sir. It was so pleasant to hear you today. Shri B. Anant Nageshwaran is the chief guest today, and we are excited to hear some words from him. Instead of his tiring busy schedule, he agreed to be with us today. We are grateful to him for the same. Being appointed Chief Economic Advisor in January 2022, Dr. Nageshwaran is a writer, author, teacher, and consultant. He has co-authored 4 books. He has taught at several business schools and institutes of management in India and in Singapore. He was the Dean of the IFMR Graduate School of Business and a distinguished visiting professor of economics at Kriya University. He was one of the founders of Avishkar Venture Capital Fund and the Takshila Institution. He was a part-time member of the Economic Advisory Council to Prime Minister from 2019 to 2021. With that, I invite Mr. Nageshwaran to kindly address our distinguished audience. Welcome, sir.
Thank you, Deepali. Good morning to everybody. Mr. Ashwini Bhatia, Director, NISM. Ms. Madhabi Puri Bush, Chairperson, SEBI. Mr. Uday Kotak, Founder Director of Kotak Mahindra Bank. Mr. Tirthankar Patnaik, Chief Economist, NSE. Mr. Anant Narayanan, SEBI whole-time member, other distinguished whole-time members of SEBI. Ladies and gentlemen, it would have been my absolute pleasure to be there in person, be with you and share my thoughts. However, one thing I have learned in the last 2 years is that it has made me very philosophical. In other words, the extent of uncertainty that we face in terms of even having control and influence your day-to-day schedule is so light that one simply has to go with the flow, and nothing is certain until it is actually completed, not even when it begins. So this particular address, which I would have loved to deliver in person, was pretty much a certainty until about 36 hours ago. And then certain developments happened, which required my presence unavoidably here in Delhi. And therefore, I am delivering this lecture virtually, and my grateful thanks to SEBI and NISM for organizing this virtual interaction on my part, and my apologies to all of you for not being there. When Deepali was making the initial announcement about the focus of this conference, and I had spoken at this conference, if I'm not mistaken, in 2020, I think a few weeks before, I think COVID enforced a 2-year moratorium on many things in the world. She said sustainable finance the way forward, and that made me shudder involuntarily, because some of these words like sustainable, green, climate, environmental have all been overused to the extent that many of them have lost their meaning. They have become nice scaffolding or convenient packaging for industries, policymakers, regulators, financiers, and everybody to clothe whatever else they do in this language. And that fad and fashion, therefore, is not the subject of this research conference. According to the complete schedule I got, it is sustained capital formation, the way forward, which I like. And I was also very happy to hear from Director NISM, Mr. Bhatia, that apart from reading out the statistics on number of investors in the market, number of demat accounts, assets under management, etc., towards the end of his remarks, he also cited one of my favorite authors and writers, Morgan Housel, from The Psychology of Money. And he did speak about the power of compounding, which takes time. And that is the key consideration that all of us attending this conference have to take away with us. Capital formation also takes time. And one of the most important ingredient of capital formation. I will come to the non-economic ingredients later. But the economic ingredient of capital formation is, of course, economic growth. And there is a mutually dependent and symbiotic relationship between capital formation and economic growth. Capital formation is required to generate economic growth, and economic growth in turn generates the income and savings to facilitate capital formation. That is why the economy is a system of mutual dependencies. That is why when an economy goes into a funk, you need exogenous shocks to lift it out of the funk, which normally comes from fiscal stimulus, because the fiscal authorities, given their ability to tax, or the monetary authorities given their ability to print money, or external demand, or the factors that do not necessarily fall within this closed loop system. And these are considered exogenous factors that can once in a while be applied to lift economies out of downturns. Otherwise, capital formation and economic growth are naturally codependent. And in this regard, we are all very happy to note that our economy is poised to grow at more than 7% for 3 consecutive years. And with some very good luck and reasonable assumptions, we might do so in FY25 as well. That would be 4 consecutive years after COVID. Not too many economies around the world have managed to achieve this feat. It is as important for us to learn from our successes as it is important to learn from failures. So how have we been able to get to these possibly 4 consecutive years of 7+? And the answer is that we did things prudently in a calibrated manner and did not get carried away. I have deliberately chosen words which apply very much to capital markets as well. Not getting carried away, doing things prudently, and knowing your strengths and limitations. And I'm talking precisely about the fiscal and monetary stimulus that were applied to the economic downturn that followed the COVID pandemic onset. Because the fiscal and monetary stimulus were measured, calibrated, and finite, it was possible for them to be pulled back. Monetary policy pulled back earlier, and fiscal policy is now pulling back very actively, as is evident in the interim budget presented for FY25, and creating fiscal space in good times, withdrawing the fiscal accommodation that was needed for 2 years or 3 years after the onset of the pandemic. So in other words, it is important to know one's strengths and limitations and not get carried away by conventional wisdom and groupthink, which at that point, and even I myself have to admit that I wrote in an op-ed in Mint that the government of India should use the opportunity to kickstart growth with a large fiscal stimulus, because we already were getting into an economic downturn in 2019-20 as well. And I'm glad that the policymakers in North Block, the building that I currently am part of, did not heed such advice, including from me, and stuck to their chosen path of prudence, targeted and effective fiscal intervention. In other words, one of the important things to sustain capital formation in the economy and the way forward is to not fall prey to conventional wisdom and groupthink. So that is, apart from economic growth, apart from responsible fiscal and monetary policy making, the most important considerations I want to mention here are behavioral factors in my opening remarks. Mr. Bhatia spoke about the new mission of NISM, and he spoke about skill and capacity building in among various players in the capital market. I think conferences such as this have to also focus on the behavioral dimensions that will sustain capital formation. And I'm coming to that. The reason why we in India have so far, and that is why I like the use of the word sustained capital formation as the theme of the conference. In general, Sustaining a certain activity or performance over long periods has been rarer in our country. It has been more the exception than the norm. I'm talking at the macro level, and I'm aware that among the audience and among the speakers, we have Mr. Uday Kotak, who has successfully built a sustained, successful business. And there are many such excellent corporate entities which have sustained performance and made a name for themselves and earned well-deserved reputation. But I'm talking in the macro sense. In general, sustaining performance over long periods has been elusive. We have had short bursts of economic growth for 8-9% over 3 years or 4 years, and soon thereafter we run into the brick wall of imbalances, overheating. And naturally, in its wake follows high trade deficits, higher inflation, overvalued exchange rate, non-performing assets in the banking system, etc. And the cycle and the clock is set back to zero again. So in other words, we have always had this problem of running out of breath and running out of steam after a few years. And just to put it in perspective, China's economy grew at an average of 9 to 10% for nearly 30 years. And even if we discount some of those growth rates as inferior in quality towards the end of this 30-year period, for the large portion of the 30 years, the quality of growth was very good. And there were many things that they did rightly, such as investing in scale, and also in the initial spurt of reforms post-1979, there was a lot of emphasis on bottom-up growth, town and village enterprises, agricultural productivity, etc. So it's important to remember that for us to be able to sustain capital formation, we need sustained growth without succumbing to the short-term economic cycle, which in turn arises out of our mindsets. And that is what I am laying the foundation for in my remarks. This time around, we have some hopeful and promising signs that we can indeed sustain the capital formation. The most important and visible symbol of this hope for sustained capital formation is the physical infrastructure that has been created over the last 8-9 years. I have not been tired of mentioning this in my remarks in various forums. One example illustrates this very clearly. In the last 1 decade, or even less than that, we have doubled that number. And you can look at power capacity addition, electrified railway lines, national highways built, number of educational institutions created, etc. All of them attest to the fact that India's supply side limitations have been considerably addressed. And of course, that is not the end of the road. It is a journey, because an economy that is graduating from poverty to underdeveloped to lower middle income status towards middle income and upper income status will continue to require the creation of infrastructure. But more important thing is the mindset shifted to realizing, accepting, and acting on the importance of supply side constraints being relieved, which is what we see manifest in the physical achievements of the infrastructure that have been created. The second reason to be hopeful about is, of course, the creation of the digital infrastructure. And it is not just about being able to undertake transactions for small sums of rupees electronically without carrying a wallet. More importantly, it is a step forward. It is a pathway to financial inclusion, to formalization and market access. Not financial market access, that is important. That is why I said financial inclusion, but market access in a broader sense for one's products and services without having such a large presence, physical presence. Even small businesses today can aspire to tap the local markets in the country and possibly even global markets with their presence in the digital marketplace. That is a very important development. And the third ingredient for us to be hopeful about sustained growth and sustained capital formation is the fact that our corporates and our financial institutions have come out of their balance sheet troubles and they are in the pink of health. And they are therefore having the risk appetite and the capacity to be able to borrow and lend respectively. These are the three important physical signs or indicators that give us optimism and hope about sustaining capital formation. But I spoke earlier in my remarks about the importance of behavioral dimensions. And one thing I mentioned was the willingness and the ability to defy conventional wisdom, carrying the courage of your conviction, to be able to do things that you believe is right within your capabilities and also which accommodates and recognizes one's limitations. And not only investors in Indian stock market today, but even bankers, financiers, non-banking financiers, and Indian corporate sector would do well to remember this on a daily basis and practice, because the biggest risk to India's sustained capital formation and sustained economic growth is not even in these physical attributes, but in our short-termism. And it is a bit of a puzzle to me that a country which has such a deep spiritual heritage and wisdom is actually interpreting mindfulness and living in the present in the wrong ways. Living in the present doesn't mean that one doesn't worry about the future, but consume and also pander to instant gratification. Mindfulness and living in the present simply means one does what one has to do in the present, mindful of one's duties and obligations, without necessarily worrying about the consequences and whether the fruits of such actions will materialize or not. Living in the present and mindfulness did not mean that one had zero consideration for the long term. But I'm not saying that Indians are interpreting mindfulness and living in the present in this manner. They may not be. But our actions make me worry that we may be interpreting mindfulness and living in the present as being myopic. SEBI brought out a very good working paper early in 2022, if I'm not mistaken, or 2023, about how 9 in 10 derivative trades lose money. And yet today, we are still talking about the kind of volume surge we are seeing in F&O segments. And if we look at the RBI data on public issues and rights issues of equity, even including private placements, in 22-23, we basically had about 2.1 or 2.11 lakh crores of total funds raised for the commercial sector in India, of a total of 29.5 crores, all resources combined, debt, equity, public, private, foreign resources, all put together. The Indian commercial sector, the flow of resources to the Indian commercial sector, including bank credit and foreign resources, was about 29.5 lakh crores in 22-23. Equity alone, public and private placement, constituted only about 2.11 lakh crores. One can think, and of course, I'm not including foreign direct investment, which mostly comes in the form of equity. And if I add that, that number indeed goes up by another 50,000 crores, not a big sum. So 2.6 or 2.7 lakh crores out of 29.5 lakh crores that comes in the form of overall resources to the public, to the commercial sector. I beg your pardon. I think the foreign direct investment translates into a figure of 3.35 lakh crores, or not 50,000 crores. So I'm talking about 5.5 lakh crores out of about 29.5 lakh crores, which probably come in the form of equity. And that is still a ratio of 1:4 or 1:5. If we can very loosely talk in terms of the equity debt mix of all resources that come to the Indian commercial sector. And this number, from a macroeconomic perspective, is probably on the lower side in terms of the equity debt balance. So what is needed in terms of the mindset is to be able to focus on long-term equity capital formation in the country. And for that, I think it is important. It is not just the regulator, but also the market participants, including investors, realize that the regulator is not somebody who needs to be tolerated, but who is providing the correct counterbalance or corrective to this instant gratification or myopia, which with few exceptions is the dominant sentiment, especially during optimistic times. Somebody basically, even in temple chariot rides, some of you who have seen those festivals, there is always somebody who has to make sure that the flow and the pace of the chariot movement has to be moderated and managed over time if the chariot has to complete its entire journey around the temple. Otherwise, there will be disaster. So right now, what we have, both in terms of mindsets and in terms of public reactions, there is a certain adversarial attitude that we adopt vis-a-vis regulators. Yes, there can always be a dialogue, discussion, differences with respect to specific measures. But the underlying focus that the regulators have, which is to ensure that we stay stronger for longer, rather than get caught up in the immediate euphoria of our growth rates and market valuations, and also try to make instant profits. And that is what the rising exposure of even small investors in the F&O segment signal to me. And that is a worry, because we don't want to go through boom and bust cycles again and again and again. One thing that distinguishes human beings from other living organisms is supposedly our ability to learn and not repeat the same mistake. We can commit new mistakes, but not repeat the same ones of the past. And therefore, my submission that conferences of this nature have to focus also on how do we inculcate, or NISM, how do we inculcate capacity building in terms of the mental attitudes that are needed to sustain capital formation. Skill and capacity building have to become broader in definition. Let me turn to one last remark on what else is needed. While I have spoken at length on the mindsets that are needed to sustain capital formation, we should also remember that ultimately our work and our preparations for sustaining capital formation has to be based on empirical analysis. In fact, Table 64 of the Reserve Bank of India's Handbook of Statistics on the Indian Economy is actually giving you very, very important pointers, just so that we don't forget the kind of situation we faced in 2017-18 all the way up to 2021. Take a look at the fact about non-food credit in the Indian banking system. The flow of non-food credit to the commercial sector, to the private commercial sector, or including public, was 11.5 lakh crores in 2018-19. It dropped to 4.7 lakh crores in 2021. So that is a drop of almost 7 lakh crores in the flow of banking, non-food bank credit. Let's take housing finance companies. The flow was 2.2 lakh crores in 2017-18, dropped to 28,500 crores in just 2 years in 1920. Funding given by systemically important non-deposit taking NBFCs and deposit taking NBFCs, of course, net of bank credit which they obtained, was 3.7 lakh crores in 2017-18, dropped to 85,000 crores only. The orders of magnitude of contraction in just a 2-year period in the banking system, in NBFCs, in housing finance companies was so big that naturally the Indian economy, even before COVID set in, was in a weaker state. And why did this happen? This happened because of exuberance in borrowing and lending that prevailed in the first decade, spilling over into the second decade. And this is the kind of memory that we should remember. And in order to ensure that one doesn't overlend or overborrow, because again, remember, in the first decade of the millennium, the bank assets to GDP ratio in India doubled from around 28% at the end of 1999-2000 to more than 56%, double, the ratio doubling in a decade when nominal GDP growth was in double digits, is what paved the way for the rise in non-performing assets and all the hard work that needed to be done in the second decade. If we don't have to repeat such spells of excess lending and then indigestion and rebuilding of balance sheets, we should plan ahead by looking at what is the kind of investment ratio that this country needs for the kind of nominal GDP growth that it will have for the next 20 years. And what is the nominal GDP growth that is possible given our demographics, labor and capital productivity? If this is the investment ratio that we can sustain, what does it mean in terms of actual flow of resources that is needed? How much of it has to come in the form of equity? How much of it has to come in the form of debt so that the overall macro financial balance does not get jeopardized? If we naturally, much will come in the form of debt. And if such is the amount of debt that is required, and partly from the banking system, partly from the capital markets, what is the amount of bank capital that will be needed given the capital risk-weighted asset ratio? If that is the amount of equity capital that will be needed in the banking system, where is it going to find this capital? Is it going to find this capital from public budgets? If the banking system remains predominantly in government ownership, or if it has to come from the private sector, why is it a taboo to even discuss corporate ownership of banking assets, of banks? The fact that the mere discussion of the idea of corporate ownership or licensing of banks to corporate houses creates such a backlash and a furor is indeed a cause for reflection on the part of corporates too. Apart from being a cause for reflection on the part of critics and commentators and well-wishers of the Indian economy, etc., corporates also have to reflect on why is it that the public reaction to any proposal, any discussion of corporate ownership of banks or licensing of banks to them creates such a furor is also, unfortunately, a reflection on the overall state of corporate governance in the country. And that goes back to the very issues of myopia and short-termism that I spoke about, which is prevalent among investors, money managers, and the overall sense of euphoria that clouds out the considerations of compounding and waiting patiently for time to emerge, returns to emerge. So I think if India has to sustain capital formation, and the way forward for this, therefore, is in all of us realizing that compounding requires patience and time, that living in the present does not equal to myopia, that delayed gratification and not instant gratification are the answers, not just for individuals, investors or non-investors, but also for businesses, financial asset managers and corporate houses. And if India has to sustain the capital formation for the growth aspirations that we have, and therefore, if more banks and more equity are needed, and if corporates are not going to be there in the forefront of driving this, then also it is a cause for reflection on the state of corporate governance in the country, which also indeed, unfortunately, is a victim of some of the short-term impulses that we carry in all of us. And therefore, research conferences such as these should not only focus on the market microstructure that impede or facilitate capital formation, but also on these larger behavioral dimensions and also dimensions such as governance and our empirical data-based planning for equity rising, borrowing and lending, etc. I once again thank you very much for giving me this opportunity. Much as I would have loved to be present there and deliver these remarks, I hope I have given you enough thoughts for reflection, and hopefully these 2 days of deliberations and various technical sessions will leave us all richer if not financially, but intellectually. Thank you very much. I wish the conference all success.
Thank you, sir. We are so honored and privileged to listen to you today. It gives me immense pleasure to introduce our distinguished guest of honor, Chairperson SEBI, Ms. Madhvi Puri-Bhuj. Ms. Bhuj assumed office as Chairperson of SEBI with effect from March 2nd, 2022. She served as a whole-time member SEBI from April 2017 till October 2021, during which she handled various departments of SEBI. Prior to that, she had a career in financial markets and banking of around 3 decades. She served as a consultant to the New Development Bank in Shanghai, head of the Singapore office of the private equity firm Greater Pacific Capital, managing director and executive officer at ICICI Securities Limited, and executive director on the board of ICICI Bank. Ms. Bhuj also served as a non-executive director on the boards of various companies. So let us have the privilege of listening to the message of Chairperson SEBI.
Very good morning. It's a privilege to be here. I must say that the emphasis that Chief Economic Advisor laid on sustained capital formation and the linkage to sustained growth is something that we all aspire to as a nation. And I would basically like to focus on a somewhat neglected area. Sorry, where do I need to point this? Here? No? Have to point it to the laptop? Okay, not to worry. I'll use page down for the moment. Page down. All right. So I think this says it all. And I always like to emphasize that the reason I'm very fond of this particular slide, I use it all the time, is because somehow this connotes to me the physicality of our nation and the growth of the real economy. You know, there's actual economic activity happening in villages, in factories, in towns, in cities. And this sort of manifests that picture to me in my mind that where there is growth, there is capital formation. Where there is capital formation, there is growth. So it's a wonderful virtuous cycle. And we are today as a nation in that wonderful place where one is reinforcing the other. Now the question is, page down also not. Kya kare bhaiya?
You just tell me.
Now that will work. Maybe that's what they did. Oh yeah. Okay. Thank you. So you can leave it now. I think it's good. So I want to focus, a lot more today on a certain group of assets in our country, the REITs, InvITs, and Muni bonds. Mr. Bhatia referred to it briefly in his speech. I think that, very often when I speak, particularly to youngsters, and it's interesting that they ask me a question, because they say, we want to be where the puck will be, right? They know that their parents and their so-called seniors have been part of a previous revolution. They have taken the benefits of high growth of certain sectors in the previous generation. Now, the youngsters today are interested in what is going to be the high growth area of the future. They want to know where the puck will be so that they position themselves at a time and place where they will have a tailwind to really help them grow as well. So here's my answer to that question. That answer to that question, in my view, is REITs, InvITs, and muni bonds. Now, why is this? Within SEBI, we've done a very simple exercise, sort of like a back of the envelope exercise, where we asked ourselves, how big can this market be? And we reached the conclusion that just as our equity markets today are at roughly one time GDP, right? The entire market cap is about 1 time GDP. We believe that the total value of our REIT, InvIT, and muni bonds ecosystem can be another 1 time GDP. So that is the opportunity for growth which is available to us as a nation. Now, why do we believe this? In a very simple sort of way, the logic is, if you look at all the goods and services that are produced by the corporate sector today, because that is what manifests itself in the form of the GDP-linked market value, right? Now, if you look at that and you look at in parallel, what is the value of the entire real estate infrastructure and municipal services that are provided in the country? Where is the balance? So in theory, the value of REITs, InvITs, and muni bonds will far exceed what is today the value of goods and services produced by the corporate sector. Now, in this context, what is it that we as SEBI see as the building blocks? And that's why, again, I love this little slide, because every business, every ecosystem has building blocks, and it's the regulator's job to ensure that those building blocks are in place to facilitate that growth. So what is it that we have put in place? The most important thing we realized is that the strength of our equity markets comes from our retail investors, not just directly their participation in the stock market and holding shares of companies, but through mutual funds, through insurance, through the pension funds, and so on. Now, what this reflects is really fractional ownership of companies, right? That's what shareholding is. It is fractional ownership of companies. So in the similar manner, fractional ownership of real estate and fractional ownership of infrastructure is where the strength of the country will lie. So what have we done to facilitate this and to put the building blocks in place to facilitate that growth? The first thing is for us as a regulator to get comfort to go to retail investors, for us to go to our parents, to our in-laws, to our uncles, to our aunts, to our nieces and nephews to say, you know, this is a very good product, you should invest in it. We need to have that comfort. So the first thing that we have done is we have ensured that the governance elements of these asset classes and the disclosure elements of these asset classes are now something that gives us the comfort and gives us the confidence to go and tell our retail investors that we are comfortable with the way these things are structured. We are comfortable with the disclosure and the governance norms. You can now, without worrying, you can think about investing in these products. So that is one of the first things that we did over the last couple of years. The second thing that we have done is to bring down the minimum investment size, because naturally these products which were considered sort of high risk, and therefore the minimum entry price was kept high. We have steadily brought it down, and the intention, the commitment to the industry is down the line, we will bring it down even further. So making it very much affordable, as I often like to refer, this is the sachetization of financial products that we need to do. And with a very, very small amount, somebody should be able to go and own a fractional ownership of these assets. The third thing that we have done in this context is to facilitate innovation and to facilitate digitization of this whole ecosystem, using the now, I would say, concept of framework that we have in the country of saying that there is public infrastructure and private innovation. So in the markets, while the infrastructure is not strictly public, for instance, the exchanges form the basic infrastructure, the depositories form the basic infrastructure of our markets, they do perform the role of public infrastructure, even though they are in somewhat private hands in a diverse and diversified manner. So allowing for platforms like the online bond platform, for instance, allowing now you've recently seen the notification on small and medium REITs. The objective is that we should now facilitate many more smaller and smaller and smaller units of this ownership to be diversely held and democratically held across the country by our citizens. What is true for REITs is also true for InvITs. And we have a lot of belief in the way in which this infrastructure is going to grow in our country, because with every foreign investor that I meet, I find that the interest in our InvIT structures is growing by the day. There used to be trepidation that the way that the banking system, and we've all been bankers, Mr. Bhatia and I often laugh about it, we've burnt our hands ourselves in the infrastructure sector. We know the pitfalls of that, but the way that InvITs have been structured, the way that there are escrowed accounts, the way that there is a ring fencing against bankruptcy, all of those aspects have resulted in a high level of confidence that the investors now show in our InvIT assets. So there is a huge appetite for this. So for all the youngsters who are looking and wondering as to which area of the financial sector they should enter into, wondering where the high growth is going to come from, I can share with you that the level of investor interest, particularly from foreign investors in the InvIT space, is very, very significant. Bonds. This is another one of my favorite pictures, and I was advised in a forum where I recently used this thing कि हमारा एक उधर एक Indian hero भी होना चाहिए. मैंने कहा ठीक है, अगली बार अक्षय कुमार को वहां पे डाल देंगे. So, the time has come. We all know and we're all delighted that now Government of India bonds will be part of the global indices. And that automatically means that a lot of passive investment will come into the country. The reason we are delighted is that once a benchmark and a yield curve has been established for the sovereign debt, then there is a lot of confidence in terms of investing in the corporate debt as well. So we are expecting that on the back of the inclusion of sovereign debt in the global indices, there will be a significant interest in corporate debt. And so it won't be long before we have an Akshay Kumar standing over there. And certainly, I've asked one of my colleagues to say, yaar, kuch AI lagao, aur wahan pe Akshay Kumar ko bithao. Okay, so we are going to do that very soon. But I think the important thing is to take stock of where we are already. This is a very little known fact. But if you look at our bond market, even as it exists today, while the secondary market has relatively very low liquidity because most of the investors are buy and hold kind of investors, the primary market is actually very robust. So what's really happening, if you see here, this is a percentage which is reflecting that if the entire corporate sector in India is borrowing 100 rupees from the banking system, how much is it borrowing from the bonds through the markets, through the bond market? So as you can see, it reached a peak of about 68, almost 70%. And there was a reason for that. Chief Economic Advisor also mentioned about how certain credit deposit ratios in the economy were moving. But if you see, and our expectation is that this number around the 60% mark is actually a number that we can expect to be stable. So for every 100 rupees that the banking system gives to the corporate sector, the bond market gives 60 rupees. This is not small. Okay, and we've only just gotten started in terms of retailizing and facilitating a wider and easier spread of bond investments, particularly through the online bond platform, which our teams have facilitated. So we expect this growth really to be quite significant. And with the focus that we have on muni bonds, again, this is something that we hope across the country, we are seeing more and more traction. Mr. Bhatia is personally leading this charge in favor of, facilitating this. And we expect to see a lot of growth. So another area of high growth for the youngsters to focus on. In all of this growth, as has been discussed, the focus of today's conference is sustained capital formation. And we are very clear that we need that capital to come from everywhere. We need the domestic capital. So you have that 500 rupee note there very, very, very closely to be seen. But we need this capital coming from every part of the world because we are a capital deficient nation. for the aspiration of growth that we have, for the capacity of capital that we can actually absorb, we don't have a savings rate that will allow that to happen at this point in time. So we need the foreign capital, and SEBI is committed to making this happen because we see our fundamental role as facilitators of capital formation. And therefore, the objective to say that the ecosystem should be such, there should be trust, there should be faith in the ecosystem, and the mechanism should be flexible enough to accommodate the needs of every single investor who wants to come in to provide capital to fuel the growth in the country. And that is what we are all here to talk about. And I'm hoping that the next few days will give us, as was said earlier, some good insights into what we can do to make this the reality that we're all well on the path to. Thank you.
Thank you, ma'am, for such a thought-provoking message today. Now let us have the pleasure of listening to Shri Uday Kotak, who has graciously consented to be the keynote speaker today. Shri Kotak is the founder and director of Kotak Mahindra Bank. He has played an important role in defining and developing India's banking and financial sector over 3 decades. He is currently co-chairman of the Indo-UK Financial Partnership. He is on the International Advisory Board of the Government of Singapore Investment Corporation. He was the president of Confederation of Indian Industry from June 2020 until May 2021. In 2017, a committee on corporate governance constituted by SEBI under the leadership of Mr. Kotak recommended sweeping changes towards more robust and transparent corporate governance. May I invite Mr. Kotak to address the gathering?
SEBI Chairperson, Ms. Madhvi Puri-Buch, Mr. Bhatia, Director NISM, and of course, member SEBI, Mr. Anant Narayan, Mr. Vashne, Ashish Chauhan, many members from NISM, NSC, SEBI, and of course, the part of the practitioner fraternity, ladies and gentlemen. It's a very tough act to follow. After the amount of ground which has been covered by Madhvi Puri-Buch, Chief Economic Advisor, and Mr. Bhatia on the whole area of the sustained capital formation, I thought I will make my talk a little more personal in terms of the whole history of how I've seen the development of Indian capital markets and how I see the road ahead from here. It takes me back generations, if I can say, back to 1980. I was a student in Jamnalal Bajaj Institute, and there was a professor from Larsen and Toubro, since we are talking about infrastructure, a gentleman called Professor Shivanand Mankekar. And he taught me the basics of corporate finance, medium and long term, and the importance of IRRs, NPVs, discounted cash flows as the basis for taking corporate decisions as also investment decisions. I found after his lectures, he would normally go away and to the So, and I was quite intrigued. Here is a MBA. And not many people know that I actually bought a stock exchange card in my name in 1985 and went into the ring. In those days, the ring was a physical ring. And buy, sell, all those signals which I learned. And then in that big ring, there was one corner where there was a lot of crowd, but only one market maker, broker. So I asked, because I was learning, कि वो corner में क्या है? So somebody said, वो चोर गली है. So I said, what does that mean? पूरा ring तो बड़ा है, but ये corner चोर गली क्यों है? कि उधर illiquid stocks trade होते हैं और bid offer between 20 and 50%. And of course, the issues of illiquid stocks, lack of floating stocks, even in the technology world, remain. So I'm just trying to say that we may have been 45 years ago, but the issues which challenge markets in those days continue to be some of the issues which we deal with as we deal with the whole area of capital formation. So if I go back to the journey of Indian capital markets, I am actually amazed at the kind of progress we have made. What we are sitting here and seeing compared to those 80s is just mind-blowing. And I have to put it on record. I have to credit various governments across this period. I have to credit the formation of SEBI in 1992. From a point of time when people in the market practitioners used to say that SEBI has no teeth, to, I'm sure some of them may now be saying, is it too much? I'm not saying that. But that is the journey, friends, of last 40 to 45 years that we have seen the evolution of Indian capital markets. And I have no doubt and hesitation to say that the capital formation in India has a lot to do the development and regulation of capital markets by policymakers and regulators across generations of governments in the last 40 years. So a big round of kudos to the regulatory system and the policymakers. I saw the development of foreign investors in the 90s, till the 90s and even in 2000s. If you talk to most people, investing in markets was considered as a bad word. That's not a place to be. It was always considered to be negative. And if corporate India wanted to raise capital for growth, it was normally foreign portfolio investors in the 90s, and we saw it start with the GDR market. We were exporting our market. We saw the prominence of an unknown exchange in the world called the Luxembourg Stock Exchange become the place where most Indian GDRs were listed. And probably no other company in the world got listed on that exchange, or very few companies on the world got listed on the stock exchange. From there, the evolution of QIP market, the private placement market, development of the secondary markets, progress on. I have seen a revolution of scale and size, which should make every Indian proud. And the question then, friends, is what do we do from us to nurture this average Indian saver who has become an investor? And at the outset, I believe that if you look at the pure model, the investor sure challenges which it needs to meet in order to be able to sustain the investor issuer model. And it is subject to many, many vagaries and factors. And in this context, I want to talk about the largest and the most successful, and probably at this stage, the only icon which we can compare ourselves with is the United States of America, which has built deep capital markets and has created ability to manage large pools of capital. To an extent, the markets remain stable, even if a single stock moves in delta value of $250 billion in a day, more than the largest market cap company in the country, and everything works. However, when I go into that market and look at some of the developments, we should be concerned about the capital formation aspect of capital markets, the way the world financial markets are shaping at this stage. I think the starting point of the trouble really is the US dollar. It has just been enormously printed to support fiscal deficits. And as you go get larger and larger on that and print more and more of that, it gives a unencumbered right to one country to be able to do things which no other country in the world can do. So one area which I think for India's sustained future is, I think a time has come for us to foresee over the next 10 or 20 years for India's true growth and development, is how can India look at improving its position on the currency side to get a larger and larger positioning as a potential currency of trade on its own capacity. With it comes, how do we lay the path for convertibility of the rupee? What are the institutional mechanisms we need to build? Because if we want true capital formation of the scale and size of the largest market in the world or anywhere near, and we aspire by 2047 to be the top 2 economy in the world, we will have to take the battle on the reserve currency on. And friends, nothing is permanent. In the early 20th century, there used to be a saying that the sun never sets on the British Empire. In a lighter vein, nowadays, if I talk to some of my friends in London, they are waiting for the sun to rise. So things have changed, and therefore, any country which considers its reserve currency supremacy forever, like probably Britain did once upon a time, and maybe US considers itself very comfortable. That's the time for a nation to build. And I genuinely believe if there's one country in the world which has the ability to build trust on a global platform and with strong institutional mechanisms, it is not China. And India has a shot to be thinking about this as a next 10 to 15-year project of what we can do. Because once we do that, it gives us a significant amount of ability to do things and build India at speed and scale like the US does. The fact of the matter is 60% of the world's market capitalization is the United States of America. And for getting there, the reserve currency has undoubtedly played a major role. The second important aspect for India's future in the context of building long-term capital for India's phenomenal growth needs is the concerns of what's happening right now in the US and the development of an alternate market currency, which is the crypto. And I think Chairperson SEBI has mentioned about this for daily settlement, that the future competition for markets is coming from there. Frankly, I am at a loss how gold or a crypto really creates capital formation. But investors are looking for protection of their capital. And they put it into this as a counter hedge for governments worldwide who misbehave and are irresponsible on the fiscal or monetary side over long periods of time. Therefore, you just have to look last 1 year's performance on crypto. It's 3x. 23,000, I was just looking at, to more than 70,000. And what does it create? And I just saw the UK, Europe, and even the US are legitimizing crypto as a major part of the future. And effectively, savings of investors are going into that and taking away very, very critical pools of resources, which otherwise would go into capital formation. But investors are focused on protecting their value. Gold has kept its value over generations. And therefore, we have to be clear in terms of policy making and regulation. The saver and investor is not concerned about capital formation. The saver and investor is concerned about only his or her own capital and how that is protected from vagaries of inflation, poor economic policies, and protection for its future. And gold, even now, produces that 10% compounded return over a long period of time. Therefore, as we think about capital formation as a public goal, we have to be clear that there is a public policy requirement versus an investor who has a very different perspective, protection of his own long-term punji. That brings me to some of the issues that as we see the movement of the saver to the investor, it is the same person. Any of us, in a moment, take a decision, a bank deposit versus a debt mutual fund versus an equity share. So the individual changes in the mind from a saver to the investor. I'm asking the question that our system of regulation has compartmentalized the saver-borrower model primarily with one regulator and the investor-issuer model much more with the other regulator. So the saver is the same. The lens through which we are seeing the practitioners perform have different compartments. And what we have to be clear is that finally, it is the same person which we are serving through different ends. And for sustained growth, we need to keep that. And the third angle, and I'm glad the chief economic advisor was there, that in addition to the verticals on regulation, the third important player is the fiscal side. And as we build and nurture and build the guardrails of building a deep pool of capital markets which supports India's growth, as it has done for the last 40 to 50 years, into a new India with lower intermediation costs, there are some risks which we need to keep in mind. We have seen a phenomenal growth on the futures options, and I think a lot has been talked about that. And it reminds me of a famous, and this is not common, it's not about today, it's back in the 1940s, a statement of John Maynard Keynes, which went like this: speculators may do no harm as bubbles on a steady stream of enterprise. The position becomes serious when enterprise becomes a bubble in the whirlpool of speculation. Therefore, what we need to keep in mind is the speculation is a core part of markets. But how do we ensure that the enterprise itself then starts manipulating things to get the speculation get to higher price? And this statement of John Maynard Keynes in the 40s, and it comes on the back of the Great Depression with a crash in 1929, is something which we always need to keep in mind as we think about balancing speculation with creation of capital formation and enterprise. And we have examples of that. I think the biggest example in recent times has been 1980 to 89 Japan. And it's only 35 years later that Japan index Nikkei has barely crossed its 1989 peak. And that's something which we need to keep in mind. But I want to at the same time say that I believe at this stage, we are nowhere near that risk. And there are enough checks and balances in our system today to compare ourselves in serious bubble territory. There may be early froth, as if I can use the phrase from what you said a few days ago, but I would say that it is still froth, a little bubbly, but not out of control. That's my personal view. But as long as we keep a watch and manage it well, we can create a sustained capital formation going forward. I was very intrigued by also the numbers, I think, on the share of mutual funds and compared to bank deposits. 54 lakh crores, which is 26+% compared to bank deposits, which is 204 lakh crores. This number 10 years ago was 10% compared to bank deposits. So 10 has become 27. And if I'm predicting something, before that, in addition to 26% of mutual funds, if you take AIFs and PMS, it's now a number which is close to 30% of bank deposits. And if we can put good guardrails, I have no doubt that this number in the next 10 years from 30 combined could go to 50% of bank deposits. And we need to nurture and build this for providing capital for enterprise and growth. That brings me to a second point, friends, of sustained capital formation. Yes, of course, we need equity. But it is not a one-legged race. It's a two-legged race. And as has been mentioned, we need debt. And debt, of course, is coming from bank in the form of bank deposits, but also debt in the bond markets, in the REIT markets. And it is here that the tripod of the regulators plus the fiscal policy makers need to have a close working together. And to put it very bluntly, I think from the position of a saver or an investor, if I'm taxed at 10% on equities, which I think is a good thing, because I think you need to encourage equity culture before it is misunderstood. I do believe 40% marginal tax on debt certainly dissuades every saver from considering the debt options. And therefore, we need to look at the gap. And I'm not suggesting any particular direction, but 10 to 40 is a very large gap in terms of outcomes. And it is therefore quite surprising that today, an equity trader in the markets with 6:1 debt equity can borrow at lower rates than a AAA corporate. So we need to look at the entire plumbing of how our financial system currently is to lead to a situation where both the legs of the market, equity and debt, work in tandem for sustained growth over a long period of time. And there is certainly some work to be done on that. And therefore, at times, the fiscal side has some very different choices. What is right in public policy versus what is right for their short-term revenue. And at times, the decision can be swayed, just as the chief economic advisor highlighted about practitioners in the market. We need to ensure the policymakers also keep a long-term view in their decision-making, where public policy focus of what is right is taken as much importance as the short-term revenue implications of their decisions. And this is, again, a genuine belief that in the context of the equity culture, I do believe that there has to be some streamlining of taxation across different classes, including on double taxation on dividends. And we need to find a way of equalizing the highest marginal total tax on debt with the total tax on dividends, which is a corporate which pays 25%, plus the tax in hands of the receiver, which total should not be more than the highest marginal tax. The fact of the matter is, highest marginal tax on debt is 39%. Highest marginal tax on dividends is effectively 57%. So we need to, from a public policy point of view, look at a sustained, pure public policy angle to ensure that capital gets allocated not on the basis of arbitrage, but on the basis of what is fair level of returns for the capital. And undoubtedly, equity is higher risk therefore needs to be taxed de facto lower than other categories of capital, but not in a manner that it distorts the overall balance of financial markets. Just in that context, I wanted to also highlight often debate. The capital markets have been compared to what I call as the jungle. And it's the survival of the fittest. And then we have to make sure that the policy making modulates the jungle. But what do we want to achieve out of that policy making? Do we want it to be a perfect garden? Do we want it to be keeping the characteristics of a jungle with appropriate rules? How do we get this whole range of policy-making options between a free jungle to a perfect garden? And this is the debate which each of us has to ask, and where do we draw the line? If we make it a perfect garden, we will have a wonderful situation. What will it do to creativity and out of the box disruption and change in facts, which are as important for a future as it is to ensure that whatever flowers there are, they bloom well. And I frankly believe that the answer is not an easy answer, and it's an answer of balance and equilibrium. The jungle has beautiful elements. It enables lots of things to flourish, which would never flourish in a garden. But it comes with, at times, rules which may not be fair for all. And therefore, we need to move to a balance between just the survival of the fittest to not moving to a stage where enterprise starts getting affected because of the situation and the policies which we do. And I'm sure regulators, policymakers will be always trying to sustain and struggle through these important differences. And on my last point, as I think about this future, I have no doubt that when we look at India 2047, there is a very strong ability for India to become the top 2 nation. And it is for us here to put the building blocks. I appreciate the number of areas which I think SEBI has made progress, including the whole area of REITs, InvITs, building new platforms, creating opportunity for players with diverse approaches, and keeping in mind that we want a perfect garden in a wild jungle. With that, I'll say thank you very much, and I'm truly honored to be here on this occasion. Thank you.
Thank you, sir. Thank you so much for your words of wisdom. May I request Chairperson SEBI to please present a memento to our keynote speaker, Mr. Udekut. Now I invite Shri Tirthankar Patnaik, Chief Economist, NSE, to deliver the vote of thanks.
Ladies and gentlemen, I extend my deepest gratitude to our esteemed guests, Dr. V. Anant Nageshwaran, Ms. Madhvi Puri-Buch, Mr. Uday Kotak, for gracing this occasion and sharing their valuable thoughts and insights with us. The points you put forward have been truly informative and thought-provoking. I would also like to express my sincere thanks to NISM Director, Shri Ashwini Bhatia, and SEBI whole-time members for giving us the opportunity to host day 1 of the SEBI-NISM conference. I thank the organizing teams at SEBI and NISM for their meticulous planning, tireless efforts, and unwavering dedication in bringing this conference to fruition. I'm absolutely and extremely grateful for the cooperation we received from our colleagues at NSE in ensuring smooth logistics and technical support. The planning for this conference began much in advance, and we truly appreciate your support throughout this time. A special thanks to our MD and CEO, Shri Ashish Chauhan, for his support and guidance. Lastly, certainly not the least, my heartfelt thanks to every one of you, our participants and attendees here, for accepting our invitation to participate in this conference. It's our pleasure to host you as guests. I wrote some of the notes from each of the three speakers. We got a sense of the scale of capital formation in this country over the last few decades, the importance of growth for sustained capital formation, how we should be seeing beyond just short-term gratification, the true meaning of mindfulness and living in the present from Dr. Van. We also saw the relevance of monetization of real assets from Madam Chairperson with fractional ownership, a la financial assets. We also saw the importance of seeing the saver and investor as one person in the saver borrower and the investor issuer models. The saver and investor I wrote here is not worried about capital formation alone, but more importantly about his capital, its protection and growth, the importance of debt in the bigger scheme of things, including taxation, the importance of keeping the long term in mind again, and the balance between, sir, the garden and the jungle. Thank you. I will, as a mark of our gratitude at NSE, may I now invite our MD and CEO, Shri Ashish Chauhan, to felicitate everyone on the dais. Thank you, sir. Ladies and gentlemen, that brings us to the end of the inaugural session. We'll break for tea at this point. Thank you. Yeah, we are back in 10 minutes.
Yeah.
10 minutes. There's a quiz to start the panel discussion going. First panel discussion.
The quiz is specifically intended for the students, so I will encourage the students to participate more and more in the quiz. हाँ वो अंदर उसके हाँ पैनलिस्ट बोल हाँ पैनलिस्ट
Hello, our number. कौन है क्या लगा हाँ एक चेयर और होगी ना दो चेयर और चाहिए 5 पीस है देखो नहीं जी नहीं 5 है ना 5 चाहिए और देखो It's from here. Photos to my son is that after now and from more than come for the US visa thing. So we left him there. So we तो कोई भी नहीं रहेगा तो मेरे मॉम को मेरे अंदर से कुछ भेजे मैं मॉम साड़ी मैंने मॉम को फोटोज भेजे तो टाइम नहीं नाउ so when grandson is there, he has the time to see the photos. It's for you, for you. My mother तो कुछ शादी है उसकी कजन के बेटे की शादी के लिए यूएस her cousin sisters are very close to her. So they are insisting that she मई में है शादी अभी उसका यूएस वीजा का वो इंटरव्यू का सब डेट है नाउ इज काफी पहले हाँ मतलब मई का वीजा मिल गया हाँ मैंने अंदर रखा है हाँ हाँ मैंने देखा स्लाइडो तो कनेक्ट है मेरे को कनेक्टेड बता रहा है ठीक है स्कूल बुलाएंगे नहीं स्टार्टिंग में नहीं शाम बाद देखो the moment panel starts I'll open the quiz okay I want to announce the winner to come after the panel okay and finals so once the leaderboard declares I have to tell that person whoever is going to win to please come to the auditorium during the Q&A yeah during the Q&A for collecting the near the stage during the Q&A and full screen huh full अलग से भी है ये ना अलग से भी है
और एक बार वो ज्वाइन वाला स्लाइड भी कर दो तो एक बार वो घूमने वाला जो 2 सेकंड का गैप भी होता है ना
पर अभी फुल प्रेजेंटेशन अभी तो हम नहीं दिखाना चाहते हैं
हाँ एक बार
अच्छा एक बार देखिए ओके
एक बार करके नहीं ये ज्वाइन वाला क्यों नहीं है बैक 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 तो एक सेकंड
जॉइन वाला आ रहा था पहले
अभी क्यों नहीं आ रहा उनको बोलो मैं दूसरा करने के लिए बोलूँगा नहीं कुछ फ्रीज करने के लिए बोल दो ना
फ्रीज करने बोल दो कुछ और
फ्रीज करने के लिए बोल दो
कुछ और
एक सेकंड
Good morning and welcome back. We'll start the first panel discussion that will delve into critical insights and perspectives on next big ideas on capital formation. Our esteemed panelists for this session are Mr. Ashish Kumar Chauhan, MD and CEO, NSE, a technocrat from IIT Bombay and IIM Calcutta. Mr. Ashish Chauhan was part of the founding team at NSE. Prior to joining NSE back in 2022, he was the MD and CEO of Bombay Stock Exchange for 10 years. He is considered as the father of modern financial derivatives and is credited with setting up screen-based trading, satellite telecom, and many other modern developments in the Indian stock market. Our next panelist is Mr. Amitabh Chaudhary, MD and CEO of Axis Bank. Before joining the Axis Bank, Mr. Chaudhary had a long stint as the CEO of HDFC Life. Mr. Chaudhary is the chairperson of the FICCI National Committee on Banking since 2019. He has also served as the director on the board of several reputed organizations and has received numerous awards and recognitions. Our next panelist is Mr. Sunil Sanghai, founder and CEO of Nova Dhruva Capital. Mr. Sanghai has been a career investment banking professional since 1992. Prior to founding Nova Dhruva, he was at HSBC India as Vice Chairman, Investment Banking, and Head of Global Banking. He is also the member of SEBI Primary Market Advisory Committee. Our final panelist is Mr. Nilesh Shah, MD and CEO of Kotak Mahindra Asset Management. He has over 25 years of experience in capital markets, having managed funds across equity, fixed income, and real estate. He is also part-time member of the Economic Advisory Council to the Prime Minister and Unique Identification Authority of India. He is a member of the AMFI board and SEBI's Corporate Bond and Securitization Advisory Committee. The session will be moderated by Mr. Anant Narayan, whole-time member SEBI, who looks after Market Regulation Department, Alternative Investment Funds, and Foreign Portfolio Investors Department, Enforcement, Inquiries, and Adjudication Department, among many others. Prior to this current role at SEBI, Mr. Narayan has had extensive experience in academia, governance, and international banking. May I invite all panelists to come on stage for the panel discussion.
Good morning, everybody, and thank you very much to NISM, SEBI, and NSE for arranging for this excellent conference. And just a quick primer as to why we are doing what we are doing. A few months ago, the senior officials of SEBI, the members, the EDs, the chairperson, we were sitting and brainstorming on what could be the next big ideas for taking capital formation forward. We heard the chief economic advisor talk about the need for long-termism. We heard Mr. Uday Kotak speak about regulators needing to look beyond their noses. He said it in a much more polite way, though. You'll be happy to hear that we were actually thinking about this as to, for the next 5 years, 10 years, what could be the big ideas which could take us towards sustained capital formation, which is so crucial to ensure that we meet our immense economic potential. Now, when we were brainstorming on this, we said, rather than us breaking our heads, the best thing we could do is to actually get the thought leaders in the market ecosystem and do the hard work for us. So, which is precisely what we are doing over the next couple of days, starting with the first session, which I thought was excellent, and the series of panels which will continue from here. We've tried to get the best and the brightest thinkers who can, throw ideas and give us some insights as to what we should look at for the next few years to ensure that sustained capital formation ensues. We heard lovely insights from the chief economic advisor, the whole-time member, Mr. Bhatia, from our chairperson, Madhvi Puri Butch, and of course, Mr. Uday Kotak. I'm sure the panels which will ensue from here will add to that knowledge and to those insights. A few two bits from me before I throw the panel open. I was looking at some of the numbers which have gone into capital formation. Now, Mr. Uday Kotak made the point that you have a investor issuer model and you have a saver borrowing model, right? The two models which kind of, in a sense, are complementary to each other, in a sense, compete with each other. But these are the two basic models. I was looking at some of the numbers behind the issuer investor model. In terms of the inflows, we've really got a good thing going, right? So mutual funds, again, some of these numbers you know very well, but worth repeating. For instance, over the last 5 years, if you look at risk-seeking money coming into the mutual fund ecosystem, right, which is equity-oriented, balanced, advantage, equity, all of that put together, it's been about 10.2 lakh crores, which has come into the ecosystem. The corresponding numbers for the 5 years before that was about 5 lakh crores. So it's about doubled the money coming in, seeking risk actively, right? Likewise, there are other ways in which money has come in seeking risk. So somebody mentioned, I think Mr. Kotak mentioned alternate investment funds. About 3 lakh crores has come in over the last 5 years. The prior block of 5 years saw about 1 lakh crores coming in, right? Another big area of money coming in, not strictly comparable to mutual funds, is PMSs. And I'm here including EPF4 and the advisory part. So it looks like a big number, but because of these components being there, 16 lakh crores has come in through that route compared to 8 lakh crores in the prior 5-year block. Okay. So if you were to look at all of this, and by the way, investors, individual investors have also come directly into the markets. It's about 1.5 lakh crore, which has come in over the last 5 years compared to about 75-80,000 crores the previous 5 years. All in all, if I add all these flows, and I'm not including insurance flows, etc., which frankly, I should be adding to give it a full picture, about 16-17 lakh crores of inflows in the prior 5 years has been replaced by about 35 lakh crores in the next 5 years. So the last 5 years, we've pretty much doubled the amount of flows coming in from the investor side, seeking issuers, right? So that's a great story there. That's what financial inclusion is all about, sachetization, tokenization, the great mutual funds are here campaign, all of that have contributed towards that, which is great, financialization of savings and savers becoming investors. Where there seems to be a bit of a lacuna is on the issuer side. So we do have a good story in some pockets. For instance, the last 5 years, if I look at IPOs, FPOs, money coming in, capital being raised in the equity markets, it's about 11 lakh crores. The previous 5 years was about 7 lakh crores. So it's seen some increase. On bonds, however, it's not such a great story. Corporate bonds, and I'm ignoring CP, CDs, etc. for the time being. Corporate bonds has grown by about 15 lakh crores over the last 5 years, the stock of corporate bonds. That increased by 16 lakh crores the previous block of 5 years. So actually, we've seen a slowdown in absolute numbers in terms of the growth in outstanding corporate bonds. Put just these two together, and it's not a full story of the issuers. There are plenty of others. InvITs and REITs, which Pramod looks at, has seen about 1 lakh crore of issuance over the last 5 years. But ignoring all that, we have had about 23 lakh crores of issuers across equity and debt, grow to about 25 lakh crores of issuers across equity and debt. Now, you might think it's a debt problem. It's also an equity problem. I would argue that actually the issuance on the equity side has been a lot lower than the willingness to invest in equity, on which we are seeing a big fillip coming up right now. I thought it's interesting. By the way, eventually all markets and prices are a function of supply and demand. We can give a lot of stories about fundamentals and valuation, all of that, but eventually markets boil down to supply and demand. If you have so much of money coming in seeking risk and not enough of issuers taking out that supply, prices will go up. So, it boils down to that very simple equation. And for sustained capital formation, perhaps we need some more equilibrium to come through as far as this issuers matching with the supply coming through is concerned. There are good signs. I think there is a lot of talk about, the restart of the investment cycle from the private sector side. The big lifting was done by the government over the last 5 years. So maybe the private sector now takes over. But I just thought it's an interesting statistic and a set of numbers to look at when it comes to sustained capital formation. Okay, I'm going to speak less going forward. What I'm going to do is, using the excellent panel that I have here, go sequentially from here. The first question to each of the members putting your thinking hats on and looking 5 years, 10 years, rather than the immediate future, what do you think are the biggest 1 or 2 ideas on capital formation that you think the ecosystem should think about a little more? Okay. And this could be anything. It could be how do you increase the number of investors? How do you get in more people to become investors from savers? It could be the deployment areas, anything, whatever comes to your mind, 1 or 2 big ideas. And what do you think would be the next steps to making sure these ideas, actually see fruition? Ashish, let's start with you.
No, thanks, Anant. One of the interesting observation when I was sitting in the morning session and now after your talk also is that we seem to look at only the input part of the capital formation. That what comes inside from the savers will somehow create capital. For me, I have a fundamental sort of different opinion saying, look at the output. Because capital formation is an outcome, not what you put in, right? So having seen this for last 32 years, India's market capitalization in 1994, when NSE started, was around $250 billion, around 4 lakh crore rupees. Today, it is around 3.9 crore or 4 crore rupees, just for the sake of ease. I would say it has gone up by 95 to 100 times. We have put in very little because all the statistics tell you that most of the money goes in fixed deposits and everyone likes fixed deposits and stuff. How come fixed deposits are remaining the same? And the ratio of banking system size to the market cap or market cap to banking system size was probably 4:1, 5:1. Today, market cap of India is now almost 170% of the banking system size. What has happened? Outcome is phenomenally different from income. Why? I was trying to search the answer and I figured the answer in the earlier talk is the compounding has caught up. That other assets have not given the compounding. Fixed deposits, no compounding. One of the reasons is because taxation is higher, but otherwise also, there was another answer also saying that the intermediation part, what Uday said about 2 models, I call it intermediation and disintermediation. Intermediation is the banking part. It takes away too much money to manage that money. Whereas disintermediation, it's pretty much now close to zero, right? In terms of when you transact, how much you pay compared to what you actually trade, right? Including all taxes, STT and all. So basically for me, one is compounding has reached, the cost is lower. And that's why the outcome of the markets is much, much higher. So if we say we need people to put in more in equities market, why not? But even when they were not putting anything or very little compared to gold and real estate and everything, today with literally $4.8 trillion of market capitalization, the total wealth represented by trust markets, that is the equities market, is now almost 40% of India's total wealth. We were putting very little. It's like a boy who was supposed to do nothing. And there were brilliant people who were talking and talking, and we were putting money there. And this small little guy who was not supposed to do anything suddenly performed so well. So why I'm telling you this is, we need to worry about outcomes in addition to inputs. I'm not saying don't worry about inputs, but somehow every discussion is coming from that side saying, and somewhere look at the outcomes, right? Especially the market people need to also be a little proud of what markets have achieved, right? And I used to be banker, but only for 1 or 2 years. They are much longer. So that's one part. The second part is the future is not going to be the same as the past. And the need for debt may not be that much for many, many activities. Earlier, the wealth used to be created using a lot of capital. That's why a lot of borrowing used to happen. Now, the modern world is what I call capitalism with less capital or very little capital. And tremendous amount of wealth can be created. So these 2 ideas I just wanted to park. There are many more things, but these 2 ideas are fundamentally changing the world and our way of thinking, and we should kind of focus on those 2.
Thanks a lot, Ashish. I really appreciate. Amitabh, coming over to you. You probably have the best bird's eye view of the real economy as well. Look forward to it.
No, thanks a lot. Thanks a lot for giving me the opportunity. Just building up from what Ashish said, there are 3 or 4 ideas, and I think we had the opportunity to discuss them briefly in a call. Obviously, one of the ideas which Ashish referred to was the financialization of savings, and I think I heard my friend Nilesh Bhai express it much better. So I'll leave it to you to bring it out with the passion the way you expressed it. So I'll just leave it there. But I think there are 2, 3 other things. One is that I think the government of India and both the central and the state have over a period of time spent a lot of money on creating assets. And these assets are, the somehow monetizing all these assets is a very important idea on capital formation going forward in the future. We have seen some of it happen on roads. We have seen some of it happen in railways. But I think ultimately, I very strongly believe that the government needs to come out with clear policy, taxation benefits. How do we monetize all these assets which are lying all over the place? And these are ports, railways, obviously what we're seeing on highways, there are dams, there are all kinds of stuff. And they invariably, most of them are generating pretty stable revenues also. You're seeing spotty, one-off stuff which is happening. My view is that the size of this, what monetization can happen and what capital it can attract, and that's the second idea I want to talk about, can bring a huge amount of capital formation for the country. Frankly, when I go and meet some of the state governments, the answer I get is we don't even know what assets we have. We discover our assets when a case is filed. Then we go and dig our records, and by the way, we discover, oh, by the way, through some route, this asset, we have a say on this asset. So I think there is a long way to go. And by the way, it is not just about monetization. It has to be backed with proper policies. How will the monetization happen? Will a central authority do it? What are the tax policies? What will happen if tomorrow there is a dispute? The rules will not change, etc., because you will be selling these assets for a long, long period. And immediately following this idea would be that I think while we are trying very hard to attract sovereign wealth funds, and there are a huge amount of money with now sovereign wealth funds, do we need to create a sovereign wealth corridor or some way or mechanism whereby these funds are comfortable investing in some of these assets and creating platforms which can give them a steady return? Again, the point is that we do it one-off. We don't have clearly defined policies. We don't have a central set of people who are going and pushing this agenda in a particular way. And I think, again, there is a huge opportunity which is available to kind of connect the two. We have huge assets which can be monetized, and there are a huge number of funds, and I'm using sovereign wealth funds as only one example. There are a huge amount of credit funds which are available now globally. There are real estate funds which have raised a lot of money. Recently, Blackstone raised, close to $25 billion, one of the highest amounts of money they have raised. So a lot of capital available, but they want a platform to be able to invest in. Last, and I'll just stop here. I think India is late to the party as far as manufacturing is concerned. Government is obviously trying to do a lot in that area, but we're still quite far behind. I know we are going after some specific sectors, but the size of the companies we have in India, the scale we are thinking about, how we are going about attracting some of the potential companies who can come to India, I think the scale of what we are thinking has to change dramatically. I think India has demonstrated that when they start thinking big, they can really deliver. I think on the manufacturing side, our thought process has to, double or quadruple in terms of what we're thinking. Let me just stop here.
Thanks a lot, Amitabh. Good points. And by the way, on this point about asset monetization was the theme of Chairperson Madhvi Puri Bush's chat earlier today, where she talked specifically about InvITs, REITs, and munis as the neglected asset classes which have a lot of potential. So we'll talk a little more about that. Sunil, you see this world from a very, very vast vantage point. So again, the floor is yours on your ideas.
Yeah. First of all, thank you to NISM and SEBI and Mr. Anantanaran to inviting me. And more importantly, this is interesting to see that a regulator is talking about the path-breaking ideas for the future for the next 5 to 10 years, and they're willing to listen to the practitioner's point of view, which is really very heartening to note. So thank you for that. You said a couple of ideas. If I can borrow some time, and I want to talk about 3 of them, actually. I would say digitization, corporatization, and rationalization. Let me put this in the context. When we talk about digitization, there are number of assets. And since you talked about the supply side, because demand is already been talked about and taken care of, On the supply side, there are number of assets which can still come in the capital market, which can add to the capital formation. You talked, SEBI chairperson talked about REITs, and Mr. Rao is sitting here. He leads the REITs and InvITs department in SEBI. 2014, we came out with a guideline. And at that time, we were struggling who was going to do the first REITs. And today, the market cap of the REITs is more than 1 lakh crore in such a short time. And this is a product which can actually go on and pick up in a big way. Gold could be the other item. Some work has happened on the gold. There's a lot to be done. Again, Uday Bhai talked about, can gold be a productive? It can be made productive if it comes in the capital market. There are various studies, $1.4 trillion to $1.8 trillion of the gold is lying unproductive in a household, in our tijoris, which can come out. So the gold is another, the commodity. So a number of new classes of assets, including the bond and the municipal bond, which was talked about. I remember 1993, this was early part of my career, we were doing a bond transaction for a state government. And we were wondering whether the capital market will ever embrace state government 20 years bond. And actually it did in 1993. And before that in 91, 92, IDBI and CDB bonds were sold for 25 years. So the market always finds supply for anything which you come up with new and creative. So that's on the digitization. Corporatization, we should encourage in the next 5 to 10 years to create the transformation, more and more people to corporatize and come into the market. Couple of examples I'll give you. When Coal India listing was happening, I tell you, people were shivering whether the Coal India listing will ever happen. I used to do the meetings in a place called Raniganj in Bengal in the coal area, but it happened. LIC listing happened. Saudi Aramco got listed. It is almost like a kingdom. You look at Singapore, most of the Singapore enterprises through Temasek and all are listed. You lived in Singapore, you know that. So can we corporatize every part and then bring it in the capital formation and the supply? And the third and the final point is a little bit of rationalization. Let me put this again in the context. What I have in mind is a kind of green corridor. We come from the airport and we see there is a green channel and there is a red channel, right? Green channel does not mean that you cannot be caught. It means that there is a random checking. Income tax department implemented that. Custom has implemented that. SEBI also has implemented in some way rights issue or the follow-on, which Uday talked about and all. And the experience so far is not that bad. I mean, I totally understand in a class of 100, 10 kids may not do as well as the 90 will do, but we need to do a special additional tuition for those 10 kids. But that does not mean we, do not allow freedom to the 90. So is there any way we can create a green corridor which increases the efficiency and the mobility of the capital, because the speed matters in the capital market? So these are the 3 suggestions. Thank you.
Excellent, Sunil. Thank you so much for that. And by the way, on regulators listening, etc., what we realize is it's far easier to listen than to actually talk. So we thought we'll do the reverse. Nilesh Bhai, we're all yours.
Thank you, SEBI and NISM, for inviting me over here. If you look at India's savings rate at about 30% of GDP, it will be close to $1.2 trillion next year. That's almost equivalent to American household savings. So crores of Indians put together is saving as much as Bill Gates and Warren Buffett of the world are saving. So adequacy of saving is not an issue. But how do we convert that into long-term capital formation? The real need is for knowledge and wisdom. India's most educated state is Kerala. Till last year, their cumulative AUM in equity mutual fund was about 15,000 crore. And Kerala spends annually in lottery more than that. In lottery, if consumer starts making money, manufacturer will shut the shop. And yet, Kerala spends annually on lottery more than what they saved in equity mutual fund over decades till last year. Now markets have run up, so numbers has gone up a little bit. And many of you will feel कि हाँ ये तो Kerala का problem है. Let me point fingers at all of us. In last 3 years, financial flow of the household, as per RBI study shows, 9 lakh crore has been invested in currency notes, and only 4 lakh crore came into mutual funds. Currency note is a depreciating asset because of inflation. Mutual funds, yes, there will be some funds where your experience could be negative, but on an average, it has delivered better return than inflation. How do I convince all of us that you should not be holding ice in a hot summer afternoon and come into an AC cabin? Collectively as Indians, we have spent $373 billion in import of gold on official channel. We import on a net basis about 500, 600 tons of gold every year. This does not take into account gold smuggling. Assuming that gold smugglers are not charitable organization, they do smuggling for profit, then the run rate of smuggling based on last 3 years gold seized at airport will be about $7 billion a year. If you go to airport, and especially if you see flights coming from Middle East and Singapore, you see passengers who are clowns or clones of Bappi Lahiri wearing so much of gold jewelry. Collectively, as Indians, would we have spent $500 billion in import of gold through official and unofficial channel? And where is that savings going? It's going into Tichori. It's going into bank lockers. Our problem is, how do I go and convince Indians that please don't trade in cryptos? 18 crore Indians have traded in cryptos and majority of them would have lost money. How do I convince young people, please don't invest in NFTs? You don't know how to value it. How do I go and tell people that trading for an ordinary individual is injurious to his or her financial health? There is Ponzi scheme going on in India. A Punjab Agrotech Corporation Limited decades back raised probably 60,000 crore. So first, we need to educate investors so that they are knowledgeable, they have wisdom, that their savings needs to be invested appropriately. The second thing is about governance or guardrail. Not only regulatory guardrail, but also governance guardrail at the organization level. Unit Trust of India was India's probably first mutual fund in a hybrid format. For decades, they delivered great return to investors and converted savers to investors. But one error of giving giving redemption price more than net asset value put entire mutual fund industry behind. One Morgan Stanley mutual fund taking investors for a ride put mutual fund industry behind by decade. We need regulatory guardrails and governance guardrail at organization level so that savers' money is respected. We are in the business of managing trust, not in the business of managing money. If I can get all of your trust, I will also get your currency notes. I will also get your gold, and I will also get you for long term. The third and final thing, Anantbhai, is about products. Today, SEBI has introduced so many products, innovation in mutual fund. but it's a continuous journey. For example, today, so much money is lying in savings account, current account, and currency notes. Now, can I create a product which will convert part of this, not all of this, but part of this through check-in account, through digitized payment mechanism, whereby savers get more money and we can bring them into quote unquote safe zone into the mutual funds. Once they take those baby steps, I can push them into higher products. Sunil talked about gold monetization. How do we launch products which can monetize gold lying in the tijori? One product which we had thought about and it didn't get approvals. Using gold options, we were assuring investors that you'll have only upside participation, no downside participation. Now it's a seasonal product because sometimes option prices are cheap, sometimes not. Now, can we experiment on such kind of product and slowly and steadily create a differentiated risk return profile whereby different investors gets appropriate risk adjusted return? They develop trust into the financial market, and slowly and steadily we move this great ship moving into cash, into gold, into truly financialization of savings.
Excellent, Nilesh. Thank you so much. All of you actually. Yeah, they do deserve a round of applause. I think all the 4 panelists. Lots of threads to pick up questions on. Let me start with something which I think all of you touched upon in some ways. Ashish Bhai and Amitabh, you spoke about financialization of savings and outcomes as an important part. Sunil, you spoke about digitalization and things like InvITs, REITs, etc. And Nilesh Bhai, you spoke so eloquently about the need for education, the lottery statistics and all of those things. This is, after all, an NISM conference as well. And NISM is about education. And it's now, as Mr. Bhatia mentioned in the morning, it's about capacity formation, basically trying to create capacity and knowledge and information across the ecosystem. What do you think we are missing in terms of investor education and investor awareness? And what would be, and this is for all of you, anybody can jump in. What do you think we can do more? And more concretely, what can we do rather than just brewing about it?
Anand Bhai, with your permission, sure, can I give the answer in a lighter vein?
Please.
So if I have to give just one sentence for this entire problem, and it's a multifaceted problem, but I'm just trying to lighten things. There's a Hindi song which says that जोड़ी हमारी जमेगा कैसे जानी, तुम हो अंग्रेजी, हम है हिंदुस्तानी. Anand Bhai, we are communicating in English. And the problem is that my audience has multiple languages. We have not been able to communicate to the level which people can understand. We are using jargons. We are not using language which they want to hear. And this is multifaceted problem, but we are not able to connect with our consumers as much as we should. Mutual Fund Sahi Hai has been a good campaign. You are seeing that in 50 lakh SIP and 20,000 crore flows. But we need to probably make 5 crore SIPs and 2 lakh crore flows. So how do I connect with people? And then there are multiple other factors.
Thanks, Nilesh.
Sorry, just to build on what Nilesh said. I think when you're trying to educate people of something new, which they've not done in the past, all of us have to understand and appreciate that it's a long haul. One communication does not work. You have to keep communicating regularly. And all of us, I think, their own ways are trying. I mean, including the regulators, all of us are making an attempt to educate. And I think the result is reflected in numbers, not to the extent you would like, but I'm quite confident that there is always a tipping point which is reached. And then, I mean, tipping point was reached on crypto. Tipping point was reached on options and so on and so forth. So when people want to get it, they get it very quickly. Sometimes they get it the wrong way, but they do. Secondly, if you sit back and look at all the advertising which seems to be happening, and I have a very just small suggestion to make. Regulators have a lot of money, but the regulators' messages seem to be more on educating customers on what can go wrong. And so be careful. I'm not saying regulators are out there promoting products, but I think along with the industry, so you have one side regulators who are saying all the time, beware, be aware, beware. And obviously the industry is trying to promote, whatever products are involved in. I think there is a bit of a dissonance which happens as a result. I'm not blaming anyone. I'm just saying, so a consumer who's new is hearing someone they trust more saying, be aware and beware. And someone they believe is just trying to sell them something and make money off you is saying, no, it's a great thing. So that dissonance takes time to go away. And it will not happen overnight. Now, we can always say, oh, we need to come together and talk about like what mutual fund, the association did a great job. I think other associations have tried, maybe not that successfully. It is a long haul, my view. But please understand, for anything new, there is a dissonance also which is getting created. Rightly so, in many cases. But it is a dissonance nonetheless, and we should be aware of that.
Thanks.
So in some ways, we are guilty of that. I mean, none of our advertisements are about market sahi hai, right? Or because our direct investment sahi hai. And still, I mean, mutual fund is a part of our market, right? It's not a superset. We are like the superset. And why we do this is basically you can make people aware, you can educate, which we do. We have literally all sorts of lots and lots of training seminars. Even we insert stories in class 8, class 9, class 5 kind of chapters in their curriculum to ensure that people become responsible. Because one of the issues which we are not discussing, we think awareness and education will make people responsible investors. You basically need to make them aware of the pitfalls and overcome their greed. Whatever amount of education, will it overcome your greed? No, right? That is where basically you need to have the guardrails, what we call in corporates, is basically the greed. And that's where basically for me, as frontline regulators, because we are, although market players want to project us as regulators and regulators want to project us as market players, we are regulators, irrespective of whatever people tell me. And we would continue to create that dissonance to ensure that people don't run away. Many times people tell me that like Jan Dhan Yojana, you should have also savings Yojana. And I said, no. Why? Is because equities is a risky instrument. It has to come from within. While as financialization, transaction processing is a basic necessity of the person. But equity, if person wants to come in, either through mutual fund, through any other thing, that person has to have that willingness. And if the government forces it, later on when markets go down, who will be blamed, right? And that is where actually mutual fund association has so many mutual funds. They can always give one more advertisement. I have only myself who can be taken out whenever market falls. They will require somebody to, because whenever market goes up, everyone thinks it's their brilliance. When markets go down, everyone wants some head, right? To be blamed. So that will be me. That's why we continue to do that and we will continue to do that.
Sunil.
So let me represent the corporate, because corporate has not been talked about, and it's a great chance for having a regulator and the semi-regulator here, and a very frank discussion. See, one area where we can think of, since you ask for a constructive feedback, given the new thinking at SEBI now, just analyzing some data and see there is something which is missing. Why is it missing, and what one could do that? What, the conversation we were having before the panel in the lounge talked about manufacturing and the manufacturing sector. If you analyze all IPOs, you hardly find the IPOs from the manufacturing sector. Generally, object of the issue is either it will be sell down secondary sale or it will be repayment of the loan. Why? Because there is a regulatory issue there. If you say you take debt from Amitabh and say I repay to him, it's easy. okay? Because there is a certificate you need to repay, that's it. But if you say manufacturing, you have to give almost 3 to 4, 5 pages of the guideline, that much disclosure. So disclosure itself will be another prospectus. And you have to find every single detail, and subsequently you can't change. Now, manufacturing has its own challenges. You cannot give that much of detail, and it's very difficult. And therefore, people try and avoid that. And therefore, they are not able to come to the market and raise money for the purpose of the new capex and the manufacturing. So the point I was making is that's another way of communicating with the corporate to analyze what is happening and finding immediate solution so that that problem is taken care of.
No, thanks a lot. Again, all of you. Again, I think a round of applause for some very frank opinions being given. Let me try and quickly pick up on some of the things that were discussed. So Nilesh, I totally agree with you. While you said it on a light note, I think it's a very serious issue about how do you communicate and what do you communicate. We've got Prabhas Rath here, who looks at our research along with Mr. Pramod Rao here. One of the things that we are considering within SEBI is to actually do a survey across the country on the level of investor awareness. What are the mediums and channels through which they get their information? And therefore, what is the best way to reach out to them? You know, Anant Nageshwar talked about the behavioral aspect of investments. This is something that we are consciously trying to do, to actually do this scientifically, to figure out where are the gaps and how can those gaps be addressed? What is the best medium of doing so? It'll take time. It's not going to happen overnight, but I think it's worth the exercise of rather than assuming we know what the investor wants, going backwards. I love the conversation between Amitabh and Ashish on, you know, so here is a trade secret. As a regulator, when you're trying to navigate through, you know, two opposing viewpoints, somebody who says strongly heads and the other person says strongly tails, if we come out with something that has both of them equally upset, then you're probably doing something right, you know. So that's the balance that I think we try to look for. It was great to hear Amitabh say that we are being too cautious. It was great to hear Ashish, who, by the way, there is no doubt you are a frontline regulator. There is no doubt, and let me make that very, very clear. You're an excellent first-line regulator. Give those two different viewpoints about risk and return, etc. And it's a debate which should continue. I think the debate and the conversation should continue. Sunil, your points on manufacturing, I think, were excellent and well taken as well. Let's go to another theme now, which again, some of the previous panels discussed and previous speakers talked about. And I'm going to combine some 2-3 things here and open it up to all of you. One of the points which was made was CA Anant Nageshwar talked about F&O markets effectively being a sign of the fact that we become too short-term in our approach, that we are putting, you know, we've essentially made it a glorified lottery in some ways, and a casino in some ways. So that was a point that he made. I'm using my words, not his words, but that was the gist of his message. We talked about crypto, you know, and Chairperson spoke about it. Uday Bhai spoke about it. I think some of us also spoke about it. And again, it's a controversial topic about whether it's an opportunity, it's a threat. Where does it stand? And likewise, a couple of days back, the SEBI chairperson spoke about some parts of the market being possibly showing some signs of froth. So all these are, you know, areas which are potentially controversial areas. Something to do with valuation, something to do with behavioral aspects, something to do with are these real or not real, etc., etc. I would love to hear your candid views on how you look at any one of this or all of this put together. Why don't I start with you, Ashish Bhai, and I can count on you to be controversial. So go ahead.
No, in a way, for me, the difference between a crypto and an equity, they trade similarly, right? Although, and some of them call themselves exchange also. But in equity, there is a promise of profit, which you share, right? The dividend and things like that. In crypto, it's a promise to find the next pool, right? So that is basically the difference. Otherwise, they trade the same and they look the same, but there is no dividend ever promised nor can come, right? If somebody promises, then it should be treated as securities, and then where the promises, they don't require to issue prospectus as I think Nilesh Bhai was saying, because there is no promise, right? So that's why when they are traded, it's traded SAE, right? Apne aap. And so that's where basically for me the crypto part, and it is a threat, there is no doubt about it, but they trade 24/7 and 7 days a week. So if you want to actually compete with them by fractionalizing, digitizing, then we need to be aware that we cannot be trading for 6 hours, right? And only on few days, right? So be aware. And if you want to compete on all counts and not on few counts, right? So that's another part. The third part on futures options being large, and somewhere I think it's also a competition, although perceived competition for mutual funds, perceived competition even for banks. So mutual funds analysts are saying it is 400:1, but across the world, the premium is always lower than the actual position being underwritten. In insurance, if you pay 1,000 rupees a year, you get a 1 lakh rupee premium, policy, right? How it's not 100:1 and how it is not a speculation in life. Why I'm telling you this is, it is way to project. And in some ways it's a that way. At the same time, no country can survive on pure speculation and speculation alone, right? So we need to also create guardrails, which we have tried to create. We in terms of having minimum size of the contract, but the amount and financialization and sensitization has happened. I recall when NSE was created, and I used to be hugely interested in stock markets, even as a banker, and I used to go like Uday Bhai to BSE buildings in the evening, and sometimes we both of us used to meet also those days. And so the biggest time of India's speculative history was Harshad Mehta time. BSE used to trade less than 10,000 trades per day. Automation post NSE has now created a situation where we are now doing literally 25 crore trades a day. 10,000 trades. It is not that, it's like washing machines. When washing machines came, people thought ladies will spend less time washing clothes. Guess what happened? They started washing more clothes, right? So when automation happens, the behavior changes across the world in every area. Travel also increased because you brought in car, right? So that happened not because of derivatives, but derivatives came in 2000. But from 10,000 trades a day, and it used to take 30 days to just figure out the, not settlement, just to figure out whether we traded correctly or not. He had sold Reliance and I thought he had sold Tisco. And it used to take 30 days later on in the evenings to settle ki bas kya becha tha. From there, in 1 year's time, after NSE became live, November 3, 94, Diwali day, in 1 year's time, NSE was doing 1 lakh trades a day. Pure automation, right? So sometimes we give causal relationships. To some extent, it is true. To some extent, we need to understand that there is sensitization, there is automation. On top of that, it allows speculation, right? Leverage. And leverage, in some ways, should be allowed to people who can afford, people who shouldn't, basically who are not educated enough for that particular product. It's like giving knife to a child. Knife is a useful activity, right? Because you use it every day. But you give it to a child and then everyone in the house starts running saying, "Arey, nikalo, nikalo," right? Why we are not doing it for risky instruments? So we need basically guardrails for different types of risk, different types of people, different types of, and that's why now derivatives we use in day-to-day life. Insurance we use. Life insurance, health insurance, these are all derivatives, by the way. If somebody tells you no, it is wrong. Okay, they are derivatives, they're called real derivatives. But having said that, you don't trade them every day, right? Abhi 1 lakh, abhi 2 lakh, that doesn't happen, right? So that's why when you trade more, you need to create that framework. And that's why for me, person's income tax returns are available. If you want to check that, please make some entry barriers there. Please make entry barriers in terms of increasing the lot size. There are many ways where if you don't want a child to have a knife, you can do that. Today, I'm seeing so many photographs coming out of China where every Chinese household by law has to actually tie with a chain the household knife. Are you aware of it? Because the government is worried about revolution using knives. Okay, so that is another way to risk manage, but some of you might want to search, and otherwise I will tweet one of that. But basically, for me, if we have a worry about over speculation, we have of course increased STT. Today, STT in first 9 months, NSE collected STT, GST, and stamp duty put together around 29,000 crores, 27,000 crores in first 9 months of this current fiscal, right? So we have increased that. It has not yielded that kind of results. Now probably is the time to figure out what to do and not allow people who cannot afford that lotteryization. And by that logic, we should also stop lotteries and stuff like that, right? So at least say that only such and such person should do, or cricket thing, you know, cricket people play those games and all. For me, at the same time, this is a capital formation market. Whatever they need to do in lottery or cricket games, let them do. This place is sacrosanct. Stock markets cannot allow people to commit suicide even if they want to, right? That is why we must ensure that small people who are not able to take those risks should not come into this market.
Thanks, Ashish bhai.
Well, I'll make a simple point that, you know, when you look at individual investors out there, they're obviously moving from safe, maybe putting money in bank deposits, to looking for a much better return. Stock market is one of them. Then they move to speculation, and then at some stage becomes gambling. The worry is that a lot of people, when they move to speculation and gambling, are not going in thinking that they're gambling. They're thinking that they're smart. And because they've been hooked on or have been fooled by someone saying that, no, this is an easy way to make money, and the greed obviously kicks in. The point is that, by the way, in human history, all avenues have been available for speculation and gambling, and new avenues will keep coming up. Could be crypto, could be, we talked about the Punjab issue, could be what's happening in the F&O market, as you talked about, or it could be happening in some of the apps which are available where you could do things. And, you know, there are a lot of other apps where you could just go and bet and do whatever you want. So my view is that as on the regulatory system side, one is that obviously we need to control it much faster, because the fact that people are doing it and doing to the extent to which numbers are thrown, about 18 crore people doing crypto, the number of people who are involved in some of these apps, etc., is just humongous. That means people are looking for a return. Now we can say they're not educated enough on stock market, they're not putting enough money on deposits. Fault is ours, but somewhere they want a better return than maybe what is coming through it. That's one. Secondly, I think somewhere we are not doing a good enough job in communicating to them or with them on mediums where they collect this information. Now it is Facebook, it is YouTube, it is Instagram, I don't know. But I think as institutions, we are busy doing the typical stuff and the normal stuff. And I think we have to change ourselves and start communicating with them to reduce that gambling and speculation by actually communicating with them in that medium and making them realize that please do it, of course, if you want to, your money. But at the same time, there are these avenues available where you need to understand and appreciate and obviously back it with data. I don't think we do that. That's the only point I want to make. And I think we need to do much more of it. And you talked about a survey, great idea. I think hopefully it will show to you as to, you know, where exactly the communication needs to happen, which language it needs to happen, and how we need to engage with that audience, which is just going crazy right now and just looking for ways and means of making more money and maybe enjoying it also while doing it. God knows.
Thanks, Amitabh. That's brilliant.
Yeah. Very briefly, I think you need to put on one more hat other than the regulator is a medical hat. I think we need to consult a psychologist as to how the human behavior actually reacts. I think my sense is, rather than saying crypto is good, bad, try to communicate, because obviously the motives are different. If we can give them an alternative, go back to look at what happened when the Nirma was at peak. I did the IPO for Nirma, so I remember HUL never said Nirma was bad. HUL came up with a product called Literal, said, look, Literal is better. So if we come up with an alternative, what people are looking at is the kind of return which crypto is offering, which is, there is an underlying which is right now not visible. You know, gold, we talked about gold so much. In the morning also we talked about, if you can bring gold into the main field and offer that as an alternative, I think people will pick up. And that will take them away from what we want them to be aware rather than just through the communication.
So just to give you statistics before we go forward. Yesterday I was looking, because of this session, I was looking at the number of investors who traded in options in month of February 24, which is last month, right? Around 45%, totally 22 lakhs, that is total number of people trading in derivatives, around 46 lakh people last month, that is in February. Out of that, 45% people, that is 22 lakhs, trade less than 1 lakh rupees premium. Okay. So if you want to take them out, please do, because they accounted for 0.1% of the total turnover, because many people might feel that our business will go down. Only they accounted for total trading volume of 0.1%. Okay. And although people take notionals, it's basically the premium that counts. And so that is almost equivalent to equities market, not as much as what is being said. But by chance you want to remove, please do that. And people below 10 lakh rupees turnover in a month are additional 32%. So almost 77%, almost 37 lakhs you can take out by saying, by having some other things, and it won't even make difference to the total turnover. Of course, people may think otherwise, but why I'm telling you this is that somewhere that perception that has been created, including just to point out to him, Axis MFs, somebody who researches the equities market. For me, when you make that hype, saying that small investors are getting into this, like the entire moral of the story today is about that, right? But if they're taking only 0.1% and 1 lakh transaction premium is basically they keep on buying, selling. So, and their average holding period is around 25 minutes, right? They are not keeping actually the risk for very long, nor they take risk for the entire week. They seem to be taking risk for the last half an hour only. And last half an hour, all the options die to zero, right? So it's literally a 10 paisa, 20 paisa premium thing, which is being shown as 22,000 rupees or something. And that is where all this are coming from. But if there is a perception and if there is also reality, because sometimes perceptions are better than reality. So if you want to do something, please do that. Because it happened earlier in 2013-14. It happened in equities market where capital gain tax were zero. And it was coming as if the exchanges are allowing all the bad things of capital gains tax evasion. And literally, I campaigned personally, individually, and single-handedly. There is entire market, including policymakers, were not in favor. I was the only one for 6 years. I just continued that pressure that if you want to remove the bad thing, why are you giving tax benefits to zero? Start charging tax. And that's how the tax came. Why I'm telling you this is, if something is bad, pick the bubble now. Don't wait.
Sure, we'll do that. And we'll also have a separate session between Amita when you in a separate room. I think that's required. Dilesh bhai, the last word for you on this question.
So one, on cryptos, not many people are aware that people lose their entire value in crypto. There's a gentleman called Stephen Thomas who lost probably $500 million in cryptos because he can't remember the password of his key. About 30% of Bitcoins and other cryptos are today not accessible to their investor. At least stock market में आशीष भाई वैसा नहीं करते हैं हम. On the FNO, actually, mutual fund industry is thankful to FNO industry. People lose money there and they become investor in mutual fund. On the frothiness in small cap and mid cap and micro cap and mini cap, I'll just point one example. There is a public sector bank, which is a very good bank, but trades at double the valuation of most private sector bank. There's not much to differentiate in terms of fundamental between them, except that in that bank, 96.4% is owned by the government of India, and President of India doesn't trade in market. Of the 3.6% left, something is owned by a giant insurance company which doesn't sell that stock normally. Effectively, floating stock is so limited that some people who are holding it, and if they don't participate in market, little bit of buying can pull the prices higher. And that momentum then brings more money. And then there is a sympathy wave for other PSU bank, which also starts running, saying that, oh, if that bank can trade at this valuation, this bank also is a very, very cheap. And this is how we create a sentiment and momentum and flow, which is creating some amount of froth. It is not only bad for investors, it is bad for that bank itself. Banks will always require capital. Will they be able to raise capital at 4x price to book? I doubt. They won't find sufficient capital at that valuation. It will hurt their own growth plan. So we need to, as Ashish Bhai mentioned, prick the bubble early rather than late, so that this market maintains its trust.
So if I can put all four of you on the spot with a yes or no answer on two questions, and we'll go the reverse way. Should SEBI do more in terms of putting guardrails around the mid cap, small cap, micro cap market moves? Yes or no?
Undoubtedly, yes.
Okay. Sunil?
My sense, I think SEBI should increase the supply, encourage more supply, and automatically, because of the supply, the point which Nilesh mentioned, that in terms of the float, if we increase the float so that the price will correct itself.
So I take it as a qualified no, increase supply rather than doing something on
be
the
more
demand side.
constructive rather than putting more restrictions.
Okay, fine. Amitabh?
So we should do it when it's an unequivocal yes. And that's, I think, one of the important elements of what any regulator should be looking at.
Yeah, for me, again, I would give you a framework rather than only specific for SME, that if derivatives are very risky, I know I'm coming to that. If derivatives are very risky, keep very high lot size and high net worth ability to handle the risk as high. Then if SMEs are more riskier than equities, then keep high lot size, not extremely high, but high lot size. So I'm giving you a framework. Similarly, equities, which are not that risky, and then bonds, some of them would be risky, some of them would not be. REITs. And so for me, you need to create a regulatory framework, which is basically that guardrail based, but not everyone can come and do everything. It is like you are allowing an untrained driver to drive without license. So accident hone hi wala hai. So for me, and then you can blame the driver, you can blame the regulator, whatever, right? So for me, the answer is slightly more nuanced than yes, no.
So a nuanced yes?
But being a regulator all my life, if I don't do regulatory activity, I mean, I am not, in a way, for me, free market in road will create traffic jams, okay, anarchy. So that's why I always want to be regulator, at least job is safe, although you may not make money.
So I take it as a nuanced yes or no from Ashish Bhai on both FNO as well as on mid cap, small cap, etc. On the FNO part, what would you suggest, Nilesh Bhai? Yes, no? Should SEBI do something more?
So one, as Ashish Bhai mentioned, can we look at more informed participation? Today, mutual funds are one-way entry into options and restricted entry into other side. Today, a lot of heroes say zero kind of trading happens. Can we raise the bar so that informed participation happens in FNO?
Thanks, Nilesh Bhai.
I sat through a similar conversation when Badla was to be changed, right? And at that time, there was the same fear that people will burn their finger, they would not understand, this is FNO and all of that, and the market will crash, and nothing happened. The market has grown to a completely different level. I think it's a matter of communication rather than putting any restrictions.
So again, a nuanced no.
My view is that, two regulators are sitting here, that when you come out with any, cap or anything of that nature, it will be, obviously putting some kind of framework. It will not be just, slashing it. So that's understood when one says yes. So I agree. I think as you see more speculation emerge or gambling emerge, whatever you call it, whatever name you give it, obviously, I think as regulators, they need to see that the wrong individuals don't get burned or wrong individuals don't participate and take the market to a point where what not the original intention was. So that's what I would fully support. Yeah.
Thanks. Very useful. I know we're running out of time, but one last question, which I'm probably going to regret, but I'll ask you all anyway. What would be your ask from the regulator? And Ashish bhai, for you, it is as a first line regulator, what is your ask from your regulator? So if you can just go quickly.
No, I mean, whatever they are doing is fine. So basically, continue to do good
I
job.
didn't ask him to say that.
Yeah.
Ashish is saying he's doing a great job. I completely agree. No, my only view is that, it is an evolving market and the regulator has to just keep reminding themselves, and I don't mean SEBI alone, I mean all regulators, that if they put too many rules, and I'm not saying the rules are wrong, the outside ecosystem should not become bigger than what is inside the ecosystem. And that balance has to be always sought for. I think there will be people who will always try to create things outside the ecosystem, but the rules also should not be so tight that just to enter the room it is so difficult that you start playing outside, violating the spirit of what was created and so on and so forth. So I think that balance is very, very important, and that's something should be thought about all the time. It's not some one framework. I think markets will evolve, speculators will come with their own.
Push you a bit on that, Amitabh. If there was one or two areas where you thought the regulatory system was being too onerous or too restrictive, what would that be?
No, my view is that, for example, we allow, because I guess a lot of regulators involved, my worry is slightly different, that we allow these people to exist outside the ecosystem for too long. And we sometimes take so much time to decide and get it right, and sometimes difficult to get it right, that by the time we get to them, that market is evolved into something much bigger on its own anyway. And then there are too many players who are trying to then prevent you from doing what the right thing. So I think sometimes faster, bigger cracking of the whip is more important than just waiting to get it right all the time. And I see that in not only here, I see that in some of the other regulatory regimes also. The gap between, it is wrong, something wrong is happening, and how much time you took to get to them, I think that time gap is just too long, and that ecosystem becomes too large in the process.
I just second that. And that also gives you one more point of thought is, earlier in early 2000, we exported under the same context our markets to Singapore on derivatives. Nifty started trading more there, and it took us literally 22 years to bring back to GIFT City. We are currently in the process of shifting out our markets in the interest rates, bond indexes. They will start trading futures abroad, and then we will say whatever happens abroad is fine, but they are going to affect your operations here also, because interest rates on India has decided outside. And so that portion you will have to basically again sort of keep in mind.
Thanks. Sunil?
One point I just want to go back to your opening comment that we look at from 5 to 10 years perspective. If that's one area, I would say inter-regulatory area is something which you can focus on. There are a number of things where the multiple regulators are involved. Things have evolved. I think the regulators have matured. One regulator can take care of that. Okay, we are all sitting in the hub of the capital market. Lakshmi Chanchal hai. They keeps moving. We need speed. I give you one example. There are many examples like that. So for M&A, we need to first come to Ashish, then we come to you, then we go to NCLT. By then the synergies are lost. 2 years have passed and the synergy is lost. So, and same thing can be done with one regulator, because now the regulator has become much more mature. There are many such examples.
Thanks a lot, Sunil. Really appreciate it.
So, Anant, one recommendation request is, can we encourage product innovation? For example, in India, we invented Coca company, where an unlisted company can merge into a Coca company and become listed. We banned it, but it became special purpose acquisition vehicle, SPAC, and suddenly that's a global concept. There are many things where our markets are ahead in terms of thought process and structuring and creation. Can we make it a global scale? For example, in crypto, why should I be a Bitcoin buyer? I should have my Bitcoin where global investors are buyers, and we have so much of retail volume, will create volume. We just need innovation to bring crypto into India rather than exporting out of India.
Excellent. You're picking up the phone.
Yeah, हमारे लोगों ने ट्राई किया था वो करने का, उस 2-3 लोग जेल में भी चले गए, तो कोशिश मत करना बॉस इंडिया में.
Ashish bhai, we need to build regulation. Today, how much money has been exported out of India on gold? How much money has been exported out of Bitcoin?
No, I'm
Now,
just saying
can I not-
regulations are against that. So
No. So we are talking with regulator to create regulations which will allow me to attract global savings to India rather than exporter of savings.
On a lighter note, now you get a glimpse of what we as regulators go through with diverse viewpoints. So, but this was very, very enriching. And once again, I think a round of applause to everybody. We started off with, big ideas for capital formation. I suspect thanks to a very poor moderation, we deviated from there into many other areas. But this was really enriching. And I knew I'm going to regret the question on what do you want from the regulator, but that's okay. I asked for it. So on behalf of SEBI, on behalf of NISM, I will not summarize. I think it's been very, very enriching. Lots of good ideas, including on financialization of savings, on asset monetization, manufacturing the trust, Sunil's point on digitization, corporatization, rationalization, Nilesh Bhai, inimitable in his usual statistics on, the need to focus on, on value creation and the behavioral aspect of investments. I think it was great. Some of the controversial topics, it was great to hear all the diverse views coming through. One request to all of you and to all the audience, we try to listen to everybody as SEBI. We've got Amarjeet, my fellow WTM as well, Pramod, Prabhas, everybody here. Do feed in your views. And I can assure you that every view that you put in on a consultation paper or when you write to us, we go through it. We might not always act upon them, but we need this information. We need these inputs to be able to make a conscious data-based call, right? So please keep the feedback coming. And this was very, very enriching. So once again, Ashish, Amitabh, Sunil, and Nilesh Bhai, this was fantastic. Thank you so much for your insights and for sparing the time on a working day. Really appreciate it.
So may I request Mr. Anant Narayan to felicitate all the panelists? Hmm? May I request Mr. Pramod Rao to felicitate our moderator, Mr. Narayan? We also have a small token from NSE. Ashish sir will felicitate all the panelists.
We will now begin the next panel discussion. The next panel discussion is on the topic Sustainable Finance, Innovation and Product Development. It's through innovative solutions and strategic product development, sustainable finance will help bridge the gap between financial prosperity and environmental stewardship, fostering a more resilient and equitable global economy. To delve deeper into this topic, we have a high-profile panel with vast experience in this area. Our first panelist is Mr. Manish Chaurasia, COO, Corporate and Cleantech Finance, Tata Capital. He is a financial services professional with over 25 years of experience in origination, credit risk assessment, risk management, syndication, and business transformation in the Asia-Pacific region. Our next panelist is Mr. Ritesh Tiwari, Executive Director and Chief Financial Officer, HUL and Unilever South Asia. He has a rich experience in leading diverse teams across the UK, India, and other Asian markets. Our third panelist is Mr. Sunil T.S. Nair, Chief General Manager, Department of Regulations, RBI. Mr. Nair is a career central banker with wide experience in policy and regulations and more than 3 decades of distinguished service in the Reserve Bank of India. Our fourth panelist is Ms. Aditi Haldar, Director, Global Reporting Initiative. Ms. Aditi is a sustainable development advocate for more than 27 years. Her primary role at GRI is to create and nurture a network of policymakers, investors, businesses, academia, civil societies, and will enable sustainable development. This session will be moderated by Mr. Amarjeet Singh, whole-time member SEBI. With a career spanning nearly 3 decades with SEBI, Mr. Singh has extensive experience in the development and regulation of Indian securities market. May I request all panelists to be on the stage. Thank you so much. Yes.
So good afternoon, everyone. I hope you still have some appetite for another round of discussion on sustainability. I will not hold you long. I know this is a pre-lunch session. So Sunil is joined. Okay. Yeah. So, let me give a little perspective before we get into a discussion with our eminent panelists. A couple of quick thoughts on the landscape relating to sustainability. And these are random thoughts just to set the context. One, see, this is sustainability and acceleration of AI. These are two mega trends today. And I would like to underline the word acceleration. But anyway, we are not discussing AI. We are more on sustainability issues today. That is one. Two is, it is a mega trend and thereby it is also a long-term trend. It's a multi-year movement. It is a multi-decade movement. And what we are seeing is, again, an acceleration of debate around various contentious issues on sustainability. If I can go back maybe to more near past, let's say past 5 years, and just give you the broader trends that have emerged in the last 5 years. And it's a very interesting period since COVID. So during COVID times, we saw a renewed focus on sustainability issues, which is evidenced by number of new funds being launched for ESG investings, or the existing ESG funds getting more investments. Then we also saw a
26, where, in 2021, where number of countries, including India, made their net zero pledges. But come 2022, we saw a bit of reversal, if I can say, due to the Ukraine war and all sorts of issues relating to energy security got more focus. And we also saw, if I can say, a bit of slowdown on ESG investing, and also some of the important financial groups either, withdrawing or reducing their support to Net Zero Alliance, which was formed earlier. So, but nonetheless, the fact is that it is an issue, and sustainability has a lot of implications for investors. And let me also mention that there are two major forces, to my mind, which drive the sustainability movement. One is the forces driven by investors, and I think they've been ahead of regulators. It is more of an investor push, which led to a lot of companies disclosing on sustainability without there being a regulatory requirement earlier on. But regulators have also jumped into it globally, and they are increasing their engagement on three sets of issues: disclosures, rating, and sustainable finance. And the reason is obvious, because we want investors to be, fully aware of what are the sustainability related risks and opportunities when they are investing in the corporate sector. So with this little background, let me, turn to my panelists. And what I have in mind is a little ambitious, subject to, all of us playing it well. I would like to do 3 rounds of questions, and I've tried to put them together in a particular theme. The first round would be general high level according to your expertise, and then we'll move on to the second and third round. And also we'll do a rapid fire round in the end, where that would be optional. You may or may not answer those questions. And we'll also see if we can take some questions from the audience. But it all looks quite ambitious at this stage. Let's see how we progress. So let me begin with Sunil Nair, who could not join us in person. Sunil, hope you are keeping well. And the first question comes to you.
Good afternoon, sir, and good afternoon, my co-panelists.
So I wanted to begin at a little macro level, Sunil. That is why this question comes to you. So globally, the role of banks and financial institutions is perceived as critical in transition to net zero. So what is your take on the influence of the financial sector, particularly banks, in achieving real world outcomes? How do you see the whole journey towards greening the financial system as it is playing out in India, in terms of how far we have come and how do you see the road ahead? It's a broad macro question for you, Sunil. Over to you.
Good afternoon, sir, once again, and good afternoon to all my co-panel, and good afternoon to the audience. Thanks, SEBI-NISM for inviting me to this panel discussion. I'm not keeping well, so my voice may break in between, but I'll try my level best to kind of communicate. So coming, sir, to the specific question which you asked, I think, it's a fact that globally, I think the move is in that direction of greening the financial system. And India being a country where banks and FIs play a major role, inevitably they have a crucial role as far as greening a financial system is concerned. Now, but before we get into that, or before we talk into that aspect, I think there are basic certain pillars or climate information architecture, which you can call broadly, which IMF keeps on talking about, which is required. There is number one, it is a need for a taxonomy. Number two, you need to have data. And number three, you need to have disclosures. So this entire system, about when we talk about greening the financial system, I need to be very clear about what is green and what is brown, because then only I can push the banks and FIs to move in that direction. Otherwise, you are ending up into greenwashing kind of a scenario. So taxonomy is very, very crucial. And as you are already aware, in India, you don't have a taxonomy, but in the sovereign green bond framework, which government of India came out a couple of years back, they have listed out certain sectors which you can say crudely is akin to a taxonomy. And that we have used when we came out of the green deposit framework. So there is a taxonomy, but there is not a taxonomy. So that is a need of the second. Any endeavor or any role which your bank or FI needs to undertake as far as greening is concerned, data is very important. Why data is important? There are two parts to it. One is for a bank or an FI to understand as to what kind of risk, supposing we have a taxonomy in place, and today at this point of time, the bank or FI wants to decide that what is the risk sitting on its balance sheet. It needs to know what is, it knows green and brown, it needs to have data so that it can get a sense of, again, two kind of risk, physical and transition risk, to measure the impact arising on those kind of risk on its balance sheet. It can have a sense of that. So that again is very, very important data. And third is disclosure. Disclosure is required because investors who want to invest or you want to pump in money in these kind of exposures, they would like to have clarity as to what is the entity's book looking like. So these three things are very, very important. Having said so, I think India, the journey has already begun. As you're already aware, renewable energy, a lot of funding is happening in by banks and FIs. Even EVs, you are seeing that thing is progressing well, but still lot more needs to be done. One is government support, second is the market potential, and third is the regulatory nudge. I think these three things, if put together, it will nudge or it will help the banks or to become bigger players in financing the greener kind of ecosystem. And as regards the progress so far, I would say the journey has begun and we are still a lot distance to cover. And lastly, I think it's high time we have a transition pathway or a sectoral pathway for each of the sectors. If we have identified that these are the sectors which we are going to target, if we have that, the banks and FIs or the rules and regulations or the regulations by the RBI, SEBI, or anybody, they can frame the rules or regulations around it. I'll stop there.
Just a quick follow-up, Sunil, that was helpful. Can you tell us very briefly, how are the banks playing this role as of date, just for the benefit of audience?
Banks, I think,
more specifically, what are they doing exactly? Yeah.
Banks are specifically, I think, in renewable energy, banks are doing, and EV financing is happening. These two things are happening, not in a very big way, but definitely it's happening now. But the people always keep on coming back saying that there is a regulatory nudge required, there's some kind of a PSL requirement or some kind of capital benefit, because see, any lending or investment has an bearing on the capital. So the market thinks that if you want to push a particular sector, if you want to to give an example, like when government came out with a FAME subsidy, it was to kind of give the nudge there. So there's market players expect that similar kind of leeway could be given or some kind of concession could be given whereby the money would flow more to that sector.
Okay. So let me turn to Manish, who's the CEO of Tata Capital Limited. So I believe your company has recently done a sustainability links bond issuance, and which according to reports is the first such instrument by a private financial institutions. A number of other innovative financial products and instruments are also emerging globally, as we know, in various shapes and forms, like social bonds, sustainability improvement loans, etc. So there's a great variety out there, at least on paper. So which of these instruments do you think are most relevant in our context, in the Indian context, towards achieving our sustainable finance goals? And how can these be structured to make them attractive to investors?
Very good afternoon to the esteemed audience. And thanks, SEBI-NISM, for inviting me. So we did come out with a sustainability-linked bond last year. We were the issuer, and investor was IFC, $50 million. And the key feature of this bond was that we had a baseline, reduction in carbon emissions because we are a clean tech company. The business itself is on clean tech, which leads to abatement of carbon emissions. So there was a baseline of that. And then we had agreed that every year we'll increase that abatement. And if we are able to achieve it, then we get a better pricing. So we get some reduction in the interest we have to pay. So that is what is the sustainability-linked bond. In my view, instrument like this, which incentivize the issuers to reduce their cost of funds by achieving certain targets, is an excellent instrument. Earlier, we have seen instruments like green bonds, blue bonds, but then quite a few times, because of the lack of proper taxonomy, sometimes these are just terms, and they are used very loosely. So to the extent that here the interest rate itself is tied up with achieving certain targets, and that itself is monitored by a third-party institute, I think this is a great product. Now coming to what are the kind of instruments which can really incentivize investments into sustainability. This is a great instrument. But before we go into the instrument, I think important thing to remember is that whatever is done needs to be highly transparent, and there needs to be very good disclosures. So then again, we come back to taxonomy. Today, what happens is that these terms, as I told, are used loosely. So if you talk about green, then, it can be mitigation, it can be adaptation product, it can be a circular economy product. But sometimes the product does help in one aspect of the clean tech, but can harm the other aspect of the clean tech. For example, if there is a solar power project, it'll lead to abatement of carbon emissions. But if the groundwater is used to clean the panels, then it can lead to harm as well. So I think there is a need for a proper taxonomy, which clearly specifies what is green. And also it specifies, how it is done. Just because project is green, but suppose the land is not acquired properly, or if it is harming the environment in some other way, then it cannot be green. So there has to be baseline in terms of governance and social. So I think that is fundamental if we want this sector to really scale up. So that is point number one. Point number two is that any financial instrument needs to have a proper risk-adjusted return for the issuer, for the investor to be happy with it. So when we are talking about risk-adjusted return, first thing we need to do is see how to reduce the risk. Now here again, everything is not alike. There are segments in clean tech sector, in sustainability sector, which are mainstreamed. They don't need any reduction in risk because market understands those risks. At the same time, there are sectors, I would say sectors like say green hydrogen or say electric buses, where the risk is there. So first of all, we need models where this risk is reduced by proper project execution models. And then we need some kind of a first loss guarantor as against partial loss guarantor. So if we have some multilateral who can reduce the risk by giving, say, first loss guarantee of 10%, 5%, whatever the market wants, I think it can lead to a risk reduction, which will mean that there will be more issuances. And of course, risk reduction does not happen in isolation. For the issuer, it is also important that he gets lowest cost of funds. And naturally, here we are talking about a business case. For instruments which are not mainstreamed in the clean tech sector, I think there's a need for some kind of a tax benefit, which has a sunset. It cannot be there forever. So this is in terms of risk-adjusted return. And third, I guess, these instruments will be successful only if there's a clear measurable targets. So they have to be structured in a way that investor knows what he's going to achieve by this. So I guess as far as these three things are satisfied in any instruments, it can be a great instrument. We can give it any name. Name is just a nomenclature. Yeah. That's what I would like to say.
Sorry, I have to take it back from you. I think that's very insightful, and maybe I'll come back to you later in the discussion with some follow-ups on that. We are also, we have a green bond framework, but for some reasons it's not taken off the way we would like it to. But anyway, we'll discuss that later. Aditi, if I can turn to you now. So with over 25 years of your experience in the field, you've seen it all, right? You've seen the transition from mandatory regimes to voluntary regimes. So, so the specific question I had was, what is your take on sustainability getting mainstreamed in our country? Is there evidence to suggest that sustainability disclosures can actually change company behavior and affect societal outcomes? And also, I'm tempted to ask you, you've seen it before ISSB framework, there were numerous disclosure templates. There still are actually, and each with good intentions. So how do you see the difference between what a framework seeks to achieve and what exactly it delivers on the ground? So is there a gap? So I know I'm asking a lot of questions, but over to you. Can somebody help us with the mics, I think?
Hello?
Yeah, that's good. Yeah.
Yeah. So good afternoon, everyone, and thanks to SEBI and NISM for this great conference. I was not aware that this is the fifth one, actually. So it's very nice to actually be here. But coming back to your question, and so the first thing I would like to say that, yes, 25 years, not a small time. I think it's a remarkable journey. And we have moved from, we meaning India and the region I see, the subcontinent, we've moved from voluntary to becoming more towards regulatory. We started with all kinds of, community initiatives and CSR, and still we have the law for giving that 2%. But then the question is 98% remains, right? And how do you generate the 98%? So when the 2%, tax in the form of kind of giving back to the society came from GRI, the question was, how does this 98% get generated? So that's the main thing for sustainability disclosure to our mind. I see in India this voluntary, initiatives moving on to becoming more compliance-based regulatory. It provides a very good understanding and a great indicator that it is becoming urgent. It is not that, few elite companies would do something. Some would choose to do, some would choose not to do. So that is where I come from. And the other thing I wanted to mention here is that when the regulatory and the compliance mechanism sets in, there is also a tendency, we need to all be aware, that box ticking is also becoming very rampant. So we have to understand, how do we manage and balance and maybe make sure that the box ticking leads to a path and a journey whereby real sustainability actions take place, and therefore the impact on the market and the society is evident. You wanted to also know whether there are really some, results which has happened. Yes, is the answer. And I think there are many. For example, cost savings, even in small and medium enterprises. The first low-hanging fruit of sustainability initiative is their resource efficiency, which happens. Energy conservation or waste reduction. So they are all great examples of how sustainability can help. There are also about, market differentiation, which happens maybe in terms of loan or maybe attracting customers and international investors, so on and so forth. There is a great example, and not one single, but many. It's in terms of risk mitigation. It could be supply chain management risk. It could be operational risk. It could be efficiency risk. So all sorts of risks which were not being measured and being connected to where the resources come from and how resources can be innovated to replace with something which is treated to be a waste. I think these are great examples of how sustainability has been integrated. The second question here, which you mentioned about, different reporting frameworks coming, I think that's also an indicator that it's becoming even more urgent. Some organizations and institutions, they are coming together to see that there are gaps in the existing reporting, requirements. For example, the GRI standard is all about looking at where the impact is from businesses to planet and people. But now with ISSB kind of organizations, they are saying that we also need to understand how the planet and the change in the weather conditions also impact the enterprise. And therefore, enterprise value creation and financial materiality, which was not being realized in a GRI sustainability report, is becoming more evident now, right? However, there are differences and there is gap because many reporting frameworks, they have different scope, they have different parameters which they are including, and there are differences of quality versus quantity. Companies want to, cater to many reporting frameworks. Companies want to report on maybe one reporting framework, but many topics, and they don't know where they are. So it's a lot of scattered efforts and initiatives. There is also lack of standardization. And I think there is also the accuracy and reliability of data, which is a big problem because, it's very easy to say when a question in a reporting framework, for example, do you have any incidents of child labor in your supply chain? And do you have any policies and review mechanism or any training or any management processes? I think there's one answer which comes is, we don't have any child labor in the organization. That's not the data which is required. So I'm just giving an example which is happening. So accuracy and reliability of data for the market to really use ESG information is very, very important. Otherwise, the risk mitigation and the opportunities, they will not be, taken into consideration. Other thing is sustainability report and the reporting process has a big gap. Reports are made to show maybe a mandatory requirement fulfillment, maybe to show that, okay, we have a document, but out of those processes of reporting leading to information which will be plugged into the strategic decision of the company, I think there's a huge gap, sir. And I hope that we will be able to plug in and take sustainability and sustainability reporting to actually looking at data and information which will bring in a strategic thinking change in the market.
So that I'm tempted to ask you a quick follow-up. So what is your take on greenwashing? And I just want a very brief answer. Is it real, adequate? Big, small, significant, insignificant? What is your take?
I think it's big. And greenwashing, sometimes I would say, I would like to give the benefit of doubt. Sometimes organizations are not even aware that they are doing a greenwashing. Sometimes they are aware, but they are not very well equipped to manage the situation. Sometimes it's lack of courage. And here the reporting process, I would say that sustainability reporting is not just about disclosing about achievements. It's also disclosing about where the challenges are. Maybe that greenwashing at the moment in this year is a challenge. And I have the courage to disclose and say that we would like scientists and experts to come in together, discuss with the regulators on how that challenge can shift into opportunity. So I would like to not say that, it is that companies are always evil and they are aware and they are not doing anything. I would like to say that I think a lot of capacity building and courage is also required.
You said it is big. I think we need another panel discussion. So we save it for that. So let me now move to Ritesh and let me try and get a peep into the corporate boardrooms, what is happening there in terms of, their strategies around sustainability. As I mentioned earlier, Ritesh, in my opening remarks, we've seen some loss of luster around ESG investing in the context of energy security issues in the wake of Russia-Ukraine war and so on. So how has it affected the discourse in the corporate boardrooms? And my more important question is, and I'm not saying just with respect to HLL, since you are from the corporate side, you could give us a general view also. Is ESG a sideshow or it's a main show now? That is in a nutshell what I wanted to ask you. And how is boardroom dynamics playing around it?
Yeah, I think extremely important questions. I think corporations of today have no option but to deliver value with values. And one of the most integral value is sustainability, which is absolutely getting defined as a mega trend. And there's equal business rationale also to drive sustainability. In a multi-stakeholder model, our employees seek that today. We know when companies, we go out to hunt talent, and talent today put one of the criteria how sustainable the company is. So for us to attract talent, we require sustainability. Consumers now more look at the back of the pack. What is what I'm consuming? And they give their own priority as to what they want to consume, they don't want to consume. So there's a business value in consumer value which comes from it. And hence, this is a mega trend like digital, which is genuinely redefining business model across the value chain of the organization. And hence, for example, at Hindustan Unilever, we don't believe that you can operate at a sweet spot of sustainability and business value. It has to be the same spot at which you have to operate the two. In fact, internally, we define our growth. There are 4 dimensions to growth. We call it 4G growth. Growth that is consistent, so that we get valued appropriately for our business. Growth that is competitive, so we are doing a better job to our shareholders. The growth that is profitable. We, of course, are an organization, we want to drive right business model. But equally important, the 4th element of the growth that is responsible. And if all the 4 attributes are not there, in our mind, we will not be able to deliver value with values. And hence, now we just click down a little bit on this element. Everybody has to play a role in doing that. Board, it starts with board. In my mind today, from boardroom to classroom, ESG is everybody's business. And hence, in the board, there are, of course, formal committees on ESG. But in my mind, before it even comes into regulating, are you doing ESG? Do you have commitments? Are you following through? It goes back to what is the strategy of the business. And if at all ESG is not anchored on the strategy of the business, it is very difficult for it to take off. Let me quote HUL's example. We sell soaps, you need water to bathe. We sell laundry detergent powders, you need water to cleanse your clothes. So back in 2010, we started an initiative of Hindustan Unilever Foundation, where we, along with government, along with like-minded partners, along with experts in the industry, are working to conserve water and create water potential in the country. In more than a decade now, we have 3 trillion liter water potential collectively and cumulatively we have generated. The 3 trillion liter water is equal to 2 years of water consumption need of entire India. So that's a scale at which we want to do, because we know that if water becomes scarce in times to come, our business of soaps and detergent is not going to survive. So ESG has started to become extremely integral to the business model. Then I take my role, Mr. Singh, as a CFO. I do believe I'm a chief value architect. Apart from, of course, core job, which I have, financial fiduciary responsibility I have, I'm a chief value architect. It is my job to ensure that I create a winning business case for sustainability in the organization. But there's always a question, can you afford it? Is it just a tick box exercise, ma'am, to your point? But if it is not seen integral and CFOs of today don't end up creating winning business case to justify why that business model is sustainable and long-term will create far better value, we will not be able to get succeeded in that space. And then it comes to performance, because to your point, sir, there could be a short-term challenge of business profitability. There's always a long-term strategy, but this entire area of ESG will have to be managed multi-year, because we know the solutions are not easy. They will be not there if we have to reach as India net zero, if Hindustan Unilever has to reach by 2039 net zero in our operations plus extended value chain. We'll have to keep working through multi-year initiatives to ensure that pivot happens in terms of moving to net zero. So that's an extremely important point, that companies will have to have multi-year capability to performance manage these initiatives. And hence, last but not least, the point I want to conclude by saying that it is not a zero-sum game. We do compete for market share and share of wallet of consumers, but ESG is not an area that we want to compete with each other. This is an area where we want to ensure that we collaborate to compound the impact. Can we pool resources together to crack technology and crack innovation? And of course, put resources behind to ensure that we have solutions which are innovated in times to come, which will ensure that the whole industry gets benefited from. I don't think so single company and institution today can drive ESG on their own. It is not a zero-sum game. We will have to pool our resources together to make a meaningful impact to the society.
Thanks for that. So let me now move to round 2. Here I would, try and focus more on the transition finance and sustainable finance. So let me start with you, Manish.
Yep.
You already answered my question to some extent, but the specific question which I had in mind was with respect to SEBI's green bond framework, which we revisited recently. And we also introduced the concept of yellow bonds and blue bonds and transition bonds. So, but our concern is these instruments haven't really gained much traction. Just to give you a data point, there's a total issuance of 17, of INR 5,300 odd crores. So what would be your recommendation to increase uptake and engage investor interest in these instruments?
Sure. So I'll continue from where I left. So essentially, this sector today is dominated by renewables. If you see the investments which have happened over the last 7-8 years, we have seen an investment of around 75 billion. About 20% has come in the form of equity, and the balance in the form of debt. And this is mainly debt from either NBFCs or banks. Capital market has played a very limited role. The way I see it is that if you take the sector which is mainstreamed, which is mainly renewables today, and to some extent electric vehicles, the key challenge is not the availability of funds. The key challenge is the projects. Today, if we are talking about 500 gigawatts by 2030, which is the stated ambition of the country, we are today actually at about 150 if you take small hydro as well. So if you have to do 350, then you have to do 50 per year. But actually the track record is 15 per year. So what we need is a framework where projects can be executed much faster. It is really surprising that today we have a solar capacity of around, say, 75 gigawatts. And China does more than that every year. So I think the first important thing is that we need a execution framework where the acquisition of land is much easier, where the evacuation framework is readily available, and where there are no policy, dissonance. So once that happens, then we'll have more projects. And once more projects happen, I'm sure that, this market will develop. But as I said earlier, for this market to develop, we'll have to be very clear, Madam spoke about greenwashing, that the project should really be green. So first we need taxonomy. And there, a lot of good work has happened in Europe and in some other places. And I think we can borrow from there. And we can make a taxonomy which clearly defines what is green. I think that is fundamental to this. Apart from that, for those segments which are not mainstreamed, I spoke about the mainstream segment. There are segments which are not mainstreamed, like say green hydrogen or say electric bus segment. There, and here the business models are not tested. So here something like tax incentives, I think will work very well. And at the same time, some kind of a risk mitigation framework with the help of multilaterals. Apart from that, if you see the capital markets today, they are dominated by issuances which are rated, say, AA and above. So if you have some kind of first loss guarantees, then the rating can go up the chain. And at the same time, if you have some kind of obligation given to important capital market players, like say pension funds, insurance companies, to invest in green, I think that can also make a difference in terms of developing the secondary market. So once you have a secondary market, then the market automatically develops. But the key is definitely that we need supply of projects, which is where I think the gap
Supply
is.
of projects, of course, is one. And also, how do you create that green premium? That is also a challenge. And point is, one has to raise loans at the same rate of interest, plus also take on additional compliance burden or requirement, whatever. So where is the incentive for doing it? So for that, you need multiple players in the market.
Yes.
You need more investors so that a premium is generated.
Absolutely. It's a very pertinent point. So one way of generating green premium can be just shared tax benefits. But I think the bigger thing where we need a macro level regulation is in pricing carbon. It can be through a emission trading system, or it can be through a share carbon tax, which is something which Government of India is working on. And I think that is where the premium can be created, where that each segment can only have a budget of so much of carbon. And if they generate more than that, then they have to pay for it. And they have to buy it from someone who is mitigating the generation of carbon. I think that will be a big macro level change, which will have a big impact.
Right. So Ritesh, let me turn to you again. So I believe HUL has committed to achieve net zero emissions for all its products from sourcing to point of sale by 2039. So I'm sure it requires a lot of transition planning and also challenges around transition finance. So can you share with us, unless it is confidential, how your company is dealing with these challenges on transition finance and transition planning?
Well, let me spend some time talking about it. So there are three different models we have of funding ESG. First of all, the P&L has to fund for itself. So before even we ask for resources to come from outside, the financial growth model will have to create space for investment for sustainability. And many of them, they don't come at the cost of profitability. It is just a different way of doing business. Today, for example, solar and wind, it's very clear that the business case for solar and wind is positive. So if at all you are able to commit capital to it and set up infrastructure for solar farm or windmills, the energy generation from that is cost efficient. And if that is the case, how can we scale it up? So that is one job to be done. A lot of experimentation will have to happen in the space of ESG. And once we experiment and something does not work, how do we fail fast? But once we experiment something worse, how do we scale up fast in terms of investing? So hence the first model of investing is revenue getting generated within the profit and loss account of the organization itself. So internally, for example, at HUL, we have a carbon tax as a pricing mechanism. Any capital allocation decision that we do, first assessment happens, what's the amount of carbon footprint for the project? And then what's the carbon price we need to inculcate in the project so that there's a self-sufficiency of mitigation within the project initiative itself. So before when we go outside to get money, we have to do that. Now, of course, at the end of the day, once we make a product, I can't go and charge to consumer more money that this is a more sustainable product. You can't charge more for that because not every company might end up doing similar amount of work on ESG. And hence, the job is to find resources within the P&L to ensure that we're able to make space. Second is partnership. To give an example, in Mumbai city, we have 16 Suvidha centers. Many of them are done through HSBC, where we have pooled resources. And this Suvidha centers basically provide basic sanitation, hygiene, toilet, and bathing facilities for people who are underprivileged. We know that not everybody is able to have access to such basic health and hygiene in life. 4 lakh people benefit from that today. In doing it, we save 100 million liters of water because of this initiative. And it's fabulous. The only way that was possible because HSBC and HUL came together to pool resources. The point I was making earlier, collaborate to compound. So that's a second model of investment where you get like-minded. And we have just agreed with JSW Foundation, another partnership, to further extend and the partnership. BMC in Mumbai is helping us with resources to ensure that the Suvidha centers are getting created in the right parts of the city. So, and hence, partnership is the second model of investment. And third, as a large corporation, we will have to invest in the value chain. Of course, we are very keen that we keep working with large companies as our value chain partners, but equally MSMEs as our value chain partners. What shouldn't happen that in the entire driving ESG, we should not start choosing only big players to work with. Now, for smaller players to become more capable in ESG, we will have to ensure that we co-invest with them. So, for example, when we, as HUL, we've agreed to sign an arrangement with Brookfield to set up solar farm, and the electricity generated from that, we will end up sharing with us and our manufacturing networks, our third-party suppliers who manufacture on our behalf our products. We'll be able to share the network with them as well, so that A, they get green energy, and B, also cost efficient. So that's the third model where businesses will have to lean in to our value chain partners to fund their ESG requirements, because we cannot achieve net zero if the value chain has not converted itself. So scope 3 and scope 2 cannot happen by just taking care of our own house. So those are 3 different models that we have deployed today to get the job done. And internally as an organization, we have taken a more accelerated target at 2039, as I mentioned earlier, to become net zero. And the only way that can happen is for us to A, call out our interim goals. So within that, for example, we have a goal by when in our own operation we'll end up becoming net zero before we get net zero in the end-to-end organization. And for each of those items, there are milestones we have given. Now, do we have all the answers today? Answer is no. Because many areas, technology have to keep evolving, and we have to invest to ensure that we find solutions in times to come. And hence, exactly to your point, Mr. Singh, investment and funding is super critical to ensure that this sees light of the day.
Let's now turn to Sunil. Sunil, you are aware about our commitment to SDGs and also the COP26 net zero commitments that we made. So as a regulator, what can be done to incentivize and scale up sustainable finance landscape in our country, particularly the transition finance piece? So what are the plans there and how are we dealing with it?
I'll share a bit insight on what is happening globally. Globally, I think Manish, mentioned about the transition finance. He did chip in. But if you look at globally, I think Japan and I think to my memory, HKMA are the two jurisdictions who have come out with some kind of, and MAS to my knowledge, who have come out with some kind of a transition finance framework. Now, when we talk of transition finance framework, I think essentially what is required is a transition plan in place. And that is not for a single regulator, because a transition plan, as somebody already spoke about, has to be credible, transparent, verifiable, authentic. So if a bank, for instance, say wants to kind of get into a transition finance or wants to end up doing transition finance for a corporate, the corporate should have a transition plan that should be transparent, credible, and basis that the bank or the financial institution can help it out. Now here, my sense is it has to be a joint effort. All regulators and governments need to come together, create a platform, and where all the entities can put their transition plan in public domain, and which will be transparent, credible. So the system as a whole moves together. It is not individual regulators who are going to take a call. It's for a country as a whole. So if a country as a whole, it has to be done. First, you need to have a transition pathway. Each of the corporates should have a transition plan. And when all these things are put together and all these things are put in a transparent manner, which is credible also, then only a transition. And I don't think a regulator can come out with some kind of guidelines. That's for an individual bank or an FI to deal with the corporate. You can come out with broad principles like what other jurisdictions have done. They have laid down the broad aspects or broad principles which have to be in place when you are trying to do transition finance.
Your point is it is a multi-stakeholder engagement which is required rather than just regulator or the government doing its.
It will not take us anywhere. If RBI or SEBI alone is going to do it, take my word, it doesn't take us anywhere. It has to be coordinated effort, because somebody comes and say that I want transition finance. There will be banks who would say, I would not fund you. Why should I fund you? Even though the intention for that person is to move from brown to green, nobody will touch it. So for there, you need a platform where all regulators and government and everybody comes together and work in a single, because it's for a country as a whole. It's not for a regulator or an entity.
Right. Okay. So Aditi, I will turn to you again now, but this is not a question on sustainable finance or a sustainable finance product. It's a question again on disclosures. So how do you see the interplay, or if I can use the word tension, between GRI framework and the ISSB framework? Are you collaborating in some sense, or you are, if I may say, on a confrontational path? So just share your take on that.
Yeah, very nice question. I'm sure many of you would be interested to know about this because I think the GRI standard is here for now 27 years, pioneer of sustainability reporting framework. But we, as an organization, we have always collaborated with other reporting frameworks. We started like the CDP came, Carbon Disclosure Project, and they went into different topics also, and moved into many other, today we have many important reporting frameworks. So first of all, we always created from GRI, we always created some linkages to facilitate the process for businesses to see where are they, to look at depth study and look at a wider study to look at many topics versus a single topic which can go into more details. So that's the way that GRI has been working. ISSB is from the financial side. So definitely they are looking at sustainability from financial materiality angle. We, if I can answer your question about the word tension, I would say tension here is good from GRI side, because we definitely needed the financial materiality and the information about environment, social, and governance topics to reach the investors. So that's very, very important. Plus, I think IFRS has been there as a body on the financial reporting side, right? So from their side, if some standard comes, it's good. Now, how are we working? It is a tension to bring both sides of sustainability in the same platform. So ISSB is looking at from the financial materiality side. GRI is looking from the impact reporting side. That means what are the business footprints on the planet and people? If that is not recognized or measured and targets not set for reducing those kind of footprints or improving the situation, I don't think financial materiality will be complete. So therefore, the complementarity and I think collaboration between ISSB and GRI is very much needed. And to your question, we have an MOU with ISSB. We have launched the Sustainability Innovation Lab in Singapore. It is going to come to also India and the southern, the subcontinent, where we are looking at how the financial materiality and the impact reporting side can be together. The good news is also that in 2023, a lot of changes happened, and the European Union, EFRAG, also brought out the ESRS, where they are looking at double materiality. So both of them. And for GRI, it's a great opportunity because we bring in the bridge between IFRS, the ISSB standard, which focuses only on climate change at the moment. And then we can link the ESRS, which is talking about double materiality. So companies who do not understand double materiality, the foundation can be the GRI standard, looking at 31 topics of sustainability, looking at how businesses are placing their impact on people and planet, and going back to financial materiality with the ISSB.
Sorry to butt in there, but is there any interoperability also? This innovation lab is looking at, that's what I was told.
Yeah, so it is actually standard agnostic initiative that GRI has created. We have already launched in the public domain the interoperability mapping tool between ESRS and GRI. And EFRAG has mentioned publicly that companies who have been always using GRI standard for reporting globally, they can use this as a ESRS compliant report through a mapping mechanism. With IFRS, we are actually on the path of bringing out this kind of interoperability, so that not interoperability, I think there has to be linkages more, because at the moment, the ISSB standard is focusing on climate change through their S1, S2, whereas GRI has a varied number of disclosures on environment, social, and governance topics. Yeah.
But I guess they'll also get there in due course of time. But thanks for sharing
Of
those
course.
insights. So now I know this discussion on sustainability is very important, but lunch is equally important. I don't know what time we have, Pramod, till what time? 15 more minutes? All right. So what I'll do is I'll get into the round 3, but I'll request all of you to keep your answers brief and so that we can finish on time. So in this round, I wanted to focus more on the ecosystem around sustainability, disclosure related issues, which we've been talking anyways, and the ratings also. So maybe let me start with you, Manish. What is your take on the usefulness of ESG ratings? This is one area where regulators are also engaging now for investors or lenders in assessing ESG risks faced by corporates. And also, what are your thoughts on following a differential approach for benchmarking for ESG ratings across various markets? Because it will not be fair to have the same common standards for all the markets. So,
absolutely. So ESG ratings can be a great tool for the investors. But for that to be true, the ratings have to be transparent, they have to be consistent, and there has to be a comparability. And all these 3 parameters, unfortunately, the things are not stacking up. Today, if you see the way ratings are being done, some raters are using the secondary market information, some are using information from the company, some are buying the information. Then they are giving different weightages to E, S, and G. And they have got a different way of rating the company. So you will find that maybe Tesla will be rated very well by maybe MSCI, but Sustainalytics might say it is very poor. Similarly, some of the other companies, some rating agency might say that this is the best ESG rating. Other might say it is the worst. So that is the variability. So because there is so much of variability in the ratings, it is quite confusing to the investors. But at the same time, we must admit that ESG ratings will have a lot of nuances, taking into account the local factors and the local challenges. So what is important is that we need to have some baseline globally on the rating, and then we need to take into account the local factors and the local challenges, and then finalize the rating. But the fact is that we are very far off. Yeah, that's what I would like to say.
Right, right. So Ritesh, coming to you, how do you think can technology and data analytics improve the quality and timeliness of sustainability reporting? And if possible, you could even give some examples from HUL.
Sure. So this is an area which I think we are at a very nascent stage. Financial reporting systems processes have got evolved over last multiple decade into a very good space. ESG, I think first to many of the conversation that we had, even the taxonomy as to how do we define those measures, we are at that early stage this point in time. So hence, in my mind, developing sophisticated systems to support reporting, data analytics, it's some years away. The focus in organization like ours today is on first data capture, data audit trail to be created, and so that we can do some analytics around the trends of information around it. So reliability of the information, capturing information, and audit trail of the information is today the first focus area. At HUL, we have our own in-house tool that we have developed to do this, because when we scanned the market, we couldn't get much amount of solutions which were in that space. So we created our own tool. That's stage one. But stage two, now what we're doing is we started to collaborate with external business partners to develop an ecosystem tool for the industry. In times to come, two big need. ERP systems today, which only record financial transactions, they will have to evolve to record also non-financial transaction. So if power cost is getting captured, then the source of the power, the usage of the power needs to start getting detailed as part of the ERP system. That in my mind is the right solution, but that's time away. Second important solution is blockchain. Because when you talk about value chain and value chain reporting as part of BRSR, imagine a company has 50 customers, and they to start reporting to all 50 customers the cut of the data, which they need to include as part of their ESG value chain reporting. That is not sustainable. So can we then, hence, there's a need to create a distributed ledger, a blockchain around it, where data once created by an organization, appropriate slices getting picked up by anybody else who needs to complete their reporting. And hence blockchain as a technology, which is a distributed ledger, will need its own anchoring into ESG reporting in times to come.
Are you trying that, if I may ask?
At this stage, we have started to put, let me say, blueprint and paper respond in time. It's away. The current focus is to solve the data capture, reliability, and audit trail. That is what we have internally got it done. Now we're working with our business partners to create a tool which industry at length can use, which can keep getting evolved as BRSR is evolving. We can have a tool which all of us can end up using. So we are working with few partners, hopefully end up having a tool which industry at length can use, and everybody can benefit from a tool like that. So that's the second stage, but redefining ERP and blockchain, in my mind, is some years away.
Aditya, I have to come back to you again on disclosures. So your favorite piece. I heard, in one of the conferences like this, that why do we need so many frameworks, and why can't we just have, so you have financial reports, you have sustainability reports. Within sustainability reports, you have multiple jurisdictions asking for different disclosure formats and so on. Why can't we have one single integrated report for the benefit of investors? Which would combine both financial and non-financial disclosures. And there was an attempt in that direction from the Integrated Reporting Council in UK. So your take on that?
I think it's I think an aspiration for everyone. We have financial reporting for so many years, yeah, and the maturity of sustainability information to become very relevant for a business is, I think, a cultural shift that is needed. And for anything to become like not just a regulatory norm or not like a practice that can be audited, but to bring that cultural shift, I think it takes few generations, which has happened in financial reporting. To so many nations actually have financial reporting as a mainstream practice. But right now, sustainability reporting is not there still. It's many, many years away. So that's the first thing. The other is that when the moment we want to harmonize, I think the main issue here is who becomes the biggest, who is most, popular, who is more going to be revered by others. I think that's the problem which stops harmonization to happen.
When you say biggest, you mean in terms of standard setters?
Yeah, standard
Oh my-
setters,
okay.
who has the might,
Okay.
So you will see that now when IFRS, came into the picture of sustainability, they may have started with just the climate change dimension of reporting, right? But when they used the word sustainability and only on climate change, there was a big noise in the market around the world. Oh, now everything is going to change, including questions coming back to GRI that, okay, now sustainability reporting from IFRS, what will happen to GRI? But if you think about it, the understanding of what is the implication of each ESG topics to the core business, what you were mentioning and what you were mentioning, I think it's very important to really, get absorbed into the DNA of the company. It takes time. And that is where I think as a regulatory body like SEBI here in India, I'm going to talk about my country only, let's push this sustainability reporting not just as the, tick, tick, tick. Then it will never happen. Coming back to our question on harmonization, maybe the standards are different, but who stops from different organizations to collaborate and dialogue on where the assurance is, what kind of difficulties are companies facing, where if we can collaborate with civil societies to see, you asked about greenwashing, is there greenwashing? Or even, the social impacts which are happening on the ground, are they really aware of what should be done by businesses? I would say harmonization of standards may take long time unless a big regulatory body, I don't know who will make it happen in the world. But because standard also has a commercial side to it, right? GRI, for example, is a public good, but not many standards on sustainability reporting in different dimensions are actually a freely available public good. So that's one point. Number two is what I mentioned. And number three, I think it's a cultural shift which will harmonize everything. So I feel this understanding about double materiality within a company can make it happen on its own. We don't have to wait for a body to, say that this is the standard. Companies can be very aware and very smart and say that we know where the impacts are on the people and planet and on the finance.
Sorry, I'm interrupting you there. So, the good part is in the sense I've been tracking all this for the last 5 years or so. The push from investors, I think, has done a very good job there. They didn't wait for regulators to mandate. Investors themselves were asking for it. And some of the enlightened corporates around the world were very voluntarily, disclosing what they needed to disclose to satisfy those investors. Plus also some of the fund houses saying that we'll not invest unless, you follow sustainability practices and so on. So now I'm mindful of time, so I will not see, these are all very interesting, engaging issues, and we can keep discussing till cows come home. And I have list of more questions, but I'll not get there now. I'll get into my rapid fire round. And there you may say, I don't want to answer. I don't want to force you. You can say, no, I'll not answer this. Or answer is generally one line or one word, right? So I'll start with you, Manish. Is this okay with you? So the statement is technology to directly remove carbon from the atmosphere. Science fiction or reality?
It's science fiction, right?
One key ask from regulators in the area of sustainable finance.
Taxonomy.
Good. Greenium for bond issuances in emerging markets. Fact or fantasy?
Fact.
It will happen. Okay, good. Ritesh, if I can move to you. Should companies link the achievement of sustainability related goals to executive remuneration? Yes, no?
A big yes.
Wow.
We have it at HUL. my salary today gets decided how I deliver on sustainable goals.
Interesting. Flexibility, proportionality. I mean, these are two things which we've been parroting in all international meetings. We need flexibility, we need proportionality, and reliefs in the ISSB standards for companies in emerging markets. Adequate or inadequate?
To some extent, inadequate.
Inadequate. Okay. Does driving the ESG agenda come at the cost of sacrificing financial performance? Yes, no.
Absolutely no.
Okay, that was very clear. Aditi. So, I asked you this already, so that's why I was pausing, but let me ask you anyways. Do entities that form part of voluntary net zero responsible investing or other corporate purpose initiatives, do they walk the talk when it comes to sustainability? Yes or no?
To an extent.
To an extent.
Yeah.
Okay. Comment in one line. Should companies in emerging markets use internal carbon pricing in decision making?
Yes.
Okay. I have one more question, but that is common for all of you. But before that, Sunil, I don't want to leave you from this round, but you can say no if you don't want to. I know you from RBI. So comment in one line, biggest challenge in assessing climate related risk. What is the biggest challenge?
Data.
Okay.
Of course, it has linkage to taxonomy, but still data will be the biggest challenge.
So data and taxonomy, that's what you would say, right?
Yeah.
Okay. Second question is, I'm asking you only two. Key feature necessary to increase the attractiveness of green deposits.
I think market says differential interest rate.
Sorry, say that again.
Market says differential interest rate. Because right now you cannot differentiate between a green deposit and a normal deposit. So market.
Okay. Right. Okay. Got it. All right. So let me see if I have some more stuff here. So this is a common question for all of you. E, S, or G, which should come first for a company? We'll start with you.
E.
I would say same thing, E.
I think it's G.
Right. And Sunil, E, S, or G, what comes first?
E cannot happen without G.
Good. So I'm not supposed to answer. For a change, I'm in a good spot today. Otherwise, I'm just used to sitting the other side. So I would go with G. I would go with Manish and Sunil, but I respect your answer as well. So now, last question, which I'll ask all of you, and that is, you need to complete the sentence. And the sentence is just 4 words. The path to net zero is?
Not a zero-sum game.
I would say the same, not a zero sum.
It's pretty much possible.
How?
Technology.
Technology, right. Sunil, path to net zero is? You may not answer.
I think creating an enabling regulatory environment.
Can you say that again?
Creating an enabling regulatory environment.
Right. Yeah. That's fair. So I will not trouble you anymore, but I will leave it open to the audience. If they have, we can take maybe 1 or 2 questions very quickly. Yes, please. Oh, yes, please. So I'll just take 2 questions because I'm mindful of the time.
One is RBI.
Right.
I am seeing banks giving a lower rate of interest to depositors for green deposits.
Just hang on. Can somebody pass on a mic to him so that Sunil can also listen?
So you just answered one of the questions from Mr. Amarjeet saying that differential rates, whereas we are seeing that banks are giving a lower rate of interest for green deposits. And to my mind, it's quite a bit of, discussion both ways that why should depositor get lower rate and vice versa? And I will also ask my second question. I don't want to lose my this thing, which is for the other panelists. What is the difference between transition finance and greenwashing? I see that anybody who's trying to transit, you might say he's greenwashing. These are my two questions. How is RBI? What are you going to do in terms of why should the depositor get a lower rate?
Yeah, we got your question. So I'll ask Sunil to answer the first question. And maybe Ritesh, would you like, one of you could answer the second one. So over to you, Sunil, quickly. Yeah.
Sir, the guidelines are pretty clear. Same tenor, same tenor, same tenor. I think couple of things are there. You cannot differentiate when you're offering the two kind of deposits. So there is no question of that. What banks may be doing, they are playing around with the maturity. Supposing 1 year kind of thing, they may be offering 367 days or 368 days. So there they may not be. But I think if it's happening in the market, we have our supervisory teams at the grassroots level, they will examine. So I'll stop short at that, saying that the guidelines are pretty clear on that. They cannot differentiate when it's a same tenor kind of report.
Can I try and answer your question? Again, not referring to any.
Yeah, I'm not talking about a regulatory question. I know the regulation, you can't differentiate between two depositors. My question is at a philosophical level as to when we're talking about sustainable finance and we're seeing green deposits as one of the ways in which RBI could push green finance or green objectives. How do you suggest it be done? I don't.
Yeah. I'll respond to that. Madam. I think these was internally deliberated within the organization also, that whether we can give a differential rate of interest, either it could be higher side or lower side, 5 basis point up or 5 basis point down. But at that point of time, because see, you have to take one fact in mind, that before we came out with the green deposit framework, some 5 or 6 banks are already offering this thing. Now, if we had not come out with a framework, any bank or any entity would raise the money. And tomorrow, if there are issues relating to greenwashing, then the regulator will get caught there. So that's why we came out with a green framework, basically, which suggests as to what all steps a bank needs to do when they come out with the green deposits. And there are certain items which they have to comply with. Now, having said so, whether we can offer differential rate of interest, I think that is getting deliberated internally. But no final kind of stance has been taken on that. So it will be too early for me to comment on that part. But I do.
Right, Sunil, thank you. Thank you, Sunil. Just to very quickly add to what Sunil said, at a philosophical level, the rationale is, as a depositor, am I willing to take less financial return and get more social return? So that's a combination of the two. A second question, transition finance and green finance, greenwashing, are they the same?
Sure. So they are not the same. See, the green, all greens are not the same. You can be a dark green, you can be light green, or you can be medium green. Let me just explain that. If you say dark green, then your project is good for the environment in all the aspects. So maybe it is mitigating carbon emission, but it's possible that, say, a wind project, for example, is mitigating carbon emission, but it might be in the path of migratory birds. So it is killing biodiversity. So in that case, it is still green to some extent, but not fully green. Now, there could be a project which was earlier using coal, thermal coal, for generation of power. Now, suppose they start using some waste, agro waste. It's not fully green because it is still emitting carbon, but then it is relatively better. So as long as we are clear, as long as there's a taxonomy which is clear whether this is dark green, medium green, or light green, then investors will be clear what they're funding. And as long as that is happening, I think it is fine. But if you're doing something which is light green and then claiming it is dark green, then I think it is greenwashing.
Correct. Thank you for that. So your last question, yes, please.
Thank you for the opportunity. So I have seen that the research that has been done on ESG investing, so there is a dichotomy between findings in the emerging markets and the developed markets. So most of the developed markets report that firms with lower ESG risks, they are more, sort of resilient when it came to COVID period. The returns are better, and the ESG return has, ESG investing also has a long history. in the US, although with a different name like SRI investing or not. But when we look at markets like India, then, I mean, I did a couple of exploratory studies where there I found that the firms with higher ESG scores, they tended to crash more, for example. Firms with higher ESG scores, they delivered lower returns. And that, had a resonance in other emerging market studies, which I could refer to. So are we alive to this fact that the ESG risks for the Indian investors mean differently than what they mean to investors in the developed markets? And what if we do not recognize this? And if we don't, then are we sure that the push towards ESG investing, that is going to actually succeed in the long run in a country like India, where in the previous panelists, one of the previous panelists said that investor doesn't care about anything except returns. Do you think that India is still at that stage where ESG is still ESG is still yet to find its place in the market, in the psyche of the investor? Thank you.
Okay, so returns are pretty much function of the risk. And the fact is that climate risk is now integral part of any investing. So, climate change is a global problem. It requires a global solution. Now, some part of the world has realized it. And, there are investors, like say Blackstone, they have got pie in all the geographies. So they know that their returns will definitely be impacted if there's climate change. Now, this is something which slowly the realization is happening. So fact is that today, climate risk is real, but it has not been integrated with the enterprise risk management. But eventually it will be realized because it is happening. So I guess, and I think the data which you are referring to is not a long enough data. So I said eventually, because climate risk is real, it will be realized and it will become part of the enterprise risk management. And ultimately returns are the function of the risk. So that's the way I will put it. Yeah.
Yeah. So I will bring this discussion to a close now. Thank you very much, all of you, for a very engaging discussion. I enjoyed, and I'm sure audience also enjoyed. And you all chose to take the rapid fire round. I wish I could give you a gift hamper, but I don't have one. So thank you very much, all of you. Thank you.
Thank you, sir.
Sir, may I request you to stay on the stage to felicitate the panelists? May I invite Dr. Prabhasara to come on stage to felicitate Mr. Singh? Dr. Tirthankar Patnaik, can we have you on stage for felicitating our panelists with the NSE bell? Thank you so much. Thank you so much. We'll now break for lunch.
We thought there were problems putting it back, so we just got them in.
We'll start the third panel discussion at 2:30 sharp. So please be back by then. Thank you so much.
मैंने तुरंत जाके किया मेरा मेरे में चल रहा था
क्या हो रहा है? I don't know. I think extend हो गया आपकी screen.
और ये पहले दूसरा देखेगा
It's connected to my. Yeah.
That's okay.
You want to test the speed or something?
नहीं that's okay. Speed इतना वो नहीं चाहिए. So this is lunch break. यहाँ से हम let's see. Okay, इसको duplicate कर देते हैं. ये आ गया. ठीक है. नहीं ये पहले कैसे आ गया? ये तो बाद में आएगा ना?
नहीं ये पहले आएगा, ये पहले रहेगा क्योंकि वो ना उन्होंने बोला कि पहले पैनल को इंट्रोड्यूस करेंगे, पहले पैनल। हाँ
ठीक है, ये किया, ठीक है, ये आ गया, ये फिर से आपने कहा ना, नहीं ये कुछ आपने मेरे में बराबर चल रहा है ये
कनेक्टेड है हॉटस्पॉट से।
पर नेट तो चल रहा है ना, कोई देखो नेट चल रहा है, नेट का इशू तो नहीं है।
pass.com से एक बार
Should I close and try again?
एक सेकंड देखो मेरे में नहीं अभी फुल स्क्रीन नहीं किया। जैसे ये थर्ड है, ठीक है,
पर आपके में ये लिखा हुआ आ रहा है।
नहीं वो कल वाला है ना, कल वाला है।
कितने हैं?
एक और आएगी अभी,
एक
5
उधर है ना, पीछे रखिए।
एक और लगाना है,
रख दो 5
ठीक है, ये मैंने लंच पे कनेक्ट हो रहा है। अब वो कनेक्ट होके ज्वाइन द क्विज
नहीं आ रहा है इसमें, नहीं आ रहा।
ये देखो मेरे में
तुम लॉग्ड इन हो अर्चना?
एडमिन में लॉगिन है आपका, एक बार रिफ्रेश करके देखो वाले पोर्टल में।
मैंने
अच्छा एडमिन शायद लॉगिन नहीं है ना आपका? अच्छा है, रिफ्रेश करके देखो।
या तो एक काम करते हैं, फिर से अभी डाल देते हैं वो आप
एक बार इससे लॉग आउट, स्लाइडो से लॉग आउट करके देखा है क्या? मैंने रिफ्रेश किया,
हाँ वो लॉग आउट करके
एक बार देखो।
ऐसा तो वो पावर पॉइंट भी ओपन कीजिए, उसमें भी क्या करते हैं, एक बार फिर से इंसर्ट कर लेते हैं। पावर पॉइंट ओपन कीजिए।
अभी क्या
This connect also यहाँ पे वो explanation दिखा रहा है।
ये एक्सप्लेनेशन क्यों जा रहा है, क्यों नहीं जा रहा है?
वो क्यों नहीं जा रहा है, वो आइडियली नहीं आना चाहिए।
नहीं कहीं इसलिए तो नहीं
हार्ड है ना, नहीं ये
Q&A जा रहा है क्या स्लाइडो पे? एक बार Q&A करेंगे।
नहीं अभी नहीं, तो फिर से एक बार इंसर्ट करके देखते हैं। ये किया, ठीक है, ये अब हुआ ना, वो लॉग इन लॉग आउट
सुबह भी बोल रही, तुमने एक बार ट्राई कर लो। एक बार लॉग आउट हमने पहले सुबह ट्राई कर लिया रन करके,
एडमिन
तो
लॉगिन
मुझे लगता है वो
कंसिस्टेंट रहा।
एक बार आशना जस्ट बिफोर द स्टार्ट ना 5 मिनट पहले आके फिर से एक बार ये चीज देख लेना।
देखो इसको डुप्लीकेट में भी एक बार देख लेते हैं, सो दैट ये हो गया ठीक।
पर ये
अरे एक सेकंड, ऐसी क्यों दिख रही है?
हाँ
वो एक सेकंड
एक बार
डुप्लीकेट करने से हो रहा है।
डुप्लीकेट
बड़ी स्क्रीन पे डालो। एक सेकंड के लिए देख लेते हैं आ रहा है कि नहीं। अच्छा हाँ ठीक है
ये बराबर है, ऐसे ही रखना, ठीक है ठीक है परफेक्ट है।
नेक्स्ट वाला एक से
हाँ
उसके नेक्स्ट स्लाइड करेंगे तो आएगा
हो जाएगा ना, लोगों को देखेगा।
अभी वरना बाहर पहले ही दिख टाइमर चालू हटा के देख लेते हैं
हटा के देख लो ना एक बार, आप हटवा दो। ठीक है ये हुआ, ठीक है ये ज्वाइन वाला आ गया, उसके बाद ये टाइमर स्टार्ट हो गया, ठीक है
उसको बताना है मैंने उसको फिर मतलब
सो मेरा 2 to 3 एक मीटिंग है, I'll finish that and मैं आता हूँ, ठीक है
हाँ ये ना अचानक मैं थोड़ी देर फोन चार्ज कर लेता हूँ
मेरा इसमें है
हाँ आई हैड आप लोग करो
मेरा इसमें 70% है
हाँ मैं
मेरा-
you be kind enough to tell me what is his full name, Mr. Manish?
Chaurasia.
Mr. Manish Chaurasia, his designation, he didn't give us a card, so we left wondering.
Okay.
Designation is?
The COO of Tata Capital.
Lunch break करते हैं।
But Q&A चलेगा कि नहीं? Q&A चलेगा?
Q&A भी फिर रेगुलर ही चलेगा। We'll moderate. Q&A भी कर ही लेंगे फिर। वो तो आफ्टर द पैनल होगा।
हाँ
ये चार्जिंग पोर्ट कहाँ पे है?
बाइक में टाइम होता है एक दो क्वेश्चन आप पैनल से ऐसे
बेकार का फिर वो
Yeah, I'm just waiting for ma'am and sir, regions of the both are not here. The Pali ma'am and sir. Thank you. ठीक है ठीक है ठीक है okay. हाँ no I'll just yeah I was thinking I'll wait for that. Yeah sure. The quiz. Yeah, get them back. Okay. Good afternoon, everybody. If we can just settle down. So now I'll introduce our already assembled panel. So we have a new, the panel 3 is on investing in infrastructure, bridging the gap through securities market. So this, as it was hinted in the inaugural session, will delve into more of how securities market can play a pivotal role in getting investment into infrastructure. So our moderator for this session is Mr. Kamlesh Chandra Vashni. Sir is the whole-time member of SEBI, and prior to that, he's an IRS officer of 1990 batch, and he was last appointed as Joint Secretary of Tax Policy and Legislation in the Department of Revenue. Next panelist. I'll just start introducing our panelist. Our panelist, first panelist is Mr. Pramod Rao. He's the Executive Director at SEBI, and he has a wide range of experience spanning ICICI Bank and Citi South Asia. And the next panelist is Tushar Arora. He is from World Bank, and he heads the he's the Senior Financial Sector Specialist at World Bank, India. Our next panelist is Samuel Joseph Jabraj. He's the Deputy Managing Director, Lending and Project Finance at NABFID, or National Bank for Financing Infrastructure and Development. Sir has a long experience in banking. He's been part of IDBI and Exim Bank previously. Next, our panelist is Matthew George. He's the CFO of NHAI InVeets. Sir has a prior experience of working in infrastructure side of things. So he's been part of L&T IDPL and has great experience in project finance and treasury and risk functions. So now I would invite all the panelists to kindly join on the stage. Before we start the next panel, we start the discussion. We have a small fun quiz intended for the students who are participating today in the conference. Ashiana will take through the further nitty-gritties of how you can participate in the fun quiz. This quiz is focused on the topic of the current panel discussion. Ashiana? So I request all participants to scan the QR code which you see on the screen and enter your full name. We would need the full name. Only responses from participants who have given their full name would be considered for prizes. Yeah. And there'll be 5 multiple choice questions. Each question will be given 20 seconds. So the fastest finger first will be the winner. You can see your name on the leaderboard. Okay. I cannot see. Yeah. So, yeah. Okay. Okay, so I'm moving to the questions now. You have 20 seconds to respond to each question. Okay, so many of them have got it right. Next. Good. Next, question number 3. Okay, 75% have got it right. The fourth one. Wow. Last. This is the last one. Okay. And so we have Anshul Agarwal, who has answered the all questions in the fastest time. Anshul, so I would request wherever you are in the NSE premises, please come to the auditorium when the Q&A is going on for the prize. Thank you.
We can now start the panel discussions.
Thank you. Good afternoon, everyone. We had a wonderful pre-lunch sessions, heard Chief Economic Advisor, Chairperson, Mr. Uday Kotak, Bhatia Saab, and then engrossing 2 sessions. And then after that, sumptuous lunch and gulab jamun. Now, the problem was when this topic was given to me in the afternoon session, my first question was, "Ki yaar, afternoon mein kyun diya?" So their reply was, "Don't worry, sir. We are giving you excellent panel of speakers who will make it equally absorbing." So big round of applause to my fellow speakers. Friend, the topic is very interesting. Investing in infrastructure, bridging the gap through securities market. That is what the future is about. And we will see how this topic is going to educate us how we can use capital market for infrastructure development and the growth, which will in turn lead to growth of our country. We all know that robust and high quality infrastructure is crucial for sustained growth. And we spoke about sustained growth in the pre-lunch session. Now, this is very true because we have seen how investment in infrastructure multiplies many times. It has a great multiplier effect. We have seen in last few years how roads have come up, bridges, highways, ports, airports, educational institutes, network coverage, mobile coverage. All that has led to more than anticipated growth in our economy. And a lot of that credit goes to the way infrastructure has been developed by the government during these years. And the same is the future vision for this country. So when we say what is a vision for our country, the vision is that 2047, we should have Viksit Bharat. Now, that is the vision of each one of us. And we know that infrastructure is going to play a very important part. Now, who is going to finance it? Government is doing its part. If we see last year's budget, that is 23-24 budget, for capital expenditure, the budgeted allocation was 10 lakh crores. Now, that was 38% higher than what it was the immediate previous year. And government didn't stop at that. For the current financial year, the budgetary allocation has increased further by 11.1%. Now, that shows the priority of the government. And when we say capital expenditure, the major part is on infrastructure. But can government allocation alone achieve what we intend to achieve in 2047? So my first question will be to you, Pramod, that what are your views? How can we increase private participation in infrastructure financing?
I think, thank you, sir. I think the way I would sort of put it is that, as you said, the government has done its role. But I would also refer to what the chief economic advisor also mentioned, and which is that both our banks as well as our corporates now have healthy balance sheets. They've gone through their period of, repair and so on. But now with that, to my mind, I think the corporates are well positioned to actually start reinvesting and creating infrastructure assets on their own. We have far more, I would say, credible ways of giving them exits as well. I will touch upon that maybe subsequently, but just to say that even the chairperson made some references to it about how InvITs and REITs have sort of become the alternative for many of the investment opportunities. And to my mind, that is the assurance that I think private sector can walk with, that there are exit opportunities. There is now a proven track record of sovereign wealth funds, overseas pension funds, domestic institutions coming into and taking them out in many ways. And that takeout need not be permanent. In some senses, there are corporates who have transferred their assets to InvITs for 20-year period, 25-year period. And thereby they are unlocking the or able to monetize this for reinvesting in further creation of assets. To my mind, these models are now here. And what I would sort of say is that is what the corporate should sort of take a lot of credence with.
Thank you, Pramod. So I'll go to Matthews. Now that's, he is a very important person in this panel because he carries with him wealth of experience in NHAI. And NHAI is a leader in, this infrastructure financing through InvIT and other modes. So Pramod spoke about how, things are smoothing out, better exit opportunities, better, planning reforms by the government. What do you see the other challenges in infrastructure financing currently, which we can address?
Thank you, sir. To start with, I'll just take a step back to what Pramodji was mentioning. Currently, as per the statistics which NHA had come out with, I think only 12% financing is through private sector. The remaining is all public. If you talk of 3 lakh crores, 12%, that's it. So just imagine the gap we have to go to. So, I mean, keep that one point in mind. Again, a step back. How did this, and one thing which NHA has got right is the concession agreements. And that is why, if you see, the road sector is way ahead of other sectors. Of course, transmissions have copied, and a lot of other sectors are now trying to copy the concession agreement, which has been designed by NHA. It's not that NHA has got things right. There was a huge learning curve. They started with BOT, then evolved to annuity, evolved to HAM, evolved to TOT. Now, what is a common factor in this growth story or in this movement is that they realized that, and of course, it's a cliche, but you should allocate risk to the person most capable of handling that risk. Now, in a BOT, what was the biggest problem? It was land acquisition. Of course, there was two major risks. One is land acquisition and one is getting the toll rates right. The initial estimation of the traffic or the revenue which you can garner. Conscious of time, I'm not getting too much, but in an annuity, the getting land acquisition, not an issue. HAM, to a smaller extent, land acquisition is an issue. It's not land acquisition per se, but it's just for, utility shifting and tree felling and all that, where there's a thing where nature has to assist. In TOT, what happens is NHA gives the project under under EPC after the construction, then they monetize the road. And I'll come back to this monetization. Okay, so what has been the learning? BOT, the biggest, lot of banks burn their fingers because sometimes for no reason of theirs, when land was not technically able to be fully handed over. I'm not getting into who's to blame or anything to that, but over a period, they realized that, okay, land is not best handled by private players. Let us move it out. Once a project is completed, then let us monetize that road. And that is where we have reached the toll. And I'm just going through the growth story. Now what has happened, the biggest thing which has happened and the best thing which has happened for the road industry, and I'm more specifically on the road, of course, a lot of parallels in other industry, is the revenue collection. Once upon a time, it was cash. And I remember a time when we used to go around running to banks, asking for coins, for change and all that. What has happened? Now we are one of the leaders in digital payments. It translates to almost 99% of our toll collections coming through FASTag. And you can just imagine I don't think any other country can emulate what we in India have been able to do. And when we say that other countries are doing that, yes, they are there, but they are smaller countries and they have evolved. We will evolve because we have to take care of our dynamics. And I think we are way better placed for that. So now with this, we don't have land acquisition risk. We don't have revenue risk. At least we know what the revenue is. We can't forecast. Now, what is the other biggest challenges in infrastructure? There are two parts of it. There's the debt and there's equity. On the debt portion, it's been tom-tommed over and over and over again that banks, there's an ALM mismatch. We should go to the bond market. Okay, and maybe other panelists will answer that. On the equity, currently the biggest investors into most of our projects are foreign investors. You have the Canadians, you name it, you have a lot of foreigners who are quite keen to invest into the equity portion. And when I say equity portion, I mean the units of our InvIT. I was earlier with L&T, InvIT over there. They're also doing thing. Now, they have huge check sizes and they should be part of the growth story. But and as our minister commonly says that we shouldn't be depending too much on them because we have a lot of retail investors. So what we should do as at a first round, we can give them the bonds where they can participate in. But one thing we should keep in mind, it's the hard-earned money of the retail investors. I'm not to say that the banks and all, it's not the hard-earned money of the thing, but you should be very conscious when you're doing a bond thing. See, in a loan, you can restructure it. In a bond, it becomes very difficult to do a restructuring. Or even, tweaking the terms, it becomes extremely difficult. On the units, on the other hand, at least there is a 400 or 500 basis above the load, the NCD, you get an interest on this thing. Now, why should that go only to the foreigners? We should come to a stage whereby the Indian retail participants or at least the institutions are able to participate in this. And that we are seeing quite a lot of traction now. So in brief, there are a lot of challenges, but I think we are on the right path.
Thank you, Matthews. That was very useful perspective from somebody who is developing infrastructure assets. Now, probably we'll move to Mr. Samuel, who is Deputy Managing Director of a very good, institute which is financing these institution effort. So now, perspective from you, who is financing these assets. So how these challenges have been met by evolving nature of public-private participation. So what are your views, how PPP have evolved to meet all those challenges?
Yeah, thank you, sir, for the question. PPPs, I think Matthew also touched upon it briefly. The basic concept in PPP is we allocate the risks to the person who is best suited to mitigate that risk. But earlier, we did have a lot of challenges. Risks were taken by the concessionaires much more than what they could chew in. And banks had a problem. Infrastructure segment was given a very bad name. And I think everything stopped. The infrastructure financing per se stopped. And that is what forced NHAI to move from BOT to a HAM model, annuity model, and all that. But today, things have evolved, especially in the road sector. I will not repeat whatever Matthew has said. The road sector concession agreements have evolved, where the risks are allocated and also mitigation mechanisms, whether it is a termination clause, whether it is an alternate road which comes and takes away part of the traffic. What do we do? Because in these concession agreements in a PPP, where government and private sector have to work together, wherever there is ambiguity, things will come to a standstill. If some situation is not envisaged in the concession agreement, which comes at the end of 10 years, in a 25-year concession agreement, then the government is afraid, or the senior officers in the government will be afraid that if I take a decision which favors the private party, then he could be questioned. But today, most of the situations have been envisaged and already covered upfront in the concession agreements. So as he said, the road concession agreements have, to a very large extent, the PPP models have matured to a very large extent. If you look at another very happening segment, which is renewable energy, we started with PPP under the Jawaharlal Nehru National Solar Mission. In fact, I still remember the first projects what we financed under that National Solar Mission had a tariff of 15 rupees per unit. And today, as we speak, it is about 2 rupees 30 paisa, 2 rupees 50 paisa per unit. So at that point in time, a lot of challenges were overcome through viability gap financing. PPPs merged with viability gap financing. Then the regulators brought in the RPOs, renewable purchase obligations for blending of renewable energy with concessional agreement energy. There were renewable energy certificates. There were feed-in tariffs granted to these projects. So we have come a long way. But today, as we speak, renewable energy does not need any of those prop-ups to stand on their own legs. So as we are evolving, these PPP concession agreements are also evolving. And some what were absolutely required to make the project viable in those days are no longer required. Going forward, let us say, when it comes to a green hydrogen or an offshore wind, some of those models where viability gap financing and other things will have to be part of the PPP to make these projects viable. But it is very heartening to note that infrastructure segment per se, from the lender's perspective, has become relatively risk-free once the completion risk is taken care, because after that, the cash flows are more or less steady, and we are able to predict the cash flows and hence do lending. Matthew touched upon one another thing, because PPP, it is a work in progress. If you look at what we have achieved in the infrastructure segment, the risks which were there 10 years back. See, what is finally infrastructure financing? It is a financial modeling, and based on that, you lend a loan. In financial modeling, if the base case goes wrong, if the traffic assessment for the first year goes wrong by 20%, 25%, then the banks have a problem. But today we have data. Today we have the fast-track data for almost all stretches. And hence it is very easy to arrive at the base traffic and then build your financial modeling. So to a very large extent, cash flows have become predictable in the infrastructure segment. And that is what the evolution of this sector is. There are other evolving or emerging sectors, let us say water concession agreements, which are still in a very nascent stage, I will say. But I'm sure, like what has happened in the transportation, road transportation, and what has happened in the renewable energy sector, those sectors also will emerge, and PPP will become a viable mode for financing.
Thank you. Thank you so much. So now it is a time, I think we are fortunate to have with us, somebody from World Bank to share their views. Now they have experience all around the world how infrastructure financing is happening. So it would be very good to hear from Tushar how bonds can play a very important role in infrastructure financing. If I remember what Mr. Uday Kotak was saying in the pre-lunch session in his inaugural address, keynote address, that there was a time when investment in equity was not considered as a good thing, but we have moved from that. Now, it's a completely different India. So is it that investment in bond is in India, you see, is not considered good? So, or we see bond is a very attractive instrument for infrastructure financing. So how do you see, and how do you help, how can World Bank help India in this particular area?
Thank you. Let me start by saying that I'm really glad to be here and very excited to talk about this agenda for mainly two reasons. One, I think we always talk about lending being done by World Bank, but we don't do a lot of knowledge analytical work as well, right? So in past 2-3 years, we have done various technical studies on specifically bond market, corporate bond market, and how it can be scaled up to meet the critical investment needs of the country. And I think this forum allows us to share those findings with you. So I'm really excited on that front. Secondly, I think the agenda for this workshop for today, I think is a common vision for, I think, us and other stakeholders working in this area. So we share that common vision on the development of the securities market to meet these critical needs for the country, right? Bonds, I think it's everybody realize their importance, but it is not a very common knowledge as to why bonds could be a critical source to meet, the long-term finance needs of the country. So let me just spend maybe 30 seconds to 60 seconds on that, because I see some students are here and it'd be good to explain them in simple words as to what really bonds help with. Right? Yes, right. So I think, in the past, much of the burden on infrastructure financing has been either being borne through government budgets, center or states, or through banks, right? And there's been a lot of overburden on the banks in the past, right? So as a nation, I think focusing or scaling up your bond market gives you that opportunity to diversify your funding sources, right? And reduce the burden only on one sector, which was banks until now, to different sources of financing, and bond market being one of them. So it brings in more stability in the overall financial system in the country, right? Secondly, when you have more, suppliers of funds, obviously there is more competition. When there is more competition, it has an impact on the price of the product also, right? So here the product is money, right? So the borrowing cost in the country in the long term benefits out of this. It goes down, right? So that's the long term perspective of a nation building exercise, right? Thirdly, I think some of the investors are here in this workshop. It also gives an opportunity to different sort of investors that are there in the country. Every investor is not wanting to invest in short-term needs that retail or some of the short-term players might be interested in. Many investors are interested in investing long-term basis, pension funds, insurance funds, and they don't have the right kind of avenues to invest in. And if you are able to diversify your investment avenues, you give opportunity to all sort of investors in the country, right? So that's the third clear benefit out of this. So if you look at all of these aspects, I have spoken to various investors personally in so many years for now. I never heard that pessimism around the bond market. So and if you really count these benefits, I think India has a lot to benefit if the bond market can be scaled up properly. And I think the regulators realize this, the private sectors realize this. The If you look at the recent measures that the regulators have been taking over the past couple of years, SEBI is here. The infrastructure building exercise, various measures to launch the RFQ platforms and bidding platforms, right? Improvement in market infrastructure that has happened over past few years. The nudging that is being done for large corporates to borrow from corporate bond market. I think all these measures are in direction that will help scale up the bond market in the future. And impact of some of these measures are still yet to be realized, right? Some of them have started impacting, and some of them will start to yield results in the years to come. So I think the benefits are well recognized. The regulators are cognizant of this, I think, in our view, who are working in this direction. But despite all these things, if you look at the scale of overall corporate bond market in the country, given the size of the country, it still has a lot of potential to go up. So if you look at only the corporate bond market as a share of GDP, as the share of country size, it is still around 16-17% of GDP. And it has still room to catch up with some of the emerging market players like China, like Korea, like Malaysia. Some of the peers have almost double the corporate bond market size compared to India. So given what the aspirations can be set at, I think some more interventions could be looked at, some more interventions could be designed. Maybe some measures can be adopted from other countries. And I can talk a bit more on that as the panel progresses. But we've done a lot as a country in the right direction, but the opportunity is really, really huge. And I think the country needs to tap onto that opportunity.
Yeah, thank you, Tushar. Thank you very much. So
I just wanted to come in on one, sort of thing. And I know when the CEA spoke about it. Sure. So, I just wanted to give a context to what Tushar was just mentioning. And the chief economic advisor also touched upon it, about how maybe the highs we have come off and maybe it's been far more muted in the last couple of years. But if I just look at the last 12-month rolling basis, in equity markets, the companies which did IPO raised close to about 25 billion USD, right? $25 billion. In the same 12 months, the extent of corporate bonds that were raised was $105 billion, right? I'm just wanting you to have that context because many times we don't understand how big actually a market has grown to. It is very high, it is very big, and it can grow even more. I think that's the point which is being made. But we should have this context in mind about the primary issuances that are occurring. So the bond market has indeed matured to a huge degree. It has come with the help of exchanges, putting the electronic bidding platform, the RFQ for secondary market trading, and so on. But I just feel that without that context, we will continue to think as if there is still a long runway. I just feel we should, sometimes pause, look at these numbers and feel that, there is something we have sort of accomplished.
Yeah, thanks, Pramod. I mean, this is a very good intervention that there is appetite for bond market. Just trying to look at a different, from different angle and taking what, like Samuel was also here in the morning session, what chairperson said that the youth wants to be where action is, right? And, when you see students sitting here, there are many times more students sitting outside and watching it on, video. They are going to be the future investors, right? And so my next question to Samuel, what is that investor perspective? How do you make this class of next generation to feel, yes, that investing in bond market is also equally remunerative as, being in any other sector? From investor perspective, like, how do you see it? Like,
no, before I answer that, let me just take the previous discussion a little forward. Of course, I agree with Pramodji. The volume of issuances in the market is very, very high. In the last 12 months, whatever data he gave. But if you look at the issuers, most of them are dominated by the financials, the NBFCs and the banks. It is not the manufacturing companies or really the infrastructure segment where bond market has to play a very, important role in financing that projects. That is yet to happen. So I think as practitioners, both as regulators and as industry, we should be conscious of how do we push infrastructure companies, infrastructure projects, SPVs. I'll not even call them companies, the special purpose vehicles which own an infrastructure asset, which have the right to toll an infrastructure assets. How do we push them to the market? Now, Tushar also mentioned about some of the measures which World Bank is already doing. I can say that after we were set up, we are hardly 15 months old in infrastructure financing, the latest creation by the Government of India. Having realized the importance of the bond market for infrastructure, we have taken up with the regulator, the Reserve Bank of India, because certain regulations are not very conducive for, let us say, a partial credit enhancement. Now, if you look at what is constraining this market for infrastructure companies, from the investor side, I'll touch upon the investor side also. If you look at the domestic investors in the bond market specifically, they cannot invest anything less than a AA. So it is only the AA and the AAA in which they can invest. Most of the infrastructure projects before stabilization or in the implementation phase may not get a AA rating. So is there a way where a partial credit enhancement can enhance the credit rating from an A to a AA? But if you really look at what RBI guidelines say, the capital requirement makes it very, very uncompetitive. If I have to price the capital allocated for that guarantee part, then the issuer will not find any economic sense in that. So we have already taken it up, and hopefully, I think there could be some tweak in the regulations, and we could see more issuers, even without diluting from the investor's perspective. Now, coming back to the investors, as I said, the domestic investors are constrained by some of these, and I think rightly so. SEBI and RBI are quite right, because these are the pension funds or the insurance funds, which cannot take very risky plays and risk customer money. But if we can diversify the pool beyond this, for instance, today, as we speak, I think NHAI, InvIT, and many other, because we are in the end of the financial year, the monetization program of the Government of India is coming to a close for this budget year. There are many taught assets. There are many InvITs which are raising money. Now, these are AAA rated. Because of the pooling of cash flows, and because cash flows are already stabilized, and there is, even if there is a problem, let's say in the roads leading from Haryana to Delhi because of farmer protests there, it will get compensated because this is a pool of assets, the same portfolio concept what we as students learn. So these are AAA despite challenges in certain sectors of the road. So why not open it up or promote it more aggressively to public investors? So this is one thing I think we need to move with that. And even if you look at the bond market, there is one bond ETF, I think Bharat Bond ETF or so. Can we have similar ETFs for the bonds of private corporate bonds, infrastructure bonds specifically? So this will pull in more investment into this. So coming specifically to your question on what is investor perceptions, some of these regulated entities like pension funds, insurance funds have their own challenges, but I think they have very long-term capital available with them, and hence they should be able to deploy. Coming to international investors, because today most of the infrastructure assets in particular are owned by foreign companies which plow back their insurance money, pension money. Canadians are very large players here. GIC Singapore, Adia Abu Dhabi, Temasek, Macquarie Australia. There are so many funds today, Blackstones, BlackRocks, all of them have invested billions of dollars in the infrastructure segment in our country. They are quite bullish because this cash flows which come give them a very, very steady return. And the returns, what they can earn in our market, in the Indian market, is far higher than what they can earn in their home countries. So the perception is very strong. But what can we do more to attract this in order to make the investor perception more conducive to attract more capital? I think we should be very, very sensitive to, see, in a PPP or in infrastructure projects, it is the government which is your counterparty. Today, there is a lot of comfort with the central government agencies or central government authorities. But when it comes to state government authorities, the next level of our government, even if there is an annuity or a ham from a state entity, there are a lot of questions whether state governments will do that. Now, as urbanization moves to the next level and more Indians migrate to cities, there will be a lot of urban infrastructure required. In fact, in the first session, inaugural session, Chairperson SEBI also mentioned about the municipal bonds. There are 60 odd municipalities which are in the 1 million plus population category today. A lot of urban infrastructure will have to be done by urban local bodies. But you ask even a promoter-driven Indian company to deal with the municipality, there is a lot of hesitation. Leave the foreigners. Even Indian promoter-driven entities hesitate to deal with municipalities. For instance, today a lot of concession PPP agreements are happening in the municipal waste to energy. But day in, day out, you have to be, the supply of waste comes from the municipality. So people are afraid. So unless the reforms go to the second level of government and the third level of government, which is the urban local bodies, we will see if we are able to get traction there. In fact, very concerted efforts are happening to push reforms at the urban local bodies level. There is one scheme called the Amrut scheme, where the government is incentivizing reforms in accounting, what the urban local bodies do in transparency, and hand-holding them in their concession agreements, what they do. So if we are able to get that, I think then to a large extent, the investor perception about financing infrastructure in our country will improve for the better.
Yeah, thank you, Samuel. I mean, you mentioned a very good point about municipal bond and Amrut scheme. I'll come to Pramod a little later. But maybe Tushar, you have something to add to what Samuel have said?
Yeah, thank you. So I think the investor perspective is also evolving very exponentially, not just in India, but all over the world. Samuel mentioned about credit enhancement. In a nutshell, I think there is this scope to develop the risk sharing instruments in the country. Risk sharing in the sense which allows multiple parties to distribute risk among themselves, so that they are able to meet their investment objectives, they are able to control risk on their books. And that's where I think Samuel was coming from. And we believe it's a very important instrument to, socialize, popularize, and scale up in India. But everything is not only about finance, and that's where I want to spend maybe next 2 minutes on. I am a financial sector specialist, but I think it has a lot to do many times with non-financial aspects as well. So what are these aspects? One, I think, what about the pipeline of projects? In 2020, if I remember correctly, India launched the National Infrastructure Pipeline, right? And I think it was a step in right direction, where projects worth 1.4, $1.5 trillion were put online. Investors started having access to the information that they need on these projects. I think these sort of initiatives need to scale up, keeping in light the changing needs of investors that have happened. So can we, for example, in the pipeline information that we share to investors, can we incorporate gender elements? Can we incorporate climate elements? So imagine every project having information on the climate impact of that project, every project having information on the gender impact of that project. I think with growing class of ESG investors globally, this is the kind of information they would like to have purview to, if they really consider making decisions into the long-term space. So this is one. Secondly, I think in many areas, there is capacity building required, not just from the perspective of investors, but also, intermediaries in between the entire, people who are supporting on the consulting side, project preparation side. So you need to have the right kind of capacity to prepare the right kind of projects and to ensure that the investors feel comfortable investing with you. So Samuel talked about the municipalities in the country, for example. So I think there's a need to scale up capacity building initiatives there, maybe proper accounting manuals, maybe some trainings on governance aspects, so that investors feel comfortable that they have the right capacity wherever they are investing in, right, in the institutions. So this is number two. And number three, I think in general, there is the scope to develop more innovative instruments. Sharing, credit enhancement is one, but I think there are some more instruments and some more frameworks which could be considered for India. Covered bonds, for example, is one big space which I think there's lack of a framework in the country, but Europe is a great success story on this front, where they've been able to, with a proper framework, with proper legislations, they've been able to use covered bond as an instrument, especially in the mortgage sector. So I think these innovative instruments can be scaled up along with the non-financing elements to attract the investors at the right scale in this sector.
Thank you, Tushar. Now I come back to you, Pramod. Pramod has done a lot of work on InvIT rate municipal bonds, like what Samuel mentioned about the how municipal bond can be very useful, but it is probably have a lot of challenges. And he also mentioned Amrut scheme. So just to tell the audience, Amrut scheme is a scheme of central government. It's an acronym for Atal Mission for Rejuvenation of Urban Transformation. So you in SEBI are doing a lot of work to promote these instruments like InvIT, rate, and municipal bond. So maybe you can share your experience that how these are, what are you doing to make them popular, and what are the challenges you are facing? And then maybe I can go to Matthews, because he is the one who is actually, even today, I think he is busy because he is raising 5,000 crore on his InvIT today, right? So he's monitoring ki kitna aage hai abhi tak. So, right. So ultimately, then what you are doing is SEBI, and then maybe we will hear from Matthews that whether the steps that you are taking are going to be useful. So first over to you, Pramod.
Thank you. Thank you, sir. I think quite a lot of interesting points both Samuel made and Tushar made, and I'll try and build on them. So indeed, the bond market, just to sort of close out that, is indeed AA and above. And as Samuel said, maybe a lot more of banks and NBFCs which raise bonds rather than anything. But I don't take that negatively at all. I think when they raise these bonds, they go onward and lend. And to my mind, if that end use is ending up in infrastructure, I think that is good. And maybe we don't account for it that way, but that is what also is happening. I think the other thing which we should not neglect is the growth of what I call private credit funds. So just like the bond market has evolved to being AA and above, the private credit is actually hunting for credit, which is actually below that. And to my mind, again, in India, we are seeing maybe about $10–15 billion, which has got mobilized in the last few years, dedicated to private credit. So to my mind, again, that money is coming in and going to support maybe infrastructure at the greenfield, brownfield level. But I'll shift gears to what you also touched upon, Samuel, which was urban infrastructure. For the last, I think, 14–15 months, SEBI has been doing outreach programs to municipalities, and we've touched probably close to 200–250 municipalities, promoting the concept of both tapping the markets, whether through market borrowings or through municipal bond issuances. And increasingly, because of their what I call fractured balance sheet, we've actually been telling them that they are also capable of raising REITs and InvITs. If they have revenue generating assets, maybe they don't need to leverage, they can actually monetize and put those assets into REITs and InvITs. It has been slow movement, sir. I think there are 2–3 reasons for it. They are woefully behind in their accounting. They have got good accounting manuals and so on, but the actual process of publishing latest financial statements, I think takes quite a lot of burden. The capital market process also is grueling. We expect a disclosure document. We expect a lot of information being put there. The kind of information and due diligence which is required, again, consumes time for them because they are not habitual market issuers. Somebody like a Matthew is probably coming to the market for the 4th or 5th time. And I'm sure by the time the second time they did it, it became easier. And right now he can sit on a panel, even though he's the CFO, and not worry about it because, now the system is taken over. And I think that is what happens when you become a frequent issuer. And to me, these are first-time issuers. They've never come to the market at all. So getting them up to speed is really where we have been spending quite a lot of time. Equally from the ministry side, and both as administrators of Amrut 1 and 2, MOVA has actually put interesting subsidies and incentives on the table. So for the first 100–200 crores that gets issued by a municipality, they actually say that we will give you 13+13 crores as incentive, which you will receive as soon as you issue the bonds. This brings down the effective cost of raising finances for them. The second thing which they have said is the next 200, if you issue as green bonds, green municipal bonds, there is another set of incentive which follows. To my mind, with the policymakers, with the regulators sort of all signaling that there is this opportunity for the urban infrastructure to be developed by municipalities, there is a huge opportunity. But I agree with Tushar. I think, I would again say maybe the top 25–50 municipalities can come and tap the markets on their own. We have urban local bodies, which the count reaches almost 5,000 if I was just to count urban local bodies and municipalities. If I count census towns, there will be another 3,000. So we are talking 8,000 of such, urban local bodies which exist. They are much smaller. Their needs also will be much smaller. We need evolution of pooled finance structures. We need, more innovation to sort of make sure that they can also tap the markets. Or if at least the bigger ones have, then maybe the flow of the government grants, whether from center or state, can flow to the smaller ones. But I think there is this interesting opportunity. And to me, I think the chairperson mentioned that utilizing REITs and InvITs, we might be able to achieve 1x of GDP. My belief is municipalities can do this on their own if they really put their mind to it. So that's really the scale which lies there.
Actually, the last point you hit the nail on the head, because municipalities, see, the main thing is corporate governance and having a setup to ensure that you are able to. One thing which Pramodji also mentioned is the initial disclosures required. Besides the initial disclosures, a lot of continuing disclosures are required, which I don't think they are equipped to. So can we think of a alternate framework is what we should think of. Can we think of, let's say, a few municipalities get together, appoint a person, he runs the whole thing. But the biggest problem we are seeing and the bugbear is that they're not happy sharing, between one, okay, he will know about mine. And I mean, there's a lot of, a lot of politics also involved. So that is there. But yes, if the municipalities get together, I mean, there's a lot we can do, and I mean, they could do. Yeah, but then again, to address the elephant in the room, see, if a retail investor comes into a bond, I'm saying a simple structure like a NCD. The biggest challenge they have is one, the liquidity. How do we address the liquidity concerns? Because see, these instruments are not, if I may say, very frequently traded. And if you want to sell it, whom do you need to have there are so many instruments out there in the market. Most of the people who buy these instruments are, let's say, corporates. And corporates, they don't want the small traded. They want bulk amount. So can we have a mechanism whereby there are something like a primary dealer who buys small lots, aggregates it, but then they should have their, I mean, a lot of thought should go into it, because at what price? Because they should get into it. Okay, they should get into it, buy it, aggregate it, and sell it. They should also make a profit. So that is the next major issue. Now coming to municipal bonds, and one of the things, yes, they could even do an InvIT, but it should not be too small, because see, any of these foreign investors or any investor for the matter, if it's too small, it could be a risk by itself. And I don't want it to be too big, something which is too big to fail. But yes, you should have a reasonable size to even attract foreign investors. The other thing, just in closing, I'd like to mention is, see, the advantage for corporates, just take a mutual fund. Now, if they buy a unit of InvIT, there is no, I mean, and investors are buying from them. The investors don't get taxed. Whereas if they come directly, they are taxed. So, I mean, a lot of things could be thought of in the taxation aspect also.
I'm just tempted because there are so many things to unpack, but very quickly, I think one of our big sort of achievements in the last 6-8 months has been the creation of a repo clearing for corporate bonds. To my mind, the next natural extension is extending that to municipal bonds for sure that have got issued. Because indeed, this liquidity, this ability to sort of do, I think is quite important for the market, for the investors. The other, which is our own dream, which we have been chasing and looking for ideas around the room, is about how to introduce market making into corporate bonds. I think the minute we have two-way codes and this ability for an investor to know when I need the liquidity will be available, I think will be a game changer for the next peak which we need to sort of scale. But yes, that I just wanted to.
Yeah, so Matthews referred to taxation part. Being a ex-taxman, I can't stop myself. So I was supposed to only ask question, but let me respond to his suggestions. Our tax policy view is clear that instrument should stand on its own feet, not driven by tax concession. I think that's the tax policy which the government has been following. This government has been following for years. And I mean, so basically, whatever we are discussing, very useful points have come, how to make infrastructure financing very attractive. And before I go to audience for the questions, because we still have 15 minutes, maybe to summarize whatever little each one of the four speakers want to say about global trend, about what is the future for India, what are the learnings for India, whatever you want to say in a very short summary, one by one. So let's start from you, Pramod.
Thank you, sir. So, I wanted to lay two data points. Like I said, municipal bonds, we have started planting the seeds. But REIT and InvIT, which started maybe as a regulatory framework 10 years back, and traction came in the last couple of years. Just on an aggregated AUM of all the existing REITs and InvITs is close to now 4 lakh crores. And again, it is now less than 30 entities which have contributed to this AUM of 4 lakh crores. I just want you to have an image now in your mind of that 4 lakh crores, because this is the total assets under management of the entire AIF market, right? Which is closer to about 900 or 1200 or so AIFs that operate. That's the scale that REITs and InvITs have achieved in the last few years. And to my mind, we have barely got started. The government's monetization plan can also harness InvITs. To my mind, that can go places. We talked about state governments, which are less sophisticated. Maybe they can also come into all of this. So to my mind, indeed, I look at it as a greenfield opportunity, whether for young practitioners, academics to look at how this area is evolving. But that's where we are at the point in time in this country. Thank you.
Thank you, Sir Samuel.
If you ask for my opinion in one word, what it is to finance infrastructure, what is the future of financing infrastructure, I think we should go back to our basics. Most of these forums, we come back to that same point, enforceability of contracts. Especially in infrastructure, since we are dealing with the public-private partnerships, and one side you have the government. If the government is seen as going back on its commitment, I think that perception still lingers on despite years of reforms. That perception that governments could renegotiate a power purchase agreement even after it is signed. To a large extent, center, it's not happening, but in the states, even today, there is a tendency to reopen contracts, concession agreements given earlier. So I think if we get that part right to a large extent, it's done.
Yes, Tushar.
I can conclude by maybe, presenting a fun fact for the audience. I think I think everybody is glad that India is recently being included in the global bond index, right? So JP Morgan and Bloomberg, they've well informed everyone that India over time would get some certain weight in the overall global bond index. Now, if you look at the initial calculations that are coming from the market experts, they're saying around 50,000 crores of money could come into India every year if this actually materialize, if this inclusion is successful, right? If that is the amount of money that is coming in, it means the private investors locally who are until now investing in safe haven assets and GSECs and SDLs would actually have to think about other avenues of investments, right? And what can be that other avenue better than infrastructure sector, right? You incorporate climate into it, you incorporate a gender lens into it, and it becomes a very attractive avenue if you are able to structure the right kind of deals. So if we really have to take advantage of that 50,000 crores, which will get free up, and if you want to mobilize private investors, using that money, I think there's this huge opportunity that lies in front of the country. We have discussed about new innovative instruments which will have to be mobilized for that. We have talked about, capacity building measures, non-financing elements like project preparation, having a good pipeline. All these would be a bundled, I think, initiative. It will not be only about finance. It would not be only about real economy issues. Everything will have to be brought together to, really tap onto that opportunity. Thank you.
Thank you. Matthews.
So thank you. I get to say the last word after you discuss, but that's good. See, in conclusion, just one thing. This has always been my pet peeve. In all infrastructure financing forums, we talk of infrastructure financing. But what does infrastructure require? Just look what's happening in Bangalore. No water. Do we all have to wait for the date we don't get water and then start crying about it? We are always concentrating roads. Why? We have a good concession framework. Isn't it high time we put a good concession framework for water, desalination plants, whatever, or rather wait for the day when things go awry and then start crying, government is not doing anything. I mean, there's only a limit which the government can do. No? Thank you. Just a closing thought.
Yeah, thank you. Thank you so much. And thank you all 4 of you, but your job is still not over because we still have 10 minutes left and we have audiences who will like to put some challenging questions to you. Yeah, here is that first one. Just mic, please.
Good afternoon.
I am an ex-banker, now in academics. I am a professor now in Amity University. My name is Anita Kohli. Somewhere, you people mentioned enforceability of a contract being a very big challenge. And you also mentioned politics in case of municipalities, etc. On the other hand, you mentioned why not dilute certain requirements. I'm probably mixing my own idealism into it. But even if it takes just a wee bit more, why don't we help the municipalities to come up the governance curve so that we get it right and we don't kind of, in a hurried up game, we kind of, do it the wrong way. So especially since we're talking so much of ESG, etc., since morning and sustainability. And yes, we want everything to happen quickly. And for infrastructure, money is needed, funding is needed. But since you people did talk about some very good products like credit enhancement and cash flows, etc., which is there. So to my mind, what is missing is governance, audit governance capability, however you want to say it, and separating politics from the governance.
I think excellent point. So I just want to clarify. I think it's the issuer hat which Matthew was wearing, where he said make it easier. It's not the regulator's view. It's not the regulator's view. We look at it. If I can complete, I heard your point. I'll just complete. Yes. So our intervention around municipal corporations issuing municipal bonds has been seen as an opportunity for them to upgrade their governance, to upgrade their MIS and their accounts. So we don't see it as that they require concessions at all. In fact, the strong message we give in our outreach programs is, this is your one opportunity to diversify your own sources of funding. Because today, if you are dependent on just state government grants and central government grants, and some of them are committed developments, and also own revenues, here is one more opportunity to come to the markets. So that's the message we carry to them when we go. So it is a responsible issuer, which will lead to responsible investing. So that I just wanted to reassure.
Right. Yes. Next. Please introduce her.
Yeah, my name is Deena Mehta. I'm a stockbroker for almost 4 decades. This discussion on bonds every few years, suddenly regulator feels we should have more bonds, and these discussions keep happening. But what I have, I tried to implement similar scheme for GSECs also in Bombay Stock Exchange. So what I have seen is that one major thing which is missing in not one but 2 things. One is market making. If you want retail investors and all others to participate, then like in case of SME listing, we used to have compulsory market makers. Similar mechanism is required over here. So every bond issue that comes, if you want retail participation, there must be a designated market maker, and that market maker should be suitably incentivized, so that they are making the market right up to the entire period of the bond. So, you don't have it in just 1 year, but if it's a 5-year bond, entire 5 years, we should have market making. So that I think is something which we have not addressed in a big way. And the second thing is about the issuance of the instrument. Today what happens is RBI has its own depository, which is the DBO, which is the debt market of whatever it is called. Whereas if you look at the depositories which are there, that is the NSDL and CDSL, there is hardly any interoperability between these 2 institutions. And if the municipal bonds and other bonds, they are going to be issued under the framework of Reserve Bank of India or as a government security, then government securities interoperability is missing with NSDL and CDSL. So this issue also needs to be addressed, that either you bring the debt office of RBI under the custodian regulation, that is the depository regulations. So all the 3 institutions, they are interoperable, and it becomes very easy for the investors, wherever they buy the instrument, people are all used to CDSL and NSDL. If it is part of that framework, then it will work. So, these two things have been missing for a long, long time. And every time, we all get into this, let us have bonds. But unless and until, we have safety, liquidity, returns. So returns, the people expect that it's a fixed income instrument. It will be little bit better than or something closer to bank deposits or fixed deposit. Safety, of course, it's government is guaranteeing, so it's not there. But liquidity is very, very important. So that is one big thing that we are missing out whenever we have these discussions. So I think all of you are involved in policy making. This is something that will need to be addressed to have a successful bond market. Thank you.
Thank you. Thank you for your input, ma'am. Any student, anybody who has any question, we'd love to hear from you. Please. Okay. Yes, there.
Good afternoon, panel. I am Anshul Agarwal, a student of Nasimundi Institute of Management Studies. First, I would like to apologize if my question would not be valid for this forum. But yeah, as we all here got an idea of how the regulators are playing their role, how the exchanges are playing their role, and how different bodies are playing their role in this sustained capital formation and promotion of different types of bonds. I would like to ask that me as a student, or rather we as a group of students, how can we contribute to all the limitations that you have put forward, and also like how can we contribute to the growth of the Indian scenarios, and is there any business opportunity that we can basically try and explore considering all the promotion of the different bonds and the limitations that you have put forward?
Very good question. Who wants to answer? Business opportunity. Yes.
So there was a good question, and there was an answer in one of the audience question itself. See, and that's what we've been telling. See, most of the municipalities don't have their functions act together. Set up something which can help 2-3 municipalities put their act together. You can learn from anybody from here would be happy to help you. Okay. Set up an institute like,
Yeah, I even thought of a consulting for
about 5 or
accounting.
6. Once you show a success that you are able to help 5-6 municipalities put their act together, definitely that itself is a business opportunity.
So I can tell you, and I have seen it myself because I have seen some people close to me associated, IIT graduates, they worked on startup, helping parliament, members of parliament to do good projects in their constituency as a startup. And now you must have also heard that there are similar group of intellectual students after graduating from their institutes are helping political parties to spend their money in a particular direction, which is more useful and convey the message. So I think what Matthews is saying that this is a business opportunity. How can you, this could be also be your startup. How could you help municipalities to have better governance? What one of the intervention over said, so you see, once again, these ideas will come to you, not to us. You are the future.
Thank you, sir. Got it.
Hello, sir. Hello, sir.
Okay, last question. Okay,
Yeah.
because we are close to the time. Last question. Okay, yes.
In last decade or so, we have seen that.
Please introduce yourself.
Yeah, myself, Ashutosh Sharma. I am a banker in Punjab National Bank. So in last decade or so, we have seen that in India, infrastructure financing is heavy lifting is done by public sector banks. So what role do you see of PSBs going forward in terms of infrastructure finance?
Long-term infrastructure financing per se is long-term financing. And public sector banks have been doing it mostly because most of the private sector banks have moved to a complete retail model. Public sector still maintains a mix of a retail and a corporate or a long-term model. But going forward, if you ask, it should not be a major part of bank lending at all, infrastructure per se, because of the asset liability mismatches, what was already discussed about. But if you also look at from the issuer perspective or from the project owning company concessionaire perspective, see, most of their cash flows are fixed in nature. If you look at, let's say, a solar power project, their PPAs are signed for 25 years and it is fixed. Now, what happens if they borrow with a floating rate? A commercial bank, public sector or private sector lends with a floating rate linked to their MCLR. And in the last 2 years, we have seen when rates went up by 200%, equity returns have been wiped out. Of course, there is no stress in servicing the debt component, but the equity returns have been wiped out. Had these projects funded through the bond market or through fixed interest rate instruments, then I think this is where even developers, project developers are making a major mistake. Apart from the asset liability mismatches from the bank's perspective, even the concessionaire or the project developer's perspective, it makes sense to borrow fixed term. And this is where I think a major part should move to the bond market or to other fixed rate investments.
Thank you, friend. It was very, I mean, in spite of being an afternoon session, I must compliment all the 4 speakers for such an enlightening discussion and an active participation from all of you. Thank you very much. Thank you.
Can I ask one question, please? We have been talking about this bond market for the last 2.5 decades. As far as infrastructure funding is concerned, the largest investor in India is EPFO. They have the wherewithal to invest in long-term bonds. Unfortunately, they don't go beyond AAA. One tiny default of DHFL, which is less than 1% of their mammoth asset book, has prompted them to stop. So how do we galvanize interest from these kind of large investors, which really brings liquidity to the market?
I think 2 sort of comments, very quick ones. One, all pension funds, including EPFO and also insurance companies, by mandate have to necessarily put their money in AA and above. I think that point was made also by Samuel and Tushar. I think the desire is not that they bring down that level of where they are investing, but it is to take up issuers through the partial credit enhancement that both Samuel and Tushar touched upon. If that comes to pass, we will have issuers who fulfill that criteria, and then those funds can also get deployed. But if you are at a greenfield, which is just broken ground, you can never be AAA, you can never be AA. That is a reality we recognize. That is why we are saying that there needs to be these opportunities of either sponsor getting to recycle. We talked about InvIT as a method. We talked about how bonds with credit enhancement can be offered and so on. And private credit funds that I mentioned. So these are how we sort of see it.
Thank you. Thank you very much.
Sir, I'll just ask you to give for the quiz winner, a small memento for the quiz winner.
Yes.
Anshul Agarwal, I think, yeah, you are there in this. Please approach the dais, yeah. Yeah.
Looking forward to the
Yeah.
opportunity. Very nice, very nice.
Yeah. Please come to here. Yeah.
Thank you. Thank you.
So now I would request you to give a small memento to all the panelists.
Okay, sure.
Yeah. सर को भी तो देना, सबको देना, पता चल रहा है. May I now request Lata Chari ma'am to give a small memento to our moderator? And I'll now request Tirthankar sir to be ready for the small memento from NSE side.
Oh, okay. Oh, the bell. Yes. You are in an exchange of. Yeah, thank you. Thank you very much. This is lovely. Thank you. Thank you very much.
Yeah, I invite everybody to join for tea now. We'll start the next session at 4 p.m. Huh? Good evening, everyone. Welcome back to the panel discussion 4 after a good tea break. So now I'll introduce my moderator for the session. The session is, I think, widely discussed in the inaugural session. We had covered most of it in the inaugural session. It is moving from savers to investors. It is to be said to be our focus is for this session mostly on financial literacy, capacity building, financial inclusion, and risk. So our moderator for this session is Mr. Ashwini Bhatia. He's the whole-time member of SEBI. He joined SEBI in June 2022. Prior to joining SEBI, sir has a wide experience of spanning more than 3.5 decades with the State Bank Group. Prior to joining SEBI, sir was the MD and CEO of SBI Mutual Funds. Now I'll introduce my panelists for the session. Our first panelist is Mr. Neeraj Chokshi. He's the co-founder and promoter of NJ India Invest Private Limited. Sir has an experience of almost 2 decades, and he's a very well-known face in the distributor markets of securities markets. Currently, sir is also a member of the SEBI's Mutual Fund Advisory Committee. Apart from the Mutual Fund Advisory Committee, sir is also a member of several other working groups and committees of SEBI. Now I'll introduce my next panelist, Karthik Rangappa. He's the Chief of Education at Zerodha Varsity. Karthik has more than 2 decades of experience in Indian capital markets. He's the head of education and market research at Zerodha and has created the educational initiative of Zerodha, which is the Zerodha Varsity. Our next panelist is Mr. T. Koshi. He's the MD and CEO of ONDC. ONDC is Open Network for Digital Commerce. It's a first of its kind initiative globally to democratize e-commerce in India. Sir has a wide, rich professional experience. He's a IIM Bangalore alumnus, and he has been part of the founding team of NSDL, and has also served as the executive director at NSDL. Sir has also been a pioneer in digital ID and social protection initiatives and has played a leadership role in many implementation and consulting projects globally, including the UID project. Our next panelist is kind of a well-known face for many of us. So I'll welcome Sumaira Abidi. She is the Vice President at SBI Mutual Funds for PR and Investor Connect. Prior to that, we all know Sumaira ma'am from her days as business journalist with CNBC TV 18. I'll welcome all of the panelists and the moderator to please join the dais. Before we delve into the discussions for the panel, we'll have a small fun quiz as we had in the previous session. So I'll just ask everyone who's interested in participating to please scan this code and enter their name. And of course, the rules are the same. The fastest finger first wins the quiz. So we'll start the quiz in some time. We have seen people joining in. We'll start with the first question of the quiz. Mixed answers for this one. The next question will go live in this. The next question now. Again, mixed answers for this one. The right answer is the least, almost least amount of answers. Now let's check. So we have, was a very tough quiz, and our winner is Samrat Jadhav. I will request him to please come to the dais at least 10 minutes before the panel discussion concludes. Thank you. Now I'll just invite everybody to please.
So
We'll start the panel discussion now. Yes.
a very good evening to all of you and welcome to the panelists. Last week I was at an IIT, and generally I ask when I start my sessions, and these are on financial literacy and education and investments. The first question that I ask is, anybody in this room who does not have a savings bank account, raise your hand. Is there any such person here? So great, all of us are savers, right? Now in this room, is there anyone who does not have a folio or a demat account? 1, 2, 3, 4. Okay, so everyone is a saver, but everyone is not an investor. And that is our subject this evening. But I find it surprising. And my next question is, how do you buy coffee? And they say we buy it through a UPI. Who loads your account? I don't have an account. My father's account is what I use, right? And what if you buy a share instead of a coffee? No answer. So I think we'll try to tackle a few things here. And I'm delighted to have this panel this evening. I think we'll start with Neeraj. Neeraj, of course, is a veteran and India's arguably one of the largest distributors in the mutual fund industry. So Neeraj, what exactly has changed? So from 2013 to 2023, or till February 2024, we today have an AUM of 54 lakhs. In 2013, we were at 8. What has changed and why are people getting into the market and investing?
Yeah, I think if we look at the mutual fund landscape, one, obviously, the corporate performance has been good. Secondly, the kind of products which has been sold and the effort made by the industry is mainly SIPs. And generally, SIP is a vehicle of investment where you manage your risk on its own. Normally, what happens that investment happens with a lot of emotions. There is a lot of behavior into it. So when the markets are rising, we have seen in the past also, people tend to invest more. The perception of risk changes. The reality is different while the perception is different. So when you promote instruments like SIPs, you are managing the risk, and the experience of the customers is quite good because of that. So more and more people have started, distributors have started talking about SIPs. The mutual fund Sahi Hai campaign, more and more AMCs have been talking about SIPs at various forums. So that culture has started getting into. When you ask a common man, sometimes they are not aware that what is whether the mutual fund or SIP is same or different, but they know that SIP is good. So that's the kind of thing which has happened. And today, if we see close to 19,000 crores of SIP monthly collection we've seen in last month, it has crossed 19,000 crores. Now, the dependence which was there on FIIs, that has completely gone down. If you look at the January and February numbers, the FPI has been negative. In January, it was negative 25,000 crores vis-a-vis the domestic DII's numbers are positive, and a large component is getting contributed through the SIP. So I think it is very, very important to reach. Still, a lot of financial inclusion has to happen. But I think people have reached and advocated the right products, made them invest through SIP, and that is why their experience is good. Unlike otherwise, normally the retail investors invest at peak and get out at the bottom, and the experience is not good, and that is why they always curse the market. And then we see that the investor returns and the market return, there is a gap. But if you look at the data currently, I think there's been a good experience, and probably that could be one of the reasons that we're getting good growth.
So this morning, one of the speakers, he mentioned a ratio, and that ratio was that the mutual fund is at about 26% of banking deposits. And he predicted that within 5 years, this will double and will be half of banking. Is that a fair assessment?
Yes, I think that is a very fair assessment, because
is looking at. Finally, they want a meaningful investment opportunity. From both this dimension, the impact something like this network is going to have is humongous in the coming years.
So, I mean, if we talk about products, savings bank is a standard product. Current account is a standard product. PPF is a standard product. You could be looking at, is it an ETF? Is it an index fund? Or, any thought around that?
No, we have, like I said, see, if it is very standardized product, then it is easy for people to make investment and so. But so long as something that can be a catalog, it could be even a complex product, but the kind of participation will be different. So, and the point that I'm saying is, in this network, if you can catalog it, it can be available in the network. But the way that is there to extend the reach, complex product will not work for that small investor. So that will what will extend the reach and the possibilities for even complex products. That is.
Sumera, to you. So you've been a TV anchor, and you've extensively covered the mutual fund industry. And now you're on the other side, right? So how do you think you've made that transition? And how do you think going forward, will the mutual fund industry grow, especially in tier 3, tier 4? And what is happening on financialization? Take us through maybe the RBI numbers and so on and so forth, so that we get a sense that what is the opportunity like.
Okay, so thank you very much for having me here. My own transition is, I don't even know why and how it happened, but it did. And I guess it was just the time and place for it. But in terms of what is happening is that, the number of direct investors is increasing. So even if we see the new funds which we are launching, with every fund, we see an increased proportion of people who are investing directly. Now, these are people, who we cannot communicate with directly. Their behavior is cannot be controlled. It cannot be predicted. So how do you reach out to people like this? If somebody was to say, go through a distributor, the distributor can guide them and say, this is your risk profile. Is this product suitable for you, or does it fit in your portfolio? But as a direct investor who's coming in, there is nobody who's reaching out there. How do you do the follow-up with that person? So there is a lot of work that needs to be done in that area, which is primarily what I'm aiming to do, is to create some sort of communication where we are able to reach, investors like that. In terms of what is happening in financial inclusion, see, as of now, SBI Mutual Fund is covering 97% PIN codes in the country. So there is a tremendous reach that is already there. But despite that, there is a lot of, you need more feet on the ground, so like Mr. Choksi will also tell you that despite the kind of growth that they have seen, I think it's only the of the iceberg, right? There's a lot more that we can do in terms of financialization. One of the main things is that, even because there is so much of these Ponzi schemes that you see in these tier 2, tier 3 cities and beyond, that there is a lot of mistrust has been created, okay, about anyone who goes to them and says that this is an investment product. A lot of them may still prefer to invest in the Ponzi scheme because that person is known to them. So that is the whole way they operate. So there is a lot of education that is needed in the language that they understand about where things are different and how much growth has been made in terms of making the industry transparent, making it more answerable, more reliable. So that message, I think, to a great extent, the industry has done a good job of doing. But of course, I think there's no end to how far we can take it or carry it.
So in one of your discussions, you had discussed wedding as an expense. Okay. Take us through that. How can that change?
So, what is happening is, and I'm sure everybody over here will agree. Okay, if not everybody, most people might agree that, if I was to ask you that, do you think you are financially prepared to meet all your goals? Everybody would be like, yes. But how many of you have actually calculated the number, put it next to the goal, right? So there are two goals which are unique to Asia and definitely to India. One is a child's education and the other is the child's wedding, not marriage, wedding, right? So abroad, most places you'd see that the primary education is whatever, state sponsored, and higher education, agar aapko college masters karna hai, you take a loan and you go. But in India, as parents, we cannot imagine कि हम अपने बच्चे को loan दिलवाएंगे. The other thing is the wedding, right? So soon after you finish paying for college, in a few years, you're paying for the child's wedding. And I don't think I have to tell anybody here how extravagant or how much inflation is there in both of these education and the cost of weddings. Forget that your child may want to do a startup and so on and so forth. But basically, we are not financially prepared. Everybody, the general mindset is कि मेरी 10,000 की SIP तो चल रही है. मगर 10,000 की SIP, is it equal to your goal? That is an exercise that, I'd urge more and more people to do, that unless we can invest and link it to our goals, the experience, which Mr. Choksi was saying, that the experience is good, that
we continued on those thoughts, and once you start getting a critical mass, I think that confidence will come. And then we thought that this simple idea, why can't we bring it to every household? And that's why it's thought of creating a B2B platform. And उस समय technology ने भी चालू किया. So I think the message for youngsters is you need to solve a problem rather than आजकल बच्चे लोगों को क्या के स्टार्टअप में फंड रेजिंग और उनको यूनिकॉर्न बनना. That should not be the purpose. The purpose should be what problem you want to solve. And we wanted to solve that problem, that we want to make India wealthy. I think wealth creation of customers. So वो thought पे we were just going and moving, and बहुत ही सारे mutual funds, they, when we were meeting them and understanding, so we realized that, yeah, this is something, and that experience is now there. If you look at the 20-25 year, 70% return in 1 year, it has a potential to fall 50-60% also in another year. And when that happens, that is the time where you need someone who will tell you that just don't worry, wait. I mean, this is, if you take a decision now, you will be completely out of the market. I don't think that by creating a technology or a platform that communication will happen. It is you to just sit with the customer, show him your statement, कि मैं भी आपके साथ में हूँ. And that's how I think that comfort when you give, even many a times people are very clear, but still they want someone to confirm कि मैं ये fund में लगा रहा हूँ, यहाँ लगा रहा हूँ, should I do it or not? I think even for that confirmation, it's not about the administrative part. That obviously has to be digital. That obviously has to be digital. But this piece, I think, which is most important, and that is where a distributor or an advisor has an important role to play. You can look at the US market. I think the advisors have been doing far, far better there. Irrespective of all the robo platforms or anything, it is the advisors who are driving the market. There was one study which was done by IFIC in Canada a few years back, where over a 15-year period, they had demonstrated that the investors who are DIY, do it your own, and those who are by an independent body there, and similar studies can be done here. I mean, SEBI and NISM can take that initiative. We have a 2013 say direct plan. You can just see what the direct plan returns, and through distributors, what is there. So whether that free differentiation is really making or the difference or not, one can come to know from that. But I think this is more related to behavior, and that's where someone is required to help you and take you through the troubling times. And that's why
the deposits with the banks. And these 204 lakh crores are residing in about 150 crore accounts, which is like the population of the country. A market capitalization of about 380 lakh crores, which is, I think, 1.1 or 1.2 times the GDP. And you have only about 5 crore unique demat accounts. How do you even touch 20 crores?
So I think this is where financial...
So I mean, what I'm trying to say is that wealth is not evenly distributed, you know.
Yeah.
It is still in the hands of a few.
True.
And tier 3, tier 4, I mean, if I call my dad, he'll say, beta, stay out of it.
Yeah.
Right.
No, I think this is where financial literacy plays a massive role. And financial literacy, like she was mentioning, has to be done, especially in tier 2, tier 3 city, has to be done in regional languages, right? So you can't really have a financial literacy initiative at scale and talk about capital markets in English. It has to be in regional languages. It has to be delivered by people belonging from the community. It has to be a large-scale effort. Only then can we see that the larger numbers can be met. And like Mr. Choksi was mentioning, advisor network is extremely important. Although I come from a direct distribution network, I think distribution is good. Direct distribution is good as long as a person knows what he or she is dealing with. And that's very small segment of society. For the larger masses, there has to be an advisor. There has to be someone who can handhold, because end of the day, making investments in capital markets is more about managing emotions, more about managing hope, greed, and fear. and for that, there has to be a human touch.
Example, the guy in a village who is doing assisted commerce can also help that person who comes to buy to give him a very standard product, so long as it has per the appropriate training, appropriate regulation, etc. is in place. So that's why I believe that such extended participation in the digital world, where commerce and finance come together, will have a humongous impact of extending the participation.
So, Sumera, we've talked about SIP and all. There's also been discussion on sachetization. And will it work?
Oh, yes. I was in Delhi recently and Guwahati, and a lot of people asked me that, for my domestic help, we want to start something, but they feel unable to even make that 500 rupee commitment. So can't they do it, 250 twice a month? So definitely, like, that chota packet, which used to sell very well, for sure. And, just one more thing I want to add when the question you asked, Karthik, about how can we increase the base. See, one is that, money is such a taboo in our families that by the time we start talking about financial inclusion, financial literacy, the person is already quite set in their ways, Why can we not have it included in family discussions? We should be telling our children about what is my philosophy, this whole thing around controversy around finfluencers. But that is because we as parents have vacated that space and we are not transmitting our money philosophy to our children directly, which is why they are having to go outside. A child, by the time they're 18, I mean, there are people I know who are at 18, 19, 20 who don't even know what are tax returns. I mean, they have no idea. The only thing they know is कि मुझे iPhone 14 खरीदना है. So, savers to investors, pehle we have to bring them from spenders to savers to investors. So, create that better circle. Sorry, I'm not being judgmental. It's just.
Yeah. So, I mean, in my case, for example, when I joined service in 1985, the first account, and there'll be many from the public sector here, our first saving instrument is actually a PF account. And a PF account is nothing but a SIP. And you do it month after month. You get promotions, you get increments, you get wage hikes. So after 2.5 years, my PF balance was 7,600 rupees, 2.5 years. And I started with 170 rupees. And when I retired, it was 1 CR plus. But the question is 1 CR enough? So Mr. Choksi, next question, what is enough?
So I think it will differ obviously from individual to individual and based on anyone's aspiration, but it's fairly easy to calculate because you can just calculate it on a financial calculator. You can put your needs, assume the inflation and assume the rates. If you get 4-5% over inflation in equity, investing in SIP. But Sumera was saying that people have had experience with a 10,000 SIP. Now, whether that 10,000 is adequate or not is something, a role of an advisor, a distributor, he can. And the moment you start talking about the goals that you want to save for retirement, you want to save for child's education, you want to save for child's marriage or wedding, then obviously you will come to know, yes, this is the money which you need to save. And that's why one will spend less and save more. So in our scheme of things, when we talk to customers, the equation is investment minus savings is expenses. It should not be investment minus expenses is savings. Otherwise, we will spend everything but you don't understand the power of compounding. And in the power of compounding, N has an exponential power. N is number of years. So the early you start saving, the more wealth you create. In Warren Buffett's 50 years of his career, his 80% of wealth came in the last 10 years. So I think that's what is going to make a difference. So one should start early. At an early age, when you start saving, your students are here, if you're getting pocket money, at least start saving something, 500 rupees, 1000 rupees, whatever is possible. And then you can see you will be able to, you are probably can do wonders going forward. The amount which will become will be just phenomenal. And I think what she was also mentioning, parents should encourage when the kids are young, in 7th standard, 8th standard, ask them कि आपके घर पे जब शादी में कोई आता है, बर्थडे पे पैसा देता है, उसमें से 200 रुपया, 500 रुपया, 1000 बचाओ. If you save 500, I'll put 500, and then show them that what that 1000 rupees has become. So that will inculcate a habits of saving and understanding. Actually, he'll see, yeah, this is what has happened. 4-5 years will just go, and then once you see, कि, oh, 5 साल में double हो गया, 5 साल में इतना हो गया. So that, I think these are the communication as an industry at large we have to make to the general masses, that this is what is required. And obviously, I think one, as the question is, what is enough, I think it will be different from individual to individual, and it can be easily calculated.
So my next question to Karthik and to Mr. Koshi. So the two assets that are predominant in the balance sheets of the Indian household, one is a home, residence, and second is gold. How do you get out of this? Number one, gold, and people, instead of one house, they have 1, 2, 3, 4. So how do you break that?
Actually, that's, I think, very closely related to your earlier question to Mr. Choksi, especially in terms of house, right? How much is enough? Morgul Housel, in his book, Psychology of Money, talks about this problem called moving goalpost, right? So, of course, you can use calculators. Of course, you can use a lot of tools that are available online and identify and put a precise number saying this should be enough for me. But the closer you reach to that point, you will start redefining your goals. The moment you own one house, maybe you would want to own another house, by the next area, in the next posh locality. So I think this is a human psychological problem rather than a mathematical problem. So defining your goal and sticking to that goal is extremely important, and not really moving away from that goal. So by the way, that book is highly recommended. If for people who've not read it, I would suggest you please pick up that book and read. And yeah, so moving goalposts should not be a problem for you when you are defining your aspirations and defining what is really enough for you. So, yeah.
Now you're getting me out of my comfort zone. But again, I'll say that from the context where I come from today, is that if you look at home, is about investment in home, is about protection. Investment in gold, of course, one is that my daughter has to have so much gold. I mean, that is one. But it all came from confidence of the asset as a saving instrument. And if something happens, they feel that it is something that will not. No, that will be there for me. So again, it's a question of gradually educating people about the alternate assets and the risk profile of it in comparison to the world where they come from. So, and when we have such standardized product, for example, if again, take the same example as why did everybody started using UPI? Because it was affordable, it started making sense. Today, many of this product, while there are good products and education available, that is for a certain class of the society. If you are able to take it to the broader participation, you have to make it contextual for them in terms of the return, in terms of risk, in terms of the cost, and in terms of this convenience, in terms of the recommendation coming from the people around them. So all these things become, when that become relevant, you would see more participation in that. That's why, like today, only thing we've touched the tip of the iceberg. When, as he explained, when Morgan Stanley and Mastergain, when it started, I think Morgan Stanley, when they came with the first one, there was a line of people trying to buy the mutual. They thought it's like magic instrument. Then there was also a letdown. But compared to, you yourself gave the numbers, compared to 13 years of the numbers has grown up. But that has grown up with the constraints of that is there. So when you remove those constraints, the growth can be much larger. And that is how I believe that this thing will change. And there's no magic for that.
Sumera, the final word is yours.
So, I'll tell you, I'll share one experience with you. About a few months ago, this relationship manager that we had told us this story, and he's like,
You need a relationship manager.
Sorry?
You need a relationship manager.
No, in SBI mutual fund.
Okay,
one of
SBI.
the no. So he said that मेरे client का phone आया and उन्होंने 50 लाख का investment किया हुआ था and suddenly he's saying कि मुझे redeem करना है. So he asked him कि क्या हो गया? Suddenly, ऐसे तो कोई पहले से indication नहीं था. So he then end में पता चला कि actually he needed just 7-8 lakhs, but he did not know that he could in mutual funds redeem partly because the investment prior to that has been with real estate, etc. Where अगर आपको 7-8 चाहिए तो आप एक bathroom तो नहीं बेच सकते, घर तो पूरा ही बेचना पड़ेगा. So that is the thing, that the amount of convenience and the amount of transparency that is there in financial instruments. While we have done a tremendous job of educating people about the many benefits, but I think what else can you do? The only answer to that is हमें चप्पल घिसनी पड़ेगी. So the only way is to have more people on the ground saying this day in and day out, and I think that is the only way things are going to move from here. One more thing, we talk about savers and investors as two exclusive groups. But actually, if you see, even within savers are people who would have money in FD, etc., right? But within savers, you have people who invest in corporate bonds. And to call them a saver is wrong because they have completely ignored the kind of credit risk that might be there. Within investors, you have people who might be exclusively investing in money market instruments. And therefore, they think that, "Arey, maine investment kiya hai." And which is where things go south, because the person with the savings mentality is investing in something which is of the same, perhaps, risk as an equity product. The person who is investing in a money market instrument is thinking कि मैंने invest किया है, but they will not have the same experience as an equity person. So even within savers and investors, there needs to be education on the down to the product level कि आप कहाँ invest कर रहे हैं और क्या आपको पता है कि इसमें क्या risk है, इसका क्या reward है, and is it worthwhile for you, is it suitable for you? वो जो suitability है, I think not enough people, किसी को mobile phone खरीदना होता है, they will check 10 models. When I wanted to buy a refrigerator, I went to 4 shops. But जब किसी को mutual fund या कोई भी खरीदना होता है, the first person who says, "Sir, ये बहुत अच्छा है, बस इसमें दे दो, हाँ ठीक है, 10 लाख, 20 लाख." जबकि fridge for 50-60,000, we are spending hours and hours debating and fighting with your spouse and whatnot. But 20-30-60 lakh का investment हम बिना सोचे कर देते हैं. So even the investor has to take accountability कि it is my money, and at the end I am accountable for ensuring that it is protected and it grows to beat inflation.
I'm just surprised no one has talked about the role of SEBI.
So SEBI has done such a tremendous job कि अब और क्या बोलूं?
I was waiting to hear that. Okay, I think now we'll throw it to the house. Your questions, please. Please identify yourselves, and your question is directed to which panelist?
So I'm Dr. Pankaj. I teach finance. So I don't know which panelist is best suited to answer this question. It's essentially behavioral question about Indian investing and trading. So of late, we have been seeing a surge in trading, which is short term, I mean, by definition, and a surge in mutual fund investing, SIPs, right, which is essentially long-term commitment of funds. Now, it is a little curious scenario where on one hand we have huge surge in trading, on the other hand we have an equivalent surge in mutual fund investing or long-term investing. So what does it tell us about the kind of investor sentiment that is prevailing in India? Are we having a fragmented market where there is a set of people who believe in trading and there's another set of people who believe in investing? Market is getting fragmented, or we are seeing, as some people call it, expansion of the financialization of savings? I mean, what is happening there? I wanted to understand. Thank you.
I think these are two completely different sets of people, different market spins. It's hard to put a number, but if I were to take a intelligent guess, I think the active trading community is largely the younger generation, participating in the markets. I don't know what's influencing them. It could be the influencer community that is prevailing on social media, who themselves are, in my opinion, not fully equipped to talk about capital markets, because the surge in influencers, especially, is post-COVID. So most of these people who are talking about products haven't really seen market cycles, right? And they've seen markets behaving, they've seen one-sided behavior of the markets. So I think, in my opinion, all the trading activity is coming from the younger lot. But at the same time, people with some amount of experience, especially post-COVID, have realized that building long-term wealth and creating a big corpus for the family is extremely important. And these are the set of people who are making those SIPs and contributing to this monthly 19,000 crore SIP book that Mr. Choksi was talking about. But yeah, I think it's two different fragments of market. Of course, fueled by the exuberance in the market.
So first of all, to all the panelists, thank you so much for the words of wisdom. And we have been grateful to hear from you guys. So, hello, am I audible? Yeah, sorry. So so my question, I mean, to the man himself, like Karthik sir, responsible for educating to all the new and budding finance enthusiasts like myself, and just for the people who are new into the finance sector. Zerodha Varsity, which is created by Karthik sir, it is the go-to platform for anyone pursuing or entering into the finance sector. So now my question prevails here is that since financial literacy is at talks, like blogs which are written for the awareness of all these financial activities and the learnings, so which has been written years ago and they are still valid, but this Gen Z generation, people do not take out time to read the textbook and college books. And so I think that reading blogs for personal finance or financial terms is a faraway dream, which I see. Although Varsity and Varsity 2.0 YouTube channels have helped a lot of people via YouTube to gain that knowledge. So my question is that being the largest and most successful broker, at least in my terms, does Zerodha feel the responsibility of creating a competitive environment or some competitions that might trigger the new wave of educating while competing model? And also to exclaim it a little bit more, even the 60 days challenge or 30 days challenge that were launched, those have also been discontinued. So what are your says on that?
Yeah, I think, firstly, thanks so much for the kind words about Varsity. Makes my day. I think there are regulations around competitions which prohibit, market intermediaries to offer them. So that's a different topic altogether. In terms of, the attention span that you were hinting at for the Gen Zs, what we've done is we've broken down concepts into bite-sized cards. In fact, that's what you will get if you download Varsity mobile app. Every topic, every nuance is broken down into bite-sized cards, and you can actually read them offline. You don't really need internet connection to use. You don't really need your 4G connection to use that particular app. So you can download that, and you can start consuming that content in a bite-sized manner. And you could be waiting for a bus, you could be waiting for a cab, and at your convenience, you can consume this content. And it's not lengthy, it's bite size, and easily understandable.
So sir, like as in the West, there are so many trading competitions which are being held, right? I mean, brokers or even the regulatory bodies coming up and holding these kinds of competition for the people to be participating even more into this. So is there something which is in the pipeline, or is
Yeah, so we do have certification programs, right? So wherein you take up quiz and leading to a certification program. So that's already available with us.
One of our panelists was speaking about the importance of the person one person when the market goes down, and he should say, no, I'm in the business. In fact, if you take out now, you will be in loss. They have to advise like that. Now, some time back, I audited one firm, one mutual fund, which was ranking out of this 35 numbers in a lower strata. Then the next year, after 2-3 years again, I went, when I saw they improved a lot in their rankings, I said, what magic you did? And he said, sir, we have opened a individually, हम लोगों को recruit करते हैं, और those that distribution channel, it is working fine. Earlier, we used to depend on institutional distribution. So mostly banking channels. So is there any study? Ultimately, if you want the financial savings, it is the person who is the comfort to the ultimate investor that this is the correct thing, this is the right way, and there one guide should be there. So whether the guide is the banking channels like are some those institutions or an individual who is better, because you are also saying the robo advisors are not performing so well when compared to a human being. So in that aspect, my point is who is better, and how do you think? What do you think about that?
So basically, that is what I was suggesting, that if a study is done, because now there is a history, we have direct plans which is there from 2013, and then distribution is also there. So if a study is done where actually one can look at the performance even within the distribution community, there are various category of distributors, advisors, there also the study can be done. As of now, I don't have any such statistics. We have done for our firm. We continue to do for our firm, and we make sure that our investors get real returns, and over a 10-year period, we got it audited from a very reputed firm as well. The median and average return is close to 12.3% for more than 300,000 customers for a span of 10 years, and for a span of 5 years for 1 million customers, again, it is in a similar range, irrespective of when they invested. So that is giving us a comfort that there has been an inflation of around 8%, approximately 4.5% higher returns we have been able to generate for the investors. But yes, it should be done at a larger level, which will help the investor to decide which channel or where, how he could select whether he should go directly. I think makes a lot of sense, a very, very valid point raised by you.
Sir, I'm Dr. Nirmala, professor from Bangalore University.
One thing I would like to share from morning, we had wonderful sessions. And from morning, we have been hearing about financial literacy and awareness. Has any corporate thought of setting up some centers in the universities? See, in Karnataka, we have 18 universities. Under Bangalore University, we have 285 colleges. If anybody can set up one center regarding this financial literacy, which is really doing very well all over the world, I'm sure this financial literacy will be excellent all over India. We have 18 universities. If at least in 18 universities, 3 universities, we can pick up region-wise and set up this kind of a centers from the corporates who are sitting here, I'm sure that this financial literacy will be covered all over India in no time. Have anybody thought of this?
Yeah.
Because I've
So-
been telling this. Even now, 2% is only aware of it. You take all over India, only 2% is aware. 98% still not aware. Again, as a dilemma, going into it, risk factor, everything is there. If these, even we have subjects again is conceptualized. We have no practicality. See, from morning I've been hearing, being a professor, I learned many things. But how many things are these things taught in the universities and to the students level? So if this is set up in the universities, I think all youngsters will be covered in this. I think that initiative, if we can think and then do it, it will be a great initiative from the corporates. Thank you.
Yeah, thank you so much, ma'am. I would just like to update that we are running a program called FLAP, which is Financial Literacy Awareness Program. And NISM is also doing a lot of work. So we are running this program with the universities and college students only. And in fact, so many colleges, I mean, in Gujarat, where our team regularly visits their team. Even they come for internship at our premises, and then we actually show them how the trading take place, how the KYC take place, and the basic things. So that already is there. Probably many other people, like I'm sure Zerodha must also be doing the similar thing. But that is happening, and you will see more and more of that happening. Even the regulator, everyone is making efforts towards that. If anything specific is there, certainly we can look at it.
But just to add, last year we touched close to about 400 colleges across the country, where, but these were largely to interact with the students and talk about capital markets in terms of workshops, etc. But yes, we don't have, we have not thought about setting up a center as such. Maybe there's something I'll take back and discuss internally and see what can be done.
So
to us.
centers, what will happen? You'll have a continuity.
True, I agree.
Now, what you people are doing is you just go 1 year, sometimes say exams are there, sometimes colleges call, sometimes. If you have centers, there is always a continuity throughout the existence of human being. I think that initiative corporates can think over. See, online also, there are a lot of rural children, sir. Not many rural children can afford this internet. And India, rural India is 98%. 2% is urbanite. So all these problems are faced. So if we can set up centers, continuity can go on and accessibility is easier.
Can we have the last question?
Yeah. Good evening, everyone. I am Professor Veena from Bharati Vidyapeeth Institute of Management, Navi Mumbai. My question is related to what ma'am is saying, or we can say my is basically the suggestion. Like we have seen the education system where the students are learning from 1st to 10th, then 2 years of college education, 3 years of graduation, right? And then after that, they start working. Most of them go into the service, right? So, but here, whenever everyone, we are talking about moving from savers to investors. Right? So all these people will be who are earning will be saving, but are they moving towards investment? Why not? Because we can see that irony of education system is everybody who is later on will be saving and has to invest, but nowhere a formal education is received to the students regarding what are shares or what is mutual fund. An engineer, a doctor even might not be knowing what is a share or these things. So the basic, what is my suggestion would be like the English subject or Hindi or Marathi is made compulsory, right? So like this, investor education also has to be one of the compulsory education.
So I
in
agree
the
with you.
system. Like
Please
that
also
can be
get
proposed.
please also get in touch with NISM. We can do partnerships, and we are eagerly looking to sign up with more universities. So
Yeah, what
this is
ma'am is saying about signing up with universities.
oh yes, it is possible. We have a program. I think is Ina Mehta.
Yeah. Hello.
So,
Shall I?
Okay. We'll have her question first, and then
Thank you, sir.
Okay. So one is, while we compliment SEBI on great things which have been done, but I feel that just 4 crore investor in 140 crore population to MF is a very pathetic number. And I feel that the entry gate into a mutual fund investor coming into the system is very difficult. You have to do eKYC, you have to do KRA, you have to do CKYC. And if you want to, trade on BSC Star, then you have something called a AOF, that is the account opening form. So 4 levels one has to pass through. And we have as high as 30% reject rate because either the paper cannot be read properly, something or the other. So I think these 4 levels that needs to be resolved. All these paperwork which you make us do, I think that is something investors need a relief on. If you have a bank account, just go and invest. Nothing else should be required. And number 2 is, about SEBI constantly reducing the commissions, which Neeraj Bhai talked about. And of course, we say it's good for investor. And as he rightly said, if we do a study of, investors coming directly, in fact, some of the schemes are also not available to the investors if you come on direct investment platform. And there are as many as 25,000 schemes. We have 6,000 shares, of which 2,000 are actively traded. But mutual fund schemes are 25,000. And without having, that last mile connectivity to the investor, I mean, who is going to serve the people and explain to them what either you cut down on the number of schemes and make it very easy, or, we have to incentivize the person, the feet on the street, as ma'am also talked about, so that, it is possible to reach out to people. And then, malpractices will be will be avoided. So because, people want to make money, so they'll advise, oh, you keep on switching the schemes. So these kind of malpractices will be avoided if we allow people to earn adequate returns into the scheme of things. So these are my 2-3 suggestions, sir.
SEBI has noted your feedback.
Thank you.
Yes, sir. I am BK Unhelkar. I belong to life insurance industry, retired there from in the executive director grade. My one thing I would like to share here, nowadays in my house, some work is going on and the labor is working. Some of the laborers are from UP. And though I am Maharashtrian, I was brought up in UP. So one day one labor who has come through the contractor, he said he had some money invested in Sahara and all that. And then I had to help him there is a portal and all that. So my simple submission to the distributor fraternity, even to Zerodha, even to SBI-MF, who is 97% pin code, because there are a lot of such people on unorganized sector who are earning daily wages. Say he may be earning 1,000 rupees daily, perhaps, wage. So he wants to be a saver, and the Sahara found it as an opportunity and converted those savers into investors. And finally, we know the result. So there is a lot of things because the major portion of India is, I think, those people. So I would like to hear some only in a very few words from the distributor fraternity, from SBI-MF, as well as Zerodha. Are we addressing those people for the benefit, not for their own benefit, for the benefit of the nation and for the sustainable capital formation? Thank you.
So I think that is why we are creating several new distributors. So our organization itself, we have been adding more than 5,000 new people in the industry, and we are educating the distributors, and they in turn go to these investors and they are from the community, from the smaller towns. So they can speak the same language and tell them that these are unregulated, what you are talking about, all unregulated collective investment schemes. I think SEBI also has taken a hard step on that, but despite of that, our country is so large, and those kind of chit funds and VC schemes and certainly exist, but that's where we have been trying to go in small groups. Even SEBI has specifically set apart 2%, 0.2% for the investor education. IAP programs are going on in a big way in smaller towns and cities, and maybe to what extent it is helping, it is difficult to say, but certainly that work is happening. But we need more feet on street, like in life insurance industry and general insurance. There may be more than 2-3 million people. I think if they come into the mutual fund industry as well, as Dina Ben was also mentioning, if steps are taken in that direction, and I think with the help of the regulator, if it is done in a right way, that really will be of national interest. I completely agree and acknowledge what you say.
Yeah. See, being a completely online business model, I'll be frank, it will be very difficult to address that segment of society for us, because of our own business model. However, that said, I'm very happy to share that we've been funding and partnering with startups who are experimenting with the idea of delivering customized support to small investors. Right. I hope over the next few years that experiment pays off, and through these partners we will be able to address such concerns.
So, can you name any startup which is in this?
There's a company called Asset Plus, based out of Chennai. We are partnering with them and funding them to take up this initiative.
Thank you so much. Yes, madam. 97% pin codes.
I think what happens is that in a lot of these places, sometimes a crime is committed, justice is not served. So there is this lot of mistrust ke, ye jo mujhe bech raha hai, isko to main janta hu, unko nahi janta. But we have to also, bring to them the point that the regulator who is governing financial products is very, very proactive, and another system may fail you, but this won't. So that is also, I think, probably, yes, we should make a point to do that there is a point of last resort which is available.
Actually, some daily collection was happening from those people, and that is how this.
Yeah, that is another, the ticket size, they take is smaller.
We should think of something, some product.
So SIP was started for just this. SIP is an Indian innovation, was started to just address this market, but now there is feedback growing that perhaps you need to lower the ticket sizes, which is what we've also discussed today.
Thank you, madam. Thank you.
We'll try to wrap up this session now. I
can do it offline while we have tea. Huh? All the more reason that we meet outside. But thank you very much. Just one tip for all the youngsters: if you want to become a crorepati, start today. You just need to invest 1,500 rupees a month. At a 10% return, you'll become a crorepati in 40 years. Okay, so I became a crorepati in 35 years, while when I started with 160 rupees. So yeah, it's not too difficult.
So first, I would like to invite the quiz contest winner, Mr. Samrat, to please come on the stage. And that was a quiz, very tough quiz to crack, actually. Now I would like to invite Mr. Bhatia to please give mementos to all the panelists. Sir, sir. I'll now invite Ms. Rachna ma'am to please give a memento to Sir then. A little bit of, NSE. I'll just make an admin announcement. Those of us participants who are joining us at NISM, the bus will leave after 6. So please contact the NISM coordinators. And also there's a high tea and the distribution of certificates. There are desks lined outside. You all can collect the certificates and the kits for the conference. And now I'll invite Tirthankar sir to please give the NSE memento.